Ladies and gentlemen, welcome to Emergence 2025 Singapore. Can we give a big round of applause just to all of you here? Thank you so much for making it here so early in the morning, all the way at Suntec City Convention Hall, as well as our online audience. We want to welcome them. Thank you so much for making your time here today. Well, it's actually really heartwarming as I was sharing to see so many of us. Some of us were here, maybe kind of a show of hands. Who were here actually during the October last year, Venture and Capital 2024? I see a good number. Yeah, very nice. I see the familiar faces, and we also want to welcome the new faces as well. Besides the new faces, Steve, I also actually see we have many guests from overseas who can have a huge shout out here. We have some from Vietnam, I think. Yeah, Hong Kong, as well, Australia. Yeah, all right. That's great. US. Anyone else we missed? Of course, Singapore. We have Singapore in the house. Yeah, many one of us. Right, the weather nowadays has been really great. I think, thank God, it cooled down a little bit. So it'd be really good to see all of us here making our time here. Really well worth it today on this very, very special. Today's weekday, right? Yeah, it's a weekday and everyone's making that time. Yeah. Okay. So without further ado, actually, to kick all things off, we would like to just say, for those of you who are streaming in, once again, we have actually the seats right in front because we see those that are entering. There are some seats right in front. Do fill with the pockets of seats you see here. You can just sit right up there. Okay. Now, I'm sure all of us are really excited for the day ahead. Without further ado, we'd like to kick things off. Ladies and gentlemen, would you put your hands together to join me and welcome Mr. Steve Torso, CEO and co-founder of Wholesale Investor and Capital HQ. Steve, please.
Thank you so much, Evangeline. Everyone likes a nice, energetic welcome. Evangeline's one of our favorite hosts. So big thank you to everyone for joining us. And this is obviously such an important time from a market's perspective as far as what's taking place. And, you know, one of the things that I was thinking about, Emergence was initially born out of the idea about placing a spotlight on innovation. And that was, we started that in about 2018. Now it's about placing a spotlight on private markets. And I'll get to that in my actual presentation as far as from a focus perspective. Now, the history of Wholesale Investor, just so people know, a lot of people know us for a lot of the sort of startups and scale-ups and innovative companies that we work with. The reality is now we actually also work with a lot of private credit, fund-related opportunities to actually align with that. And I suppose that goes along with my thesis, which I'll also cover in my presentation as well. And you know, to me, the history of Emergence is that each Emergence has its own journey and how we get here. And you know, we've dealt with all sorts of things. Just to give you an idea, some of the history of Emergence, and I don't know why I've been lucky with this conference in so many different ways across the globe. But to give you an idea, in 2020, we hosted Emergence 1 week. I think it was like 1 week and 2 days before lockdowns. Like that was in 2020. And then in 2022, they literally opened up Australia to actually have in-person events the week before that we were hosting our Emergence conference. So this has become something very special to me. I'm super proud to obviously bring it to Singapore. I think this is our 5th year that we've been hosting it in Singapore. And we do this in such a way where we try and align the themes of the actual event with the themes that are what investors want to cover, you know, or what investors are most interested in at this actual time. So for me, Emergence is really the destination where, you know, we want to provide insights into what's happening across venture capital, digital assets, private credit, private equity, and also family offices as well. Now, just so you know, like whenever you're organizing panel sessions and you're organizing panelists and so forth, you know, everyone always asks, oh, what would you like us to talk about? And my guidance is always really simple. I want people to walk away with their own investment thesis. So therefore, all I want panelists to do and all I want speakers to do is to give their investment thesis about what they're looking at right now, what they're seeing, how they're interpreting it, and what actions they're looking to take based on it, right? Because really, when you sort of boil down this whole game of investment, it's really just a game of thesis. We all have our own investment thesis, we build it, and then it's a process of looking to execute on it. So for me, I'm going to dive into my thesis, right? And it's going to be minus a bit of noise that you can hear in the markets at the moment, but I will sort of cover it as well. But I've been mentioning this now going back to September, October last year. And whilst timing is always difficult dealing in a markets perspective, I still believe this is one of the best times that we have seen for accessing for the foundations of growth, high growth, and high yield investments. And I will do my best to articulate on that. On the innovation side, this is one of the things that I think we always forget and that we always get a bit comfortable with, is that in innovation, often it first replaces the value of the incumbent and then it actually accelerates it past it. I'll give you a beautiful example of this, and it's actually in the crypto space. What has a higher market cap? The NASDAQ or Coinbase? Go and have a look. Blows you away. And you think about how early we are in the crypto cycle, like you're at 8% adoption. And yet Coinbase is actually ahead when it comes from that. But typically this always happens in technology evolutions. We all saw it for all those of us that used to read newspapers. We watched the actual classifieds section be decimated by online. And now we're part of that next evolution of what comes next. The next versions of the internet, the next version of innovation that's actually coming through the pipeline. And I definitely don't take credit for this, but this is some of the work that's been done by ARK Invest and Kathy Wood, and I'll sort of talk about that in a second. But if you look at it, right now we're looking at a time where there's a convergence of technology platforms. And so this is why, from an investor's perspective, and even from a business builder's perspective, this is an absolutely amazing time to be building business and be in the innovation space. Because, okay, who in the room uses AI on a daily basis? Wow. I'm hoping one day, I know we've all used it in different ways, whether through different service providers, but it has been an absolute game changer for my business and for a lot of the companies that we actually work with. To me, and I'll go through what I'm focused on the AI front as part of this, robotics. Basically the biggest focus at the moment is obviously on autonomous solutions, whether it be digital solutions or in physical, whether it be on the robotic side. Then you've got energy storage, then you've got blockchain, and then you've got multi-omics in the DNA sequencing. The reality is there is so much happening from this innovation space, but all of them are really only at the early stages. And if you look at all technology goes through an S adoption curve. Now, of course, no S adoption curve looks perfect. It's a murky, murky journey that goes through all sorts of variations through this cycle. But you can see that most of the value that gets created in this journey is in that early adopters and the early majority phase. The crazy part is when you go back to that slide, all these technologies are actually going through right now their early adopters and their early majority phase. And what's so important about that is, from an investor's perspective, this sort of forms the thesis as to why I believe this is one of the greatest times to access high growth. Everyone talks about how productivity has been stagnant for so long. Now it's about to accelerate exponentially through the roof for a lot of different reasons. And you can see here, once again, like the early adopters and the early majority really only is about that sort of 13.5% mark. And crypto, as an example, is only at 8%. In the private credit space, it's also still very early in its life cycle as far as the interest that's been created in this. And, so if you go across all those different areas and you do your own sort of research, you'll realize all these different technology platforms are actually starting to work with each other, which is also an incredible thing, and also across multiple sectors. Before, as a company, I used to be so focused on sectors, right? Now, sort of more I think about it from the platform technologies perspective, because they actually infiltrate every single area. Now I know different people, who knows Kathy Wood from ARK Invest? Well, only a few. So it's interesting, everyone's got sort of different opinions about her funds. What I love is her research. And they publicly share their research for free. Like, you can literally download it, put it into Notebook LM and turn it into your own podcast if you want to, right? But it is absolutely worth exploring what is happening, what she talks about. But her comment of technology breakthroughs in AI, autonomous mobility, and humanoid robots are likely to turbocharge productivity again, causing another step function in growth over the next 5 to 10 years. There is some great periods that they can point to in history, whether it was about the inventing of electricity, about trains, the automotive solutions, etc., what that did to GDP at that stage, right? When there was another period where there was a convergence of technology platforms. And the other part is with that pace of innovation, right? AI will first, as I mentioned before, it will first actually match the value of the internet, then it will actually accelerate beyond it. So if you think about how much value is being created by online solutions, by applications, via networks, etc., network effect, it is nothing compared to what comes next. And so when I actually did this, and from a thesis perspective, if you think about the way all things are building out, there is so much network effect, whether it be on social media platforms, whether it be on messaging solutions that we deal with, chat solutions, etc., that all of a sudden you can have, like if you have a look at some of the stats around software like Cursor and, shit, I just forgot one. Some of the different AI solutions that are coming out now, they're scaling to $100 million in revenue super quick. Right? Then there's reports of one of the image generation ones where they've got 10 staff and they've got 200 million of recurring revenue. Right? So all this sort of stuff is coming down the pipeline. And actually, Sam Altman says in his friends group chat, they've got a conversation about they've got a bet about when the first company that becomes a unicorn that's only got one team member. And so you sit there and think, all the rules of business have changed. Everything that we thought about, if you think about how we were taught, like for example, I know B2B has actually been quite a hard area in Singapore. The rules of B2B have changed because we were all told how to build a B2B business was you had to have your lead generators, you had to have your salespeople, you had to have your implementation managers, then you had to have your customer success managers. All changed. Everyone's building towards product-led growth now, right? So, sorry, I should speak to this actual slide. This was an interesting take. There's lots of different quotes out there about Bitcoin, but I found it interesting the way Michael Saylor talked about Bitcoin. Has anyone been following, I think it's just called strategy now, isn't it? Has everyone been following MicroStrategy? Who knows a Michael Saylor out of curiosity? Wow, it's less than what I expected. So Michael Saylor famously, if you go his company's called MicroStrategy. So if you actually go have a look at their share price now, MicroStrategy on the NASDAQ, in 2020, he was just basically a software solutions company effectively going sideways for a period of time. And then he come up with an innovative strategy. He decided that he's got his core business, his core products that he sells, and then he thought, what I'm going to do is I'm actually going to put my balance sheet into play, right, in actually helping build the value of the business. So he took a balance sheet strategy with Bitcoin, and he went all in on Bitcoin. Have a look at how much that share price has grown over the last sort of 5 years, right? And so what he's done is then created all sorts of mechanisms and instruments to keep on acquiring more Bitcoin onto his balance sheet. Because for him, he thought, this is the best way for me to continuously grow my business as what he defined of, this is how I generate 29% ARR, to $13 million for my shareholders. And it really makes you think about what is that, how could you take a different approach to your own balance sheet as a business owner? Or how will listed companies do it in the future? So the digital asset bull run, is something that I'll sort of talk about because it's just such a prominent thing and it's sort of in mid-phase at the moment where it's just such a rare thing where a president wins an election based on something like this. I've never seen a technology that's had so much against it. There is so many reasons why Bitcoin should have failed. No banking support. I know, just to give you an idea, in Australia, to buy crypto through a crypto exchange, if you're trying to buy more than 10K worth of crypto, you have no idea of the process. The banks will shut down your account. You'll have the fraud departments ringing you up trying to find out, and then you'll be interrogated as to why you're buying it, who recommended it to you, and so forth, right? Just find me another asset class that's had that sort of level of interrogation and that's in the multiple $1 trillion of value that's been created. Right? So this is my sort of thesis where I sit there and look at it and think, well, it's got a limited supply, and we always believe, fundamental economics, supply and demand. Well, now, obviously, they're setting up the strategic Bitcoin reserve. They haven't quite announced how much they're going to put into it. Like the expectations was 1 million, but they've not said that at all. They've just talked about the amount they've already got now, which is like 208,000. But it's interesting, in them setting up their strategic Bitcoin reserve and including it as part of their sovereign fund, what does that then do? Give the green light to other sovereign funds to then do? Also, look at holding Bitcoin on their balance sheet. Now, the interesting part about that is when you do a bit of a deep dive, you see that there's 70 public listed companies around the globe that actually have crypto on their balance sheet. Now, if you've got sovereign governments that are starting to actually put crypto on their balance sheet, then all of a sudden you'll find that more and more corporate listed companies, just like fund managers are going to have pressure to put anywhere between sort of 2 to 5% of their assets into Bitcoin, likewise, listed companies at some stage are also most likely to be expected to have some of their balance sheet also in Bitcoin as well. And it becomes interesting because then you combine that with all the ETF products. When I created this slide, there was 262 ETF products that made it all easily accessible for people to buy into. Now, I know what a hub for crypto Singapore is, obviously, but this global access for, as I said, it's obviously been, dominated in several different areas, but in other places, they've got very, very low adoption rate. But what's so important about this is, as I mentioned to you, how hard it is to buy more than 10K worth of crypto. I'll give you an example. Commonwealth Bank in Australia, they're the kind of ones that we'll call the fraud squad, and all those different things. They'll have their fraud departments calling you to do that for buying more than 10K worth of crypto. But if you go and put $1 million into a Bitcoin ETF through CommSec, the trading account, do you think you'll get any questions? Not at all. That's the difference it makes. So for me, I'm so bullish, and once again, I'm not a timing person. The way I think about things is, where are things going over the next decade? And then set a direction in that alignment and understand it's an absolutely wild journey, going through that process. So then from the venture capital trends, likewise, I'm not a VC expert. That's why we have them for the panel. When I was sort of watching everything coming out of the US, and as I said, there's a lot of noise, there's a lot of media, I basically just stop reading all media and just watch the interviews. Watch the interviews direct. And this is where I landed. The absolute focus now, and if you think about it, it's logical. The absolute focus coming out of the US government is, number one, energy. 3, 4, 5 years ago, it was all about sustainable energy. Now it's just energy. Why? Because it needs it to fuel the technical requirements. So if you think about the autonomous solutions, right? For anyone that's used ChatGPT, you'll know that the early iteration of ChatGPT was like you ask it a question, it gives you a reply. That was fairly easy, right? But even that, the amount of energy consumption in that alone was astronomical and already started putting pressure on energy grids. Then you add reasoning to it, and then you add deep research, and all of a sudden, those same one questions, that same prompt that you would ask, all of a sudden has 50 to 100 times the requirements from an energy perspective in actually delivering that answer to you. So therefore, energy at all costs is going to be the absolute focus going forward. Autonomous solutions, whether it be a robotics or whether it be digital solutions. Then the next one, tech stack. Any investor looking to invest into a company in the venture or in the startup and scale-up space, if they are not asking that company what is the tech stack that they're using on a daily basis, said they are making a grave mistake for themselves, because you want to understand the level of productivity that is sitting inside that company, because you cannot beat the different autonomous solutions that are going to be coming out, whether it be through AI or whether it be through robotics, right? Because that, for every one of us, the ability for us to maximize our productivity is what's coming down the pipeline. And then when you've got AI across healthcare, agri-tech, and also health tech, it also becomes super interesting. So for me, they're the trends when I sort of looked at everything, and obviously that really is focused around sort of food supply and also improvements in healthcare, just because of the cost of the healthcare system on most economies. So when I was sort of looking at the trends and what everyone was talking about, if you actually remove all the noise, that basically aligns with the focus. And then so you move into the macro trends, right? Now I'll mention about, because I know there's talk about sort of recession in the US and so forth. Everyone felt the Trump bump, right, when the US elections took place. Then, but at the same time, interest rates went down again. But interest rates is probably the biggest mover, that you can see. But then this next one, and there's some great work done by Raoul Paul where he talks about the everything code, where he's a macroeconomist and he's looked at absolutely every trend, and he basically consults to family offices, sovereign funds, and so forth about sort of macroeconomic issues. And the reality is where he landed is that everything, basically markets move towards money supply. And so whilst there's been a tightening phase over the last few years, which we all would have felt, in the innovation ecosystem, all the governments around the world, the central banks, will have to actually start increasing their money supply. Why? Because they have to pay their own interest payments. And it's typically one of the biggest drivers of what actually moves in the markets. And then the last one is if interest rates start to come down, you're moving into a pro-business environment, and then likewise, money supply starts increasing, then all of a sudden more and more cash will come off the sidelines. Now, is it unsurprising that the words recession have been thrown around? Well, it's not. If you're thinking about taking $1 trillion of costs out of an economy, that has to be replaced somehow. Taking money out, and that's just on the government spending side. Effectively, they have to try and match that with growth, to actually not say they're going into recession. I've got a thesis for Australia, so I don't know if you have the same for Singapore. I think our government had two decisions to make. Do we want headlines to be about inflation, or do we want headlines to be about recession? And I think they chose the inflation angle. Because in Australia, 87% of new jobs come from non-market opportunities. Does anyone know what non-market means? Government funded. 87% of new jobs. So, I've got some thoughts about what's going to happen with that. So then the other thought, and I know, by the way, I'm very well aware that just putting that word up, Trump, upsets about 50% of you. Very well aware of that. But I thought in this space, we have to look at trends. And so I thought I'll go and have a look at what was the trend of the last presidency so I can understand what to expect or what to look out for in this presidency. I was blown away when I did these numbers. Right, so firstly, I didn't realize the NASDAQ went up that much. Now, fair enough, there was a whole bunch of COVID stimulus in that, right? So I don't know, I'm sure there's a great analyst that can tell me how much that could account for as part of that growth, but that's what it actually did. The one that really surprised me was crypto. I had no idea crypto went up that much during his last presidency, right? Then you've got US venture capital, same thing. Also, the stimulus, the $9 trillion of stimulus around the world would have had an impact. The one that was disappointing, I said, I'm not sure what the Singapore stock market did. I'm sure some of you can tell me, but All Ords, the Australian All Ordinaries, was very disappointing in that period. But actually, interestingly enough, Australian venture capital went through the roof during that period. So, as I said, sometimes it helps just to stop the noise and actually go and have a look at the numbers. But also, I said, I understand that there was a whole bunch of stimulus money in that picture. So then I had a look sort of going up to November 19. And it was still, even with the NASDAQ 100, I think it was still at something like 80% growth at that point, sort of nearly 3 years in at that point. So, welcome to Emergence. And, today the whole idea is about sort of gaining access to, the innovation future. I will mention on the AI front, I hope they really cover it. I think AI is the most exciting. Obviously, I'm in this space. I work with it every single day. The key things I'm focused on is what are the development applications that are coming out for AI, because that changes. The day I can build an application, it's all over. I am useless technically. So if I can start building stuff, I can build demos of stuff now, like using things like Cursor and Replit, etc. It is game over when normal people with no technical experience can start prompting their way to building applications. What individual companies and individual human potential is possible of, all the rules change. So the three business, as I said, I set my direction for 10 years and then basically look for the trends that are taking place within that. The business trends, great succession, absolutely unavoidable because of demographics, right? And obviously we've got a keynote speaker today to talk about that. The expansion of private market opportunities. I know the SGX has not had as many new listings as what people would have thought over the last decade. Guess what? NASDAQ has, I think, half the amount of listings as to what they had sort of back in the 2000s. The ASX has the same amount of ASX listings as what they had in 2006. Private markets will be expanding to $30 trillion of assets by 2033. The rise of non-bank lending, as bank criteria start to tighten up, there's so much more opportunity now and obviously we've got some great presenting companies, both from Australia and locally that are talking about this today as well. So I won't go into that, but 40% of businesses. Do you know, in the UK, they've actually got a government policy, a government discussion around this, because if baby boomers don't go through some sort of exit process or a succession process with their business so the business continues, they have a massive tax collection issue. So if you think about all these businesses and the taxes that they pay, 40% of them, it actually represents a substantial amount. This area growing at the expansion, if you notice from a WI perspective, where I position WI now is firmly in private markets because that is typically what we work with. And then this part, it's obviously interesting to see all the various opportunities that are coming out in this area. To me, they will continue to expand. And also, I said I even caught up with a shareholder yesterday who's basically started a private credit opportunity in Vietnam and said investors absolutely love it because right now it's a beautiful time. I said investors want yield, but it's also an incredible time to get access to growth through private equity. And private equity also looks interesting when overlaid with AI or robotics for traditional businesses. So that comes to the sort of, I'm going to do one final part for my talk. So obviously today we've got a media wall outside, so make sure you take a media photo of the media wall and tag yourself. Yes, I'm happy to take photos with everyone. And then also as part of today, some of the key points I'll mention, we've got some incredible speakers. Callum's going to be talking about that sort of business succession opportunity. Harley, coming from Prime Finance and also Auto. I think Prime Finance is one of the most best set up companies that I've seen in Australia to take advantage of what I see as the sort of decade-long trends. Andrew Shute, no pressure on Andrew, but I'm hoping he's going to become our next unicorn company that we're working with, and I'll let him talk about why. He's got a keynote in this sort of he can talk about what he's doing. And then Joey from TNB said, obviously I've had great admiration and respect for TNB for a long time, what they've been able to do in the innovation space and their role as an investor. So great to have them as a keynote speaker. Panel sessions, crypto investment panel session, always a favorite with our audience. We've got the venture capital and innovation investment trends session last for today, so saving the best for last. And then the alternative investments is to go around what is the family office investment thesis looking at? And then secondly to that, also the areas around private credit as well, across business, across property, etc. And then as far as the companies presenting, I'm going to give you a bit of a little summary just to make sure I don't miss anyone. We've got Old Quarter Coffee who's presenting today. They're revolutionizing specialty coffee through a direct ethical supply chain, which is actually out of Vietnam. And also, Amelia, if you haven't met her, she's one of the loveliest human beings I've come across. Bingo Tech have actually come out from the US. Incredibly fast growth. He's actually gone from, just to give you the numbers, his growth over the last year was from 1.8 million to 8 million this year. And following a partnership with Uber, they're targeting going to 20 million plus next year. What they do is they offer last mile fleets, offering light EVs, smart battery solutions, and management as well. And it's obviously all tech enabled. EBR, so he's the one I've mentioned, no pressure on Andrew, but EBR providing advanced wireless cardiac rhythm treatment. They're expecting their sort of FDA approval sort of mid-April, which is an exciting time for them. But they basically, if you think about pacemakers, they actually eliminate the pacemaker. So they've got a wireless device, which he will speak to it far more articulate than what I was. Chiron Global have actually got an impressive contract actually with a significant Singaporean entity. They're providing patented high-impact personal protective equipment that's already been adopted by global defence. If you can imagine, defence tech spending is through the roof at the moment, and they've got a relevant local strong customer, which they can talk about. Good Earth Dairy, infant formulas become a popular subject now with obviously the changes that are taking place at the FDA. Good Earth Dairy have got a new technology, efficient camel milk production, and the recipient of over 4.5 million grants in Australia. When I first heard of camel milk, I had no idea about the nutritional benefits of camel milk. I laughed also. I just saw someone smiling before. I laughed also until I tasted it and then until I started reading about it. Fruity Sugar, obviously I'm very well aware of the issues around diabetes in the region. So they're actually providing affordable natural sugar substitutes to combat diabetes globally. And then Acuity Development, got profitable, sustainable communities that they're building in Australia through obviously property developments. And also very pumped to have Alex Bank here. So Alex Bank is the actual really only fully digital challenger bank, neobank in Australia. designed for scale. They've got low cost deposit funding, and have got an incredible team behind it. And then lastly, Refield, which is an Australian company. And by the way, Refield is just so perfect alignment from a trend perspective in Singapore. I couldn't believe it when I come here last year and I just realized that there was no plastic bottles anywhere. Like, to actually go looking to get a bottle of water was an impossible mission. It took me like 15 minutes, right? So they're perfectly tapping into that trend, but obviously providing other solutions that have already got some contracts with 5-star hotels, etc. So another good solution. So ladies and gentlemen, I've definitely gone over my time. My final thing I'm going to say is a big thank you to Prime and TMB. Going to the Capital HQ app, I've sent you an email. You can network with each other in there, set up discussions with all the companies that are presenting. And then lastly, the power of one conversation is everything. What is so beautiful about these events is sometimes you'll be thinking 5 years from now how you come across that opportunity or that person, and it often takes place at this event. You know, I've seen this happen so many times where one conversation can change the entire trajectory of a business and also of an investment opportunity. And that is why I love creating these events and putting on these conferences, that manufactured serendipity. So make the most of it. If the deal is not relevant for you, maybe they're relevant for investors in your network, please do the introduction. Nearly everyone has flown to come over here today. Make the most of the time. The day will go incredibly fast, but the networking will be strong all day. And of course, we finish with networking drinks. So ladies and gentlemen, enjoy your Emergence 2025.
Thank you so much, Steve, for that introduction and invigorating speech. Could we give just a huge round of applause? Thank you for Steve for that introduction, for that energetic start to the day, as well as Wholesale Investor for organizing this event. We do see a very good stream of people coming in. Actually, in fact, this morning we were talking about manifesting an entire room, being present, full of guests. And in fact, we have more. And so we have actually added more chairs in. I think we might need a bigger ballroom next year. Okay, so for those who are new, just a quick introduction on and welcome once again to Emergence 2025, a premier investment conference series where visionary investors and groundbreaking innovations converge to shape the future. So as Steve shared just now, if I may too, the power of one conversation is extremely powerful. So we hope today will be filled with those conversations for you, and you would not walk away with that just one conversation which might change the future of your company or your investment in years to come. With that, ladies and gentlemen, we want to start and kick off with our first keynote address. If we may, we want to introduce Mr. Caleb Lang, the founder of Guild Members. He's here today to share his perspectives on small business M&A, as well as succession and ecosystem. Would you put your hands together and join me to welcome Mr. Caleb Lang?
Thank you, everyone. Great to see so many people here. Yeah, great talk from Steve there, and I absolutely agree with his thesis. And just the rate of pace of AI is absolutely mind-blowing at the moment. We don't really work in that high-tech space. We work with traditional old economy small businesses. So Steve asked me to talk about small business M&A, succession and ecosystems, which is an awful lot to cover. He then told me I had 15 minutes. So I'm going to go through as fast as I can. I may be a little bit overwhelming. If you reach out to me on LinkedIn and just mention Emergence, then I'll send you these slides or anything else you want. Quick background on me. I've been an entrepreneur for about 25 years, won a bunch of awards, written 4 best-selling books. The third book on there, Entrepreneurial Investing, there's a whole bunch of them that were supposed to be delivered half an hour ago. I'm assured they will be delivered before the end of today, so just feel free to take a copy. We've taken over 100 companies public through Unity Group in the last decade. I have got the Guild, which is Global Investment Leaders Directive, which is a global network of 500 capital raisers. And then we have Veblen Director Program, which helps women, minorities, and first-timers to get board seats and has allowed us to put boards, have 250 people on boards all over the world. And we add about 10 to 20 board seats a month. And then Get Launched, which is all about monetizing communities. So with that, what I wanted to talk about was predominantly ecosystems, how we've managed to take 100 companies public and raise 100 million through a regulated fund. And I kind of want to show what we've done through our core business, it's not to say replicate this, but what I hope to emphasize is that anyone can create an ecosystem around your core business, which will allow you to amplify significantly what you're doing. So our core business is Unity Group. We're kind of a boutique M&A shop / investment bank place. Our core product is we take holdcos public in various markets around the world, typically Europe or the US, and then we find good owner-operated small businesses, cash-generating, old economy, boring businesses, construction, education, transport, that sort of thing, but not where the founder wants to exit, where the founder wants to grow. And so what we do is we let them reverse into our shell. So in effect, they swap their private stock for public stock, but they keep running their own business, but now they get all the advantages of a PLC. This can be industry specific or a traditional conglomerate. It can be in one geography or it can be geographically dispersed. At this point, no cash is needed, so it's a relatively easy way to solve a problem for small businesses. Behind the scenes, we do have an investment model. Those of you from Singapore will be familiar probably with first degree global asset management. So we have a MAS regulated fund. We raise money in that fund. It's a 5-year bond, pays 15%. We take the cash from that. We invest it down here in the SMEs. It's growth capital for them to grow once they're listed. And typically we'll get a 2-for-1 return on that. So we get our private stock in their business. We then get acquired by our own PLC, turning that into public stock. It's all locked up for 5 years, which kind of gets rid of the problem of people going public and then dumping their stock. Everyone is locked up for 5 years. We then have an investor off-ramp. So we have a small group of investors that buy our stock at a significant discount so they can show it on their balance sheet and show the uplift immediately. And then we take that capital that we get from that, we send 15% back to our investors, and then we can reuse the other capital and basically kind of get into this infinite money loop around that cycle. So that's kind of going on in the background. I'm not suggesting anyone tries to replicate this model. It's been very successful for us. As an entrepreneur, entrepreneurs are a nightmare to deal with. We always think we're right. We hate listening to anyone. So trying to put 100 of them in groups together is a nightmare, but it's a very big pool to fish in. As Steve mentioned, we have a lot of these businesses are baby boomers. They're looking for solutions right now. They've got a real problem and they're looking for people to help them solve it. We get about 1,000 inbound inquiries a year. It's actually probably gone up significantly in the last 6 months or so. That's what allows us to do this model. We're able to move through deals so quickly. And basically, when you get that much deal flow, you can do this take it or leave it deal structure. Now, lawyers, anyone that does small business or any M&A will know that lawyers are the bane of our lives. When you have a take it or leave it structure, lawyers can't do anything with that. And anything that upsets lawyers makes me happy. But you can only do that when you've got significant deal flow. And so that's kind of what we'll get onto. And then we sort of discovered this by accident, that acquisition is really the best succession planning strategy that we found. So we had tried lots of things for succession planning, the sort of traditional promote someone from within. It's nearly impossible to convince an employee to think like an owner. It just very rarely works. It's very difficult to bring someone in from a different company. You have that culture shock and all the problems that come with that. So the best solution that we've found is have an entrepreneur running an entrepreneurial business, acquire the other business, and then at least you end up with an entrepreneur running an entrepreneurial business. It's not 100%, it doesn't work every time, but we've found it as to be the best succession planning model so far. Now, the whole idea around ecosystems is really anyone that does deals will know deals are hard. There's that sort of famous saying that if you don't think you've lost a deal at least 3 times, it's not a real deal. This kind of happens a lot. To get good at it, you really need to have enough deal flow that you can walk away from deals, that you can make mistakes on deals. And I like to think that we've made every possible mistake on deals, and probably twice because we're slow learners. But if you've got that flow of deals, you can make those mistakes. You can also walk away from deals. And I see a lot of people, especially in private equity right now, doing deals because they have to do deals. They know it's a bad deal, but they have to show that they can do deals. Ecosystems give you both credibility and deal flow. I'll very quickly go through ours. We've got Unity Group in the middle, some trusted partners around us, and a wider ecosystem of partners. My business partner, Jeremy Harbour, started the Harbour Club, which was the first small business M&A training program about 15 years ago. We've got 2,000 alumni have been through that all over the world. That gives us a huge source of deals. I mentioned the Global Investment Leaders Directive. We've got 500 people learning about capital raising all around the world. That gives us a bunch of deals. Veblen Director Program. The more people we can get sitting on boards, the more access we have to those boards. We have an investor relations digital marketing company which amplifies and does lead generation for all of those things, which all then feeds into us. And then obviously we've got the stock exchanges we work with and our own public listcos. And that's allowed us to get to a point where we can go to investors whenever we want and say, hey, we want to raise capital. And it's very, very easy to raise capital now. Whereas if we were just Unity Group, it would be the same slog that everybody else faces when you try and raise capital, because raising capital is generally a slog. But if you've got that ecosystem around you, investors take a lot of comfort with that. So what I wanted to do was share with you a 3-step framework that seems to work for anyone that wants to build an ecosystem. It's a useful thing to think about when you're watching the other speakers on stage today, when you're meeting people networking. Can you be in their ecosystem? Can they be in your ecosystem? So the first one is amplification through connection. And key idea here is you don't need to own all the elements of an ecosystem. It can just be a trusted partner, somebody that you work with. But the key thing is they've got to know about you and you've got to understand about them. Where's the value transfer there? Demonstrate your value. Be useful to those who have what you want. The other thing to think about is doing deals specifically for leads. So most people, you have your thesis about what you want to do, you invest in high tech or whatever. It can be worth doing a deal that you wouldn't normally do just because that company can feed you leads for more deals in the future. That works quite well. This is something that we use a lot in the Veblen Director Program. When we're helping people get their first board seat, we aim to get them their first board seat within 60 days of joining us. What we tell them is to shout about it. So as soon as you get your first board seat, shout about it on LinkedIn. Very often, they will get their second or even their third board seat from that LinkedIn post. Because suddenly what happens is everyone in their network sees them in a completely different light and says, oh, I should introduce you to such and such. In the finance world and the investment world, we're really bad at talking about our successes. You have to be able to do it. This room is full of really nice people that would help you if they knew how to do it in an easy way. Not too hard, but if they can just make one introduction, they'd be more than happy to do it. But they don't know what you value yet. So shout about your wins and it becomes self-perpetuating. Scale through specialization. This is really me being lazy. I'm a very bad salesperson. So if someone comes to me wanting X and I've only got Y to offer them, it's just too hard to try and convince them to buy Y. So what I like to do is to have enough options in my ecosystem that whatever someone is looking for, I can give them what they want, and then slowly, once we've built that relationship, move them to what's more high value for me. So coming into our ecosystem, we've got some people want to learn, some people want to do deals, some people want to raise capital, buy a company, take a company public, high yield returns, build their status. Whatever it is that somebody's looking for, if I can introduce them to someone in my ecosystem, solve their immediate problem, I can then got a relationship with them and I can move them to some of our higher value activities. And that's really, I think, the key point to ecosystems. And the third one, so we talked about Trump and the interesting times that we live in. Anyone that has been an entrepreneur or done anything knows that as soon as you find something that works, it basically stops working again. So you get really excited, something works, it stops working. Nothing works forever. It's really useful to have an ecosystem so that even if one thing stops working, you've got another thing that's working. It just keeps that flow of deals going. And I'll finish with a quote from Richard Feynman, a famous scientist. He says, you have to keep a dozen of your favorite problems constantly present in your mind. Now, to me, that's a dozen of our businesses. Every time you hear or read a new trick or new result, test it against each of your 12 problems, or in our case, businesses, and see whether it helps. Every once in a while, there will be a hit, and people will say, how did he do it? He must be a genius. And let's face it, that's what we're all after, is someone mistaking us for a genius. So this is what we do. When something works in one business, we can roll it out across the ecosystem, and we get that amplification effect. We can test a new model of working with employees or whatever it is in one business. If it doesn't work, no problem. If it does work, we can roll it out. And then just overall, ecosystems are fun. Like, it's just, business is a team sport. It's more fun to be collaborative. It's more fun to work with groups of people. Friendships are forged through collaboration. So if you can put yourself in that environment, then you can help make stuff happen. So a couple of actions for today. Think about how, when you're meeting people, how they could be in your ecosystem, or how you could build your own ecosystem. If you want to get hold of these slides, because I have torn through this presentation as quickly as I could, reach out to me on LinkedIn, mention Emergence, so I know to accept you. I can give you copies of my books and these slides and anything else. I'll be around all day, and I'd love to chat. So thank you very much.
Thank you so much, Mr. Caleb. That was such a really insightful and informative one. And I believe all of us will actually, see the benefits of being part of the ecosystem and being collaborative, in this entire space that we are together as entrepreneurs. So the next keynote we have coming up next is actually a company presentation segment where we will hear directly from the innovative businesses themselves. First up, we have EBR Systems. They are listed on the Australian Securities Exchange under the ticker symbol EBR. Please welcome with me, ladies and gentlemen, Mr. Andrew Shute, Senior VP of Business Development, to tell us more about their organization. Thank you so much, sir.
Yeah, so start thanking Steve and the team for the opportunity to present, I think, for the second year at this meeting. So I'm pleased to represent EBR Systems, and as mentioned in the introduction, we're listed on the Australian Stock Exchange, and we are less than 2 weeks away from receiving FDA approval, which is a transformational point in our company. So I'd like to start by saying, I guess my objective today is just to share why we believe we're a de-risked investment opportunity, and we've laid the foundations to be a high-growth medical device company. So we've developed the world's only leadless pacemaker, and although we're to treat heart failure, and although we're participating in the cardiac rhythm management market, that's dominated by 3 major players. We don't have any direct competition. And although there are other leadless pacemakers in the market, they're used for a different indication, a different application to treat slow heart rate or bradycardia. At launch, we'll have a very large addressable market of $3.6 billion in the US alone. That'll only increase as we expand our indications and move into other markets. And I guess our pathway to market's really been underpinned by 2 key things. Firstly, we have the FDA's breakthrough device designation, and that provides us with a direct, informal communication channel with the FDA. And the second is our compelling clinical results. Our pathway to FDA approval really started a number of years ago, but our key milestones were in August last year. We submitted our 5th and final module. We then received our filing acknowledgement in 30 days rather than the customary 45. So I think that boded well for the rest of our review cycle. We had our Day 100 meeting in December, and then we completed a successful pre-approval inspection in January. And that's where the FDA comes onto your premises, inspects your manufacturing facilities, and reviews your quality systems. And we went through that with 0 observations, which is really unusual in our space. And on the back of that, we felt confident to go to the market and say we're expecting FDA approval on or before the 13th of April, as I mentioned, less than 2 weeks away. One of the other key things we have is, as a result of the breakthrough device designation, we automatically qualify for 2 reimbursement schemes in the US, NTAP and TPT, which I'll cover shortly, but they'll allow us to have an ASP of $45,000 US. And with that sort of price point, you only need to sell 2,200 units to get to that 100 million in annual revenue. So as I mentioned, we participate in the cardiac rhythm management market. It's made up of three segments: pacemakers for slow heart rate, implantable defibrillators for those patients at risk of sudden cardiac death, and the segment we participate, cardiac resynchronization therapy, also known as biventricular pacing. This treats a subset of heart failure patients whose left and right ventricles beat out of turn. So the therapy works by pacing both simultaneously to restore that synchrony. So the Achilles heel, I guess, for the last 60 years, we've been implanting pacemakers in humans has been the leads or the wires that connect or that deliver the electrical stimulus to the heart. These can fracture, they can migrate. If the patient develops a pocket infection, those leads can actually act as a conduit to deliver the infection to the heart. An endovascular infection has around about a 30% mortality rate. So to address that, the wider markets move towards leadless pacemakers on the top right and leadless defibrillators on the bottom right. However, we have the only leadless pacemaker, which is the size of a grain of rice, that can be implanted in the left ventricle to treat heart failure. And that's because these other devices are around 20 times larger. If they were implanted into the left ventricle, which is in the arterial system, it has a tendency to clot, and that clot would inevitably lead to a stroke. So as I mentioned, although there are other pacemakers in the market, we actually see ourselves as being complementary to them, not competitive. There's a concept called pacing-induced heart failure, whereby 30% of patients who receive a pacemaker go on to develop heart failure. And we provide the only solution to upgrade these other leadless pacemakers to CRT or cardiac resynchronization therapy. So I'm just going to skip ahead quite a bit here because I'm running out of time already. So 2 years ago at the Heart Rhythm Society in the US, we presented our pivotal clinical trial results. We had phenomenal outcome in our primary efficacy endpoint, which is a 16.4% reduction in left ventricular end systolic volume. That's essentially the amount of blood left in the heart at the end of the contraction phase. And that was then published in JAMA Cardiology last year. So as I mentioned, our pathway to commercialization has really been underpinned by that breakthrough device designation from the FDA, which will lead us to expect commercialization in April, 13th of April, less than 2 weeks away. Reimbursement is really key for us. As I said, we qualify for these two reimbursement schemes, ANTAP and TPT, which will allow us to have that $45,000 US dollar ASP. Want to jump ahead to, so our TAM is fairly large. At launch, as I mentioned, made up of four significant pies. Acute lead failure, this is where they attempted to implant a lead-based CRT system and they were unable to. Chronic lead failure, this is where a patient had a functioning system and they subsequently experienced one of those lead failures that I mentioned. High-risk upgrades and leadless upgrades. And it's that leadless upgrade segment that we're going to see growing at a fairly rapid rate. But beyond that TAM, we still look to increase that. We're starting 2 clinical studies in Australia and the UK this year, which will help us transition from treating previously failed patients to becoming first-line therapy. We continue to invest in R&D. One example of that's a rechargeable battery. We'll be the first company in CRM to have a rechargeable battery that'll be still implanted but charged using induction charging. And we'll continue to expand in some markets outside the US. So the key message for me is 13th of April, less than 2 weeks away, we have FDA approval. Those 2 reimbursement schemes will kick in on the 1st of October, and that's when we begin commercialization. And maybe I'll just spend the last 60 seconds to be the 3rd speaker in a row to talk about the impact of the US election. The previous Trump administration was actually quite favorable to the medical device industry. Dr. Oz, who many will know as a celebrity doctor, he's been appointed to lead CMS. And during his Senate confirmation hearing, he reflected on his time he was working with or associated with eValve. eValve is now marketed by Abbott as the MitraClip, but his key message was it takes a long time for promising medical devices to get reimbursement, and that's his focus on that. So I think that theme will continue across, certainly for the medical device industry. I think maybe if you're a vaccine company, you might be having a little harder time, but I think we're fairly safe as a medical device company. So I'm going to be in around for the rest of the day. I skipped quite a few slides there. So if anyone would like to know any more about our investment thesis, happy to spend some time talking about that. So thank you.
Right, and all of the presentations today, we actually have our exhibitions just right across this hall. Later on, when you exit the doors, we're just opposite, and we have all our exhibition booths, including EBR, and as well as all the other companies later on that you will see. You'll be able to learn more about them and speak more to them after the presentations. All right, and up next, we have our company pitch presentation. We have P2P Group. Ladies and gentlemen, would you put your hands together to welcome Mr. Ed Clark, founder and CEO, to this stage. Mr. Ed, please.
Hello, everyone. As mentioned, my name is Ed Clark, the founder and CEO of P2P Group. We're listed in Canada. So what I want to share about what we do is very unique. So what we actually have done with our business is build a technology which is a world first. Probably none of you have heard of this before. We use the home Wi-Fi router or standard Wi-Fi signal to sense the physical world. So every Wi-Fi router has a standard signal that it sends out, and we can use AI neural networks to scan the environment and understand what's happening and the applications I'll talk through today. But essentially, we're replacing the IoT market. Sensors, specialist devices that look at the physical world and its changes to give information, we can replace with standard Wi-Fi signal. And where does this fit? The reason we got into this is it has so many use cases and it solves a lot of the problems that I faced before in other technology companies that I've worked with and founded, and I'll talk about that. But specifically, home security, your home Wi-Fi system can become your home security system. It can sense people walking into your house into areas that you never wanted people in. So you go to bed, you can tell your system, if someone comes through the living room, front door, while I'm asleep in my bedroom, set an alarm. Military, we have a technology now that can see through walls. So we've been working with the British SAS, we've been working with North American Special Forces to give them the ability to see inside buildings, to do reconnaissance, to do mission planning, and to do execution. A huge space where we've already got a customer that's servicing over 50,000 homes is aged care. So this system you can use in your parents' house for non-intrusive in-home monitoring. So we can sense falls in the house. We can sense the amount of movement that's happening in a building. We can say they've gone to the kitchen, they've had food, they've gone to the bathroom. We can provide a full suite of sensing around a house that would traditionally cost $5,000 to $10,000 in hardware. We can do for the cost of your home router, which is already there. So a bit about our company I'll share today. We're an accomplished team. There's a massive market demand. So we only released our product to the market last month. We've already got operations happening in UK, Australia, Cambodia, North America, across a bunch of different markets. 95% gross margin, so we can run locally or in the cloud. We work with B2B model, so it's a very high margin business, and we're listed in Canada, PPB Group, at 11 million market cap, so it's a really interesting entry point. So a bit on the share structure there, you can see a bit more of that at our booth. So again, what's the problem we're solving? If you look at the IoT space now, I'm sure all of you have got sensors in homes, in agriculture, in supply chain, in healthcare. There's hundreds of pieces of hardware you have to manage, and it creates a massive mess for system networks, cybersecurity, and cost. So it's very difficult to invest as an enterprise in hardware to prove return on investment later. What we do is we get rid of all of that. We turn on the router system that they've got in their network, and we use our neural networks to sense, see, and look for these events. So as I'll show you shortly, break-ins, falls, sleeping, we actually, through a wireless device, which we've got here today, we can read your heart rate and breathing patterns from 5 meters away. So the team, myself, I've listed a tech company in the ASX called Yogi. We took that to the ASX All Ords Index in 3 years. So from founding to a $350 million market cap very quickly in the logistics across Asia. My CTO, Sudhakar Annavella, built a tech company out of Silicon Valley, which was doing 200 million revenue. In fact, Reid Hoffman, the LinkedIn founder, described in an article here that it's the best technology platform he's ever seen. And we met a number of years ago and finally decided to do something together, and this is the business we've put together. So how does it work? So you can see here, you can come to our booth and see it working. With the wireless signal, we can put a small device next to your bed that costs about $5. We can sense heart rate, breathing, and sleep quality remotely in your bedroom. We can also sense, and so here's a picture of the system here. Without any beacons, without any air tags or sensors, we can sense someone walking around the house. Where they went in the house, we can build a predictive health picture of someone for zero hardware cost and $20 a month. And we're talking to people in Cambodia to do remote healthcare as much as we're talking to premium healthcare providers in Australia to deliver this. So we can see where people went, we can look for falls, we can do predictive intelligence. It will sense something as small as brushing your teeth with the Wi-Fi signal in your house. And Wi-Fi signal as a global standard is getting upgraded every year. We're at Wi-Fi 6 now, Wi-Fi 7's being rolled out, we're at Wi-Fi 8 in 18 months. So that's like going from 320p TV to 4K. In the military space, so what you can see here is our system. You can see the people moving around. So military can get 3 small devices, smaller than this, put it around a building, and they can sense what's happening inside buildings before they go in. For safety, for intelligence, they can see who's inside, where they are, where they're moving around. And they can do this with standard hardware, so they don't need to spend thousands and thousands of dollars on equipment. So the markets we go into, as I mentioned, aged care and home security are the big markets we're going for first, because there's a real, in Singapore, you're looking at the aged care problem, which is very similar to the aged care problem in Australia. There's so many people looking for monitoring in a home. The cost effectiveness of deploying this, plus the low cost to maintain it, means it's attainable for mass rollouts. And what we're doing is talking to internet service providers like the Singtels to say, add this as a tick box for your system, and your customers can choose between home security or aged healthcare monitoring in the home for a low fee. Then we move into the military and policing, which in fact we didn't approach when we went to market for healthcare and aged care, but once they found out we could see and sense through walls, we've now got police and military organisations around the world looking to use this for their operational intelligence, but also for things like fire rescue. So if we go back to the slide here, if a fire engine turns up at a hotel, it can put these around a building and find where are the moving people and extract them from the higher floors without having to run through the fire and not know where things are. So again, strong early traction. We only released this to our customers in February. And so we've got customers onboarding for home security. So I mentioned, let's talk about the business model. Aged care company in Australia has 50,000 customers and 20,000 waiting to be deployed. The reason they're waiting for 20,000 deployments is because the existing model is specialist hardware that has to be installed by an electrician, which is costing you $5,000 to $10,000. We can deploy for $0 for the home Wi-Fi system. We can provide more intelligence and greater margins. So how we charge in that model is a per seat per month. So say $20, $30 per month, 50,000 homes becomes a very big opportunity for us and changes the profitability of the provider that's trying to deal with multiple hardware sensor sources. In use, so I've shared some of the use cases. What I'll show you in the middle is us sensing through the wall heart rate and breathing. So you can put our device on a wall. If you're military, police, fire, if someone's behind, either hiding or lying down, we can actually pick up the heart rate of the person moving. And if anyone wants to come and look at our heart rate system, you can come and see us today. And in terms of the low-cost development, if you don't want to use the home Wi-Fi router, you can actually grab on the right-hand side of this, the small $5 chip, which you can get on Lazada, on Amazon, put our firmware in it in about a minute, and suddenly you've got a smart system that will do 700 square meters for about $10 to $15. And we actually give the APIs open source for anyone to build their end use cases, deploy it into their product, and sell their software, whether it's agriculture, you could use it to read grape growth, you could use it to do warehouse intelligence, all sorts of use cases. So with that, please come and see us at the booth and we can tell you a lot more about this and show you how it works. So thank you, everyone.
Thank you so much, Ed, for that exciting sharing. Well, I can already imagine later on at the booth, we'll see a lot of them gathering just to measure and you actually try out the devices over there. I'm sure we're all curious. Okay, next up, we actually have Equity Development Group. If we would actually just put our hands together to welcome a lovely Melissa Fisher, founder and managing director, to the stage. Ladies and gentlemen, Miss Melissa.
Hi, thanks everyone. I've got to say a big thank you to Steve and the team for organising this. Always an amazing opportunity, so thanks guys. I want to talk a little bit about a project that we have had underway for a short period of time now. I'm not going to talk too much about us as an organisation. What I will say is it's not all me. I have an amazing team around me. On the platform, we've put all our details. There's bios and stuff there. You can check it out. A lot of experience behind my team. I am always super, super grateful to them. Like I said, it's a very big team game, what we do. So, reimagine the gateway into the Yarra Valley. Has anyone heard of the Yarra Valley over here? We do provide wine globally. We have some very nice wines, but it's a whole lot more than that. And I want you to give consideration to the depth of history that some of these places have. So some of the things we do deliver is the arts. So Dame Nellie Melba was one of her father actually owned this property. They're very big in the area. She was Australia's most famous opera singer. We also have culture, which is the depth of wisdom that goes beyond many, many other places that we see around the world. A commodity came from this area, which still impacts our construction industry today and has for over 100 years. So the Yarra Valley actually has a whole lot more, including agriculture, whether it be viticulture. Cattle was what this farm was used for a long time. I can guarantee you if you eat meat, it's been on your plate at some point or another. So a lot of history in this property and the region. This is what I want you to give consideration to, because the value behind this and reimagining this is where we want to take it. So for us, what's really important is giving consideration to the environment. We work with the environment from start to finish, and we give consideration to sustainability at a core level. So everything we do starts off at a baseline, and the considerations we're giving are education, sustainability. We have aviation that we are dealing with, technology that we are dealing with, and well-being. And I say well-being quite specifically because we can often get confused between well-being and wellness. There is a huge impact in the wellness space at the moment, but we took it a step further and went, well-being is really important. This particular project is hospitality at its excellence. But what we want people to be able to experience is what life is actually all about when they allow themselves to let go of everything external and step back into nature, step back into themselves and allow themselves to experience what well-being is actually about. Who has a busy lifestyle? I am one of those, okay? So the luxury of being able to step out of it at times really demonstrates to you, A, what you're missing out on, and certainly where some of the stresses are. So working with technology is absolutely and utterly imperative. It is wisdom and technology as combined to overtake what was education and knowledge. Now, I'm very big on education, but not in its old form. I think when we start looking at generations, there is so much that the younger generation brings to the table, but notwithstanding the wisdom that our older generations have. So to be able to bring these two together and deliver a product that is the absolute extent that we can take well-being to, not today, but into the future. This is a product that we'll be delivering in 5 years' time. So we are not looking at what we need today. We're very much working with industry experts in delivering what is needed well into the future. Just a couple of shots here of some of the things that have been given a lot of consideration to. It is external, it is outside, it is feet on the ground again, it is working with sound, with vibration, and with nature at its absolute best. Has technology come in? Of course it has. We can't withstand technology these days. There is so much importance that technology is bringing to the table, and it should never be excluded, but it should never exclude the fact that Mother Nature is probably one of the biggest impacts that we're ever going to have the pleasure of experiencing. It takes courage to take it all on. It absolutely does. But to not is to the detriment of everybody. This is a project that has hit world class. We have every level of government that is backing the project, not just because of the project, because of the importance behind the industries that it impacts. So for us, it's never about delivering one project. And as I will show you in a little while, we have multiple projects that you will be able to have a look at. Every single one of them takes on well-being because it is important to every single human being that walks the face of this earth, right? And at a core level. It takes on sustainability from the very first step we take into it, giving consideration to how we do better, be better, individually and in everything that we absolutely do. Very important to me is education. We want to make sure that all of our projects deliver a level of education, not just in what we've produced, but within the project itself through all the training that we offer. and some of the technology that is used to ensure that it has longevity. Whilst we deliver this one, we have training centres that go with it that will encourage our staff to travel the world to other locations and hospitality venues that we partner with to ensure that they get the luxury of life and be able to deliver the expertise and the training that they will get along the way. So collaboration through nature, yes. Healing with light and sound, absolutely. And facilitating world-class immersions. So this project actually has the ability for world-class leaders to come out and deliver, facilitate at a venue that will be of a world-class level. So bigger picture, education, industry change. We are targeting quite a few industries in this. Aviation is one of them. There is an airport that sides this, giving people the opportunity to have an arrival experience that they deserve. It is not an international airport, but it does combine with local international airports to ensure that we are able to get people in with an experience that should be something that everyone is able to enjoy. Generational connections are very, very important. Well-being is the foundation at a very core level. Global impact, absolutely. Operators that collaborate. So the operating system around this project will not be the standard operating system with multiple operators per venue, per asset class. It will be an entity that ensures that everyone that plays a part in this operates and collaborates together for the greater good of everyone, ensuring that we have value and longevity in the overall project consistently, which means that the people that are going to do this are going to be leaders in their own right, and they're going to immerse into the change in the future of what is absolutely being delivered. Training, industry, this is a global level training organisation. We want to be able to encourage staff to travel the world, to experience different cultures, to be able to deliver that to their children, their families, as they move through their life. There should be no reason in this day and age while we are actually limited by any borders or boundaries. And this opportunity moulds the future. It will break the global barriers and it will incorporate global locations. Now, whilst there is an investment opportunity, we're looking for investment partners. We like to partner with people that have a passion in what they actually do and certainly in alignment with what we are doing. So the alignment that I would love to see is an alignment in well-being. Technology, absolutely, and education. Those are the things that at a core level are very, very important to us as an organisation, align with our values and certainly very important to me. There is a short-term, long-term investment opportunity in this. Short-term horizon is 2 years and it offers a 15% per annum coupon year on year with an exit strategy at the 2-year mark with the uplift that's been created off the rezone and the permits. The long-term horizon is 5 years for completion, and that also has an opportunity of equity or ownership, but that is something that you'd need to come and have a discussion with us about. Very quickly, these will be up on the platform. You'll be able to have a look at these projects. Again, they deliver the same thing. They are wellness, they have environmental impact in each and every one of them, and again, investment opportunities. Our contact details for you, if you scan the QR code, that'll take you straight through to our website. It'll give bios on my team, a whole lot more information, and you will be able to get my details, and our CFO, Nadine, will be able to talk through any of the details on this. Thank you very much.
Thank you so much, Melissa. Those were really beautiful, and I believe this is well-being, and both well-being and wellness is something that all of us can relate, especially in this day and age. All right, without further ado, I think we're gonna take a little change up in the segment. We're actually gonna do a panel discussion, one that generates significant interest to many of us. That is a panel discussion on crypto investment trends. So today we do have a very esteemed panel of speakers with us. If we may, ladies and gentlemen, to put our hands together to welcome the 4 of them. So let me introduce one by one the panel experts. We have first Mr. Lim Huijie, CEO and founder of Vision Group. Ladies and gentlemen, a round of applause to welcome our first panel of experts. We also have Ms. Sabrina Tagian, Director of FinTech and Payments at HBAR Foundation. We also have Mr. Hayden Hughes, General Partner of Tokenized Capital. Last but not least, ladies and gentlemen, Ms. Gracie Lin, CEO of OKX Singapore. Once again, a very warm welcome to all our panel of experts. We can put a warm round of applause for all of them here. Thank you so much for being with us today, panel. And we will actually pass the time over to you. The microphones are just in front, so feel free to. Thank you.
Great, so we'll jump right into the crypto panel right now. And before I start, I'd like the panelists to do a quick introduction about themselves and the organization they're with.
Thanks, YJ. So I'm Sabrina. I'm with the HBAR Foundation. So the HBAR Foundation is the foundation that grows the ecosystem for the Hedera protocol. Has anybody, just quick show of hands, anybody in the room heard about Hedera before? Okay, not that many. So we're layer one, decentralized ledger technology. Okay, next on to you, Hayden.
Okay, thank you. HBAR is amazing, by the way, as is OKX. So just a quick thumbs up. And Huijie is also great. Hi, I'm Hayden. I'm the GP at Tokenized Capital. We are a venture firm intersecting in investing in blockchain technology. Really interested in the Solana blockchain. There are different layers of that chain. At the top, we have application and then scaling and middleware and then the chain itself. So we see really exciting opportunities at each layer of that. A lot of really bad opportunities we're trying to stay away from and I think have been successful and good ones that we're chasing hard. So that's me. Thanks.
Hi everyone, I'm Gracie. I'm from OKX Singapore. It's a regulated crypto exchange here. We got our license in September last year and we've been building for the Singapore user. Very happy to be here. And thank you for the shout out.
Perfect, great. So we'll be jumping right into questions really quickly. And right now, I think we'll be looking very much excited into crypto space, especially what happened last year after Mr. Trump got elected and the entire space been moving very quickly as well and growing very significantly in the areas of Bitcoin of the likes. So our first question really revolves around how has the landscape for crypto evolved since 2018? Where do you see the opportunities today? And whether is it approaching from an institutional or a family office or from a high net worth perspective, what's your view very much from the trends from then till now? And this open up to the whole panel.
Okay, I guess I'll start. So I went over my intro pretty quickly, but I've been in this space since 2018. So first as an investor, as a corporate VC, so doing more venture. So I think I can speak to the venture opportunities. Right now, we operate at the foundation, we operate a grant program, but there's also a lot of things in common with venture investments and I also invest on the side. So maybe I will let Gracie and Hayden discuss the more trading related opportunities. But in terms of venture, it's definitely changed a lot in the past few years. It's gotten more mature. I think when I entered that space, we were one of the first corporates to be able to invest in tokens. I remember at the time also, custody wasn't even a very mature field. So, you know, like how do you manage the tokens? Like that, this was like a question that came back. And of course, since then, like many custodians that are institutional grade, there's like multi-sig, there's a lot of more sophisticated ways to handle the custody of digital assets. So that's kind of taken care of. The opportunities that were back in 2018, 19, there were, you know, of course, a lot of ICOs at the time. So, you know, you had to dodge a few bullets there. And I guess in crypto, there's always bullets to dodge because it's a very narrative based environment. And it changes very quickly. So it's very difficult, I think, for an investor to adapt and to catch the waves before they actually collapse. It's also a very cyclical market. So it's not so much about investing in the right thing, but also investing in the right thing at the right time. So typically crypto markets are on like a 4-year cycle. And your exits will be in tokens, so that's a different exit profile as well. You typically will have, if you're investing in venture, you will get tokens into the project, maybe sometimes tokens and equity, and then you'll have a vesting schedule, right? So you have to also be able to time your exits well, and that's one of the challenges, but also an opportunity because you do get your exits faster than you do with equity. Back in in the early days of when I was investing, there were a lot of layer ones popping up. So those did pretty well, right? And then after that, so more layer ones, layer twos, a lot of scaling layers. So infrastructure-wise, I think there is still actually a lot to build, but there's definitely a multiplication and a fragmentation over the different layers. So then there's interoperability solutions, and it's becoming an increasingly complex and fragmented market, I would say. I see now a lot more opportunity also at the intersection between TradFi and crypto assets, but then I'll go into that maybe a little bit later. But yeah, this has been like kind of the evolution that I've seen over the past few years. It's been super interesting. And it's maturing, but also there's a fragmentation that also makes it, I would say, a bit complex for an institutional investor, but institutional adoption has gone up. You see ETFs now, so even if you don't know how to handle crypto, then you're able to get some exposure as well.
I'll just add a quick comment. So first off, I agree with everything Sabrina has said, and we've been in the industry, I guess, about the same time. So everything she said is spot on. I'll just go big picture and small picture. So what we've seen in let's say the previous 8 years prior to today, we've seen 4-year cycles where basically everything goes up. That has been upended this past 2.5 to 3 years by just having certain sectors of the market that rotate upwards, and everything else has basically stayed flat. That, I think, is a reflection of the fact that the liquidity has flown mainly into Bitcoin via these ETFs. On the venture side, I talked about and Sabrina has talked about the different layers. So the application layer is on the top, the infra layer is quite close to the bottom. When you think about the billion-dollar outcomes in venture, crypto venture, I think that those really in the past have only come from the chains themselves, so the layer ones, and exchanges like our friends at OKX and others. There was one quite famous one that went under a few years ago. So those are kind of the two ends of the barbell that I see in terms of the massive outcomes. But there's a ton of infrastructure that's now popping up at the infrastructure layer and at the middleware layer that allows the existing ecosystem to scale and grow. So projects that are building real businesses, not just a crazy get-rich-quick launch a token scheme that just happen to be using blockchain as the rails. So projects like Solana Sim issuing international SIM cards using the Solana chain, Akka Finance using AI to automate how people do crypto trading. So there's a lot there. I'm excited about the future, but definitely much harder than it was a few years ago.
Well, Sabrina and Hayden have already shared so many gems that I think for me it's just, I'll just add to a point that Sabrina mentioned just now about custody. And not specific to custody, but I do feel like there's been a lot of innovation in integrating, I think particularly in integrating TradFi with crypto firms and crypto companies. And that's where we see some of the opportunity coming up. So just to name a few things, we now have fiat on and off ramps, we have custody solutions, mirroring, and this I think is actually quite important in bridging the two, right? The innovative space as well as the traditional space, and making sure that the flows are going through both ways and people have the tools they need to manage their risk, to onboard, and to do what they're used to doing in other traditional assets. So I think that's kind of where we see the greatest potential. And we have seen interest from institutions, from high net worth investors. So we believe that's going in the right direction, and we think there's going to be a lot more happening in this area.
Yeah, and we probably want to deep dive into this very much as a follow-up question. And Sabrina talked about a lot of bullets to dodge. And in the space, we talk about 4-year cycles of the likes. Starting very much from Gracie and moving towards Sabrina. Maybe we can deep dive a bit into questions and say, what's the more recent trend recently? And how would some of the investors better identify, in your opinion, what would be a hype versus a more longer-term sustainable type of thing to look for within the space?
I think the investors on this panel are going to be a lot more qualified than I am to comment on that. I do think that the industry is more mature now. And the reason you're even asking that question is because there is still a lot of doubt, a lot of concern, a lot of skepticism maybe about all the different things that are coming out from the space and which areas are worth investing into and which areas you might want to steer clear of, at least for a bit, before things settle down. So I'm not going to try and make that recommendation. I'll leave it to the more qualified panelists to do that. But what I would say is that I do believe that because regulation has come in and at least for certain parts of the space, that really helps us. I believe the regulators are trying to get ahead of the innovation that's there. They're trying to figure out which areas are worth allowing to flourish and which areas they want to manage the risk more closely. And so I think that protects investors in the longer run. Obviously, there's still a lot of room to go, but we will watch what the regulators are doing and what they're saying to us. I believe that is actually a good sign of figuring out which areas are a little bit safer, which areas are a little bit more long-term in nature. The regulator coming in and providing that clarity on what the rules are for that space, those are the areas where we believe there will be long-term potential, and you might want to be looking into those spaces.
Yeah, thank you, Gracie. I think just to go back to first principles, the way that I think about blockchains is that they are ecosystems. So we're all probably familiar with Ethereum and the idea that there are smart contracts, we can build things on top of the Ethereum blockchain. So really what we're talking about, to use the language of non-crypto folks, is you're thinking about, let's say, the Apple App Store versus the Google Play Store and a bunch of different spin-offs of each of those. And so if you think about where the value is accruing in terms of those biggest app stores, which in this case I'll say are blockchains, each of those blockchains have needs for, there is an exchange that's going to be primarily focused on one blockchain. There's going to be borrowing and lending. There are different applications. So that's kind of how I think about it in terms of silos, differentiating the hype from the what's real. I mean, you can look at you can go on DeFi Llama or Token Terminal or just ask your sons, daughters, nieces, nephews how to figure this stuff out, where the adoption is happening. So you can see, unlike in 2018 when we really only had Twitter, there's websites like Token Terminal, DeFi Llama, many others that allow you to see the number of users, the number of wallets, the number of transactions, the number of fees, the amount of revenue. This idea of the price to fees ratio now allows us to value a blockchain, and the idea that we have in investment banking of comps is no longer impossible. That used to be an impossible thing for us to quantify. So I would say if you're thinking of investing in this space, look at the blockchains, see what activity is there. Typically, the further down the chain you go, the higher the valuation, the multiple. But that's kind of how I think about it.
Yeah, so maybe to back up a little bit on that. So I like the analogy. I use it myself also, the OS, the operating system analogy, where essentially your layer 1 protocol is going to be the operating system, and then you have decentralized apps that are built on top of that. So I think what Hayden's suggesting is you look at the whole ecosystem around one specific layer 1. So in our case, it would be Hedera, or it could be, another case could be Solana or Ripple. And you kind of value the whole ecosystem based on that. That means you would be investing in the underlying token for the layer 1 protocol. So Sol or HBAR or something else, XLM, you name it, XRP. So there's the layer 1 blockchain tokens, but then there's projects on top of that. They also have their own tokens, right? So you could also invest in those. Then you have to do your due diligence separately. You'd have to look at the team. Ideally, I would suggest looking at a team that's been doxed. In crypto speak, that means the members are public; they're not anonymous. You will want to do your due diligence on things like, has the code been audited? Because hacks are very notorious in crypto. And then so if it's a launch, and then you're coming in as a VC, then it's a different game versus if you're coming in as retail. Crypto projects do private sales. Then they typically do a pre-sale. And then eventually they will go on an exchange, for example, OKX, and then the token will list there. So at different stages, you'll have different conditions, right? Either public price or either a discounted private price that may come with lockups. So of course, know that if you're coming in as a retail, once the token is public, there are holders that, it's like an IPO essentially, there are holders that, have lockups and have a lower entry point. So that's kind of what you're up against, right, in terms of making your returns. I think you were asking about like some trends, right, in terms of what are the current narratives. So maybe I can run through some of these. And it's those investment trends they cycle pretty quickly, like 6 months to a year, I would say. Depends. For example, the real world asset tokenization trend, I think it's been going on and going up for several years because it's a very strong underlying, it's a shift. But there are shorter-lived trends like NFTs, for example. I'm sure you've all heard about NFTs, right? That was 2021, 2022, maybe. Until people figured out that utility wasn't really there, and it was more of a collectible play, and how many collectibles can you really do? More recently, there was a meme, I guess, narrative, and so a lot of people started buying meme coins. Again, and not a lot of substance behind the meme coins, right? It's about the community. Is the community strong? Will it sustain itself? It's kind of a subculture type thing, and kind of, I would say, at your own risk, right? With the meme coins, they're very speculative. And then there are more, I would say, use cases that are rooted in real world adoption. So DePIN is one of them. So that's essentially the intersection between IoT, the Internet of Things, and blockchain. And then there's another one, also the intersection between AI and blockchain. So now you start having agents that can trade on your behalf. So there's a lot of trading use case with AI and agents. So that's also very interesting. I think that has legs because you'll be able to automate things and get value out of it. So yeah, those are some areas that are hot these days.
So we deep dive a little bit into some individual questions to each of the different panelists, and we'll start with Hayden. As a general partner of tokenized capital, how do you approach portfolio allocation across your direct investments and trading, as well as your risk management strategies when you are implementing them to your portfolios?
Sure, great question. So I think, so we as a fund, we're 90% venture, 10% liquid. It was important for us to have that 10% because, and it's a bit of a weird structure. Usually you have one or the other completely. But in crypto, sometimes you have opportunities that are just too good not to take up. The market does tend to get overbought, and at which point, you want to sell, and sometimes it gets oversold. As it appears we're almost getting to now, not investment advice. But so I think valuing different platforms is very important. So I have 90% of the capital that we have is dedicated towards venture investing. Founders, and it's changed a lot over the years. In the old days, you would just give the founder money based on the pitch deck with nothing built. Now it's a lot more important to actually have a company and actually have traction. And I've been venture investing since long before I entered crypto, and the question it always comes back to is, if this founder is successful building whatever they're trying to build, what is the degree of behavior change required by the market, by ecosystem participants to justify that? You can have something that's life-changing and revolutionary, but if it requires people who are entrenched doing things a certain way to go through a very painful transition, it's generally not going to work, and we've seen lots of examples. So focusing on the founders that are solving a real problem, that have revenue, that again are docs that have been de-anonymized, has been very important. The 10% liquid is, I try to treat that as something that's very, very, like in case of emergencies. So in true, on March 2020 style of sell-offs, I would be wanting to sell and go quite long. So it's mainly just sitting there, not doing too much, for the most part, holding a little bit of assets. On the venture side, I think it's probably about a third allocated towards the layer 1 layer, a third towards the middleware and scaling layer, and a third towards the application layer. And as you move from the blockchain itself up towards the applications, the risk increases exponentially. So the return multiple you can expect from an application that does really well is way higher than the return multiple you can expect from an exchange that does well. Exchanges take a while, and the multiple might be 10. At an application level, it might be 100 or 200 or 500 or 1,000. So obviously sizing the bets and making sure that I can actually manage. Those are some of the principles that I think about.
Great, thank you. And moving forward over to OKX, Gracie. Given OKX global expansion and efforts to secure licenses in Singapore, Dubai, how do you anticipate regulatory frameworks influencing the development of digital assets and Web3 over the next couple of years?
That's a great question. Thank you. I mean, our experience. So for those of you who are not familiar with the journey for OKX, we have been spending the past 2 years, 3 years maybe, going to all the jurisdictions where we operate and understanding the regulatory regime framework there, understanding what it takes for us to be able to comply with those rules, and then doing what it takes to comply with those rules and to get licenses in these jurisdictions. So Singapore, as I mentioned just now, we got a license last year. There have been other jurisdictions across the world where we've done the same. And what we've noticed is that, and we expect this to continue, what we've noticed is that every regulator will have a different, I would say, risk appetite, and also maybe a slightly different objective in what areas of that space they want to encourage to continue growing, and which areas they might want to watch and see before going in and figuring out what they want to do about that. I won't go into specifics, but that's been the general trend, and we expect that to continue. But what we know for certain is that jurisdictions, regulators across jurisdictions are going to be looking very closely at what happens in this space and designing their rules to fit. So more tailoring that to fit what is coming out of this industry. And there's always a little bit of catch-up in the early phases of a new and emerging area, and that's what we're seeing. So there will be regulatory changes. For the jurisdictions where they haven't yet launched a framework, they will be launching those frameworks. For those that have already launched it, we expect to see a lot of refinement of that framework. And those are going to really determine how the sector evolves in each of these jurisdictions. So without going to specifics, that will define what market participants will see as opportunities in which jurisdictions, and maybe in some jurisdictions there will be more than others. So in Singapore, I think we've been very fortunate because the regulator has made very clear what the rules are, and they've also made it very clear that whether you are a crypto firm or you are a traditional institution looking to get into the space, the same rules apply. So that has, in my mind, I believe that has really created a lot of trust and a level playing field across both TradFi and crypto firms. And that's why in Singapore, we actually do see quite a lot of collaboration between the two. And in other jurisdictions where the regulators go down the same path, I expect to see the same as well.
And over to Sabrina, how's Hedera enabling real-world use cases in fintech and payments? And what impact does this have on institutional and retail adoption?
Thank you. So that's a big vertical for us, fintech and payments, and that's where I do most of my work. To back up a bit, Hedera is it's a layer 1 protocol that is very enterprise friendly. It's actually run by a governing council. So the node operation is permissioned. So we know exactly who the operators are. It's Google, IBM, about 30-something large enterprises and institutions. That allows us to really play in the fintech and payment space because when you are an institution and say you want to tokenize an asset, you're going to look at your risk management. You're going to see, okay, how does the technology have outages? So we are pretty much always up. Are the nodes, any nodes run in, say, a sanctioned country? So we can confidently say no because we know all the nodes. So things like that. So that's kind of an enabler. We have so strong compliance, friendliness. We're also able to do things like freeze an account or wipe a balance, so that's rare in a blockchain. So if you're an issuer and you want to have these administrative rights, and you can, we need the throughput also, especially for payments use cases, right? So we can do 3 to 5 seconds finality usually for a transaction, and up to 10,000 transactions per second. So that's kind of like the base that we're working on. And then in addition to that, specifically for payments, and also for asset tokenization, we've developed open source toolkits to enable builders and fintechs and institutions in particular to issue a stable coin. For example, we have Stablecoin Studio, which allows to at least has the blockchain infrastructure piece pretty much built and audited, including things like a proof of reserve and then the role management. And we've done the same for what we call real world assets, but so mainly for debt and equity. We have another toolkit called the Asset Tokenization Studio that has most of the smart contracts, the role management, and then a definition of the asset, definition of the jurisdiction as well. So that's allowing us to kind of support the growth of that ecosystem. We've supported a number of stable coins already, and then we have many more in the pipeline. As well as on the asset, the digital asset side, we've tokenized money markets from like Aberdeen, BlackRock, State Street, recently Fidelity, and such. And so it's going. I guess the flywheel has kind of started spinning for us, I would say.
Yep. So I think very much as a follow-up question to this, and we talk a little bit about TradeFi and of the likes as well. How do you see this very much integrating into the entire system? And how do you foresee this very much? What role will your organization play in this, and what will be the impact into the industry?
So I'm very much at the intersection between TradFi and blockchain. So I would say the first use case that kind of started touching TradFi is stablecoins. So stablecoins are essentially an on-chain representation of fiat. Usually it's a mix between collateral of fiat and then highly liquid assets like treasuries or money market funds. The initial use case for stables was really just, and they've been around forever, like maybe 2013 or 14, was trading in and out of crypto. And that was the first product market fit. But now actually stablecoins are going into the TradFi world, being accepted for payments, using for cross-border payments, FX, all these areas that have high fees and also friction. So that's a big one, and then and that's the beginning of the onboarding of capital markets on chain. And so started with stable coins, and then other assets like treasuries, money markets, and then real estate, everything. So yeah, it's kind of hard to cover it all, but that was kind of like the starting point.
Yeah, so I think that the TLDR here is that adoption is happening. These blockchains are being used by traditional market participants to put things on chain. Sabrina has talked a lot about RWAs. I think that's something that's very exciting and very clear. I think that what you'll start to see is a bit of a shift. I mean, there will be traditional use cases of blockchain technology where you might be dealing with a bank, or you might be dealing with a broker. You don't know you're using blockchain. And then there's going to be everything else. Within the crypto space, I think there will be a revaluation of a lot of these crazy, get-rich-quick tokens that'll go down, and the ones that comply with the laws will go up. So I'll just give a quick plug. So Sabrina is from HBAR. They are a home of innovators. So if you're innovating, you want to build some cool stuff, they're the ones to go to. OKX is the best exchange I've traded on, and they're open for business, and I'm here to invest in great assets, and we're open to talk to new investors as well. But I'll pause there and let, same question to Gracie? Okay.
I touched on this. Well, thank you so much for the plug. I touched on the TradFi integration earlier I think one of the earlier questions, and I mentioned specifically custody. I mentioned on-ramping. And I believe all of these are bringing us in a direction where eventually it's going to be seamless. And if you're an investor, I believe that's good news, where you don't have to think about. And just now, Hayden, you also mentioned, right? Sometimes you want to make sure that there isn't a big behavioral change required for people to adopt a new technology, a new asset class, or add something to their portfolio. And that's what some of these integrations aim to do. So if you're an investor, you can be holding your US treasuries or holding your fiat, and that can count towards collateral for your trades on an exchange when you're trading crypto. So all of these different areas where TradFi and crypto companies are working together really aim to make that experience seamless for investors. And that's where I think the biggest improvement from our perspective as an exchange is coming.
So time really flies, and we would end with a last question, which is if there's one key thing that each of the panelists would like to leave the audience with, what would you so-called give your take on to the rest of the audience here?
Okay, I'll start. So you can't ignore that this asset class is here to stay. And I'm not telling anyone that they should go, mortgage their house and chop off their left leg to put money into the space. But I would suggest respectfully that the correct allocation to this asset class is not zero. So how you do that and the way you do that and your outlook and your timeline, you can work on that and figure it out. But this is not something that you should have zero. That would be my message.
And I'm going to add that it's going to be so pervasive because that we're onboarding all the capital markets now, right? Eventually, even an asset that you used to buy off chain, you will be buying it on chain, maybe without even knowing. So to Gracie's point about the user experience, blockchain for the sake of blockchain is going to disappear. Like it's going to be under the hood, and no one's going to know that things are on chain even when they are.
I was also going to say crypto is here to stay, but you've already said that. So I'll add a little bit more. It's here to stay, and I do believe it's going to be growing in a more sustainable and responsible direction. So some of the horror stories of the past, I'm hoping were in the past, and this industry is evolving, and we see more and more trust, more and more security, more and more safety, more and more integration with the established players in every single market that we operate. So I think it's here to stay, and it's going to be growing in the right direction.
Perfect. Thank you very much to all expert panelists and the wonderful audience. Thank you. Thank you.
Thank you so much, our esteemed panelists. Could we just give a huge thank you and a really warm thank you for all of them, for all that super power charge session of our investment trends in crypto. Now, they will still be, if they are still around, do feel free to connect with them. And if not, we also have their contacts up there. You can just feel free to let us know if you'd like to connect or also to learn more about the session just now. Now, we know that we all, if you need a breather, if you need the washroom, it's just right outside. Just a little recap on this morning's session so far. We have had a few pitches from the companies. We have heard from EBR Systems, Equity Development, as well as P2P Group, which will all be exhibiting in the exhibition hall just across this room. Right, we also had our keynote sessions as well as our panel discussions on crypto trends. Also, we have right coming up next, just before lunch, we have 2 more segments. That will be our company pitch presentations, as well as 1 more keynote session later on. Now, ladies and gentlemen, if you would also just turn your attention to the company pitch presentations now, we have with us today Prime Financial, which is we have represented by Mr. Jason Shepherd here. Now, ladies and gentlemen, put your hands together to welcome Mr. Jason Shepherd, please.
Hi, everyone. 8 minutes is not a long period of time, so we're going to race through this. I won't even talk to you too much about who Altor is or who Prime Financial is. Harley Dalton's going to be doing that this afternoon in his broader speech. It is a pleasure to be here. My name is Jason Shepherd. I was also at the Sydney Emergence presentation, but the Singapore one is a little bit special for us guys because we get an opportunity to come up, to walk around, to meet our investor clients and associates in Singapore and talk about not just the things that, for example, that we'll be pitching today and that Harley is going to talk more about in detail, but to talk more about the things that are occupying our minds, excuse me, as a team, and to see their thoughts on various different things. And that's what I'd like to do here today with you. It's to engage with you and talk about the specialist disability accommodation as an investment tool. Can't do that, of course, without referencing the lawyers, and please feel free to read that in your own time. Social infrastructure, I'm sure a lot of you are aware what social infrastructure is. You see it. Obviously, we'll be talking in detail about the specialist disability sector. But it really encompasses a lot of different services that you typically see governments in a lot of jurisdictions provide. In Australia, that does include retirement accommodation, which I'm sure you'd all know about, but also, for example, defence servicemen housing. You're aware of hospitals and clinics, aged care and education. To dive a little more deeply into the specialist disability accommodation sector, I need to introduce to you another acronym, NDIS. It's unique to Australia, the National Disability Insurance Scheme. That scheme it's been around since about 2016. The government introduced that scheme to help people in need of high care receive their services and accommodation. The best way to understand that scheme is to really look at how many dollars are being spent. The numbers are there. For a start, about $100 billion Singapore we expect to be spent from the government in that sector over the next 5 years. The sector is servicing 500,000 individuals that need care, that need help. They need services and accommodation. And the people that need specialist accommodation, of that number, they're around 28,000. So that's a huge number when you think about the people who are out there at the moment who need care. They're not in this specialist accommodation at the moment. So you think, where are they? They're in homes for aged care homes. So imagine a 20-year-old person with a disability or a high care need. They would be in an aged person's home. Or they'd be at a home with their parents. Their parents may also be aging and in need of care themselves. So the government has introduced the NDIS plan, whereas traditionally they were funding direct services. Now they're funding dollars into the pockets of those individuals that need those services, and those individuals and their carers are spending those with appropriate counterparties. Those counterparties, obviously, on the property side of things, are building, managing, developing properties. As a result, we believe that the specialist disability accommodation space is a new and interesting investment space for investors. Just need to comment though, the government is often going to be providing the dollars to support the individuals, but the government does not guarantee investments in this space, and that's critical to know. So what does it mean in terms of SDA properties? Who are the players there? You just heard about the participants in that space. They're the people who get assessed by government as being high needs. And they need to pay rent for their services. Now, often that rent, more often than not, that rent is a higher level of rent than you would expect to be paid if you were the owner of a property, because the properties provide a higher level of utility for those people. The SDA operators are those charities, corporates, churches or church-related groups that are actually helping the people get into the homes, managing the homes, providing the services as well. They're the operators, they're key. Now the developers, and that's what we're interested in, the developers of the actual property, they're the people that, like in any property development situation, need to actually develop the properties themselves. Developers need funding, and that's where the investors come in, across the capital spectrum, which we'll talk to shortly. again, we're running through this discussion, but I did want to point out and say that these are normal-looking houses. On the outside there, they could be single dwellings, they could be multiple dwellings. More often than not, you would have a spare room within the house for the care provider. That may be a nurse. So on the outside, they just look like normal houses, which is important when you think of what is the long-term risk around the property. It's a normal property, I'll get to the difference in a second, that in the future will be valued just as normal properties are valued. They have land, they're in the right locations, and they have, you know, the appropriate quality of build. They could also be apartments. And again, they look like normal apartments, but they're just a little bit different in a couple of ways. That difference is pretty simple. It's the bathrooms may be more accessible. The shelves may be of different heights, the kitchen benches of different heights. And as I said before, there could be spare rooms for carers to stay in while they're providing the services. Just as with any property investment, there's multiple ways for investors to participate in that property, either in the senior secured or the provision of debt. And also you could, an investor could participate with a developer or builder in the equity of the underlying business. Again, as with normal properties, you can participate at different stages of that investment. The developer may come to you and seek capital to co-invest when they're in the pre-development phases. When they've got it, where they've found the property, they then need to get the approvals, they then need to arrange the takeout with the SDA providers for them to actually purchase the property moving forward. Or you could actually fund through, get involved in the property from day one, all the way through to when it's finished, and then earn the rental yield on the property over time. Multiple ways to get involved. I'm out of time, and I just did want to mention that Prime's reason for being in this space, we're not developers, although our team are drawn from developers. We're the people doing the one key word in that stack, and we do all of it. It's due diligence. We have the expertise to understand the developers, the quantity surveyors make sure that all of the numbers that the developers are saying they believe in, that we actually agree with those. And then eventually, before we take anything to our investor pool, it goes to our investor committee. So it's a very, very quick run through. It's an invitation, or I'm up here not really to pitch, I'm up here to invite you to come and chat to Harley and myself later. And we do look forward to having that conversation. Thank you very much.
Thank you so much, Jason. And as he shared, that is so true, actually. They're not here we don't have all the time, and that's why we're doing really sharp and short and concise. So we hope you get the gist of each of the presentations, enough to pique your interest so that you know exactly where to head to later on in the exhibition ballroom. All right? So without any further ado, we will have the next presentation as well. That will be by Good Earth Dairy, an agri-tech company leveraging innovative technology to commoditize camel milk for the global infant formula market. Ladies and gentlemen, please welcome Mr. Marcel Stezinger.
Good afternoon, everyone. It's great to be in Singapore. I spent a great part of my childhood here, and coming back feels a little bit like coming home. Before taking you through the Good Earth Dairy project, there are two things that I would like to take you through. One is around the infant formula market. The other one is around some fundamentals of milk chemistry to demonstrate the opportunity. So the global dairy industry is worth $1.35 trillion. 110 billion of that is in infant formula, which is expected to grow to approximately 240 billion in 2032. And a major stake of that is the Asia Pacific, having 68% of the market. And of course, China, with over 20 million births a year, taking $24 billion worth of that infant formula sector. Now, this is an important figure here for Australian producers. We have a strong relationship with China, and they have a huge value for our reputation, for the integrity and the high quality of our powder for infant formula. Now to the market gap. The biggest misinformation globally about dairy is I cannot tolerate dairy, therefore I must be lactose intolerant. That's actually false. The biggest intolerance to dairy actually comes from a component within the whey protein of all ruminant milks, including cow milk, which is called beta-lactoglobulin. It's in the whey protein, and it's actually the most prevalent allergen in infant formula. Also, when you give your infant formula to the child, whether it's initially because the mother can't breastfeed or during the interface prior to solids, the milk looks beautiful in the bottle, nice and liquid, and you think, that's it, I'm putting it into my child, he or she is going to be very happy. However, it will hard coagulate in the gut of the infant. Not such an issue if they're 2-year-old plus, but the younger infants will struggle more with the digestibility of the cow milk. Now, just a quick comment on the allergen. There is no cure to the allergen, and it creates inflammation in the child. Now, the solution that the infant formula sector has created for the allergen in the milk is to hydrolyze the milk. It heavily denatures the proteins. It also significantly bitters the flavor. And a lot of infants, even though they have no real choice but to consume it, they still struggle with the feeding, and there's still all sorts of issues in obtaining that infant formula. Now, despite all this, the market is expected to grow from $17 billion to $27 billion to 2032. Now, what are some of the alternatives to cow milk? You've got plant-based, very, very small market. Most of the world does have clear that it's not recommended for any child 6 months or younger. A lot of derivatives in animal milk are just not available in plant-based. And again, it impacts during the process of the actual powder. Soy protein mimics estrogen. There's many reasons why it is just not suitable for infant formula. The other alternative at the moment to cow milk that has had unbelievable growth, especially in China and especially through infant formula, is goat milk. Now, goat milk is molecularly closer to the human breast milk. It has smaller molecules. It's got smaller chains. I don't know if they've done enough marketing, but at the same time, I don't know if they've required to, because it's selling through, especially in places like China. However, it still has that beta-lactoglobulin, it still has that allergen, it still hard coagulates in the gut, and goat milk more than cow milk. Not a great flavor, some resistance in feeding as well. The solution, camel milk. Even though we've had it for thousands of years, the chemistry of the milk has not been well known. Here at Good Earth Dairy at Western Australia, we've been leading the research on that process. It is the only animal milk without that key allergen, that beta-lactoglobulin, and it is recognized as the most hyperallergenic milk for humans. It does not hard coagulate, which is why there's not a lot of cheese made out of camel milk. It also has a neutral flavor, which will eliminate any of that food resistance. On top of that, of course, you've got the molecular structure, the whey casein ratio. There's a lot more to go on about, but the chains, everything makes it more digestible and a superior product from a chemistry perspective as an infant formula. It's also naturally richer in micronutrients for immunity, for our cognitive development, and musculoskeletal process. That brings me into Good Earth Dairy. So located about an hour and a half north of Perth, we've been developing technology with $9 million to be the lead producer of camel milk powder. Now, we've got 2,000 acres just off a town called Jinjin, where we've set up a pilot facility. So Western Australia is a mining town. That's my background, BHP, as a chemical engineer and business improvement. We've been developing, as you would a mining facility when you find an ore body in the ground, the technological capability from harnessing the animals all the way to the powder facility that will give us core capabilities and advantages to scale efficiently. Scaling is a huge cost if not done well, but also in producing the milk and the powder at a superior price point. Now, strategically, huge advantages in Australia over other parts of the world. We've been very fortunate to receive a significant number of camels about 150 years ago, which have just grown and populated Australia since there was no predator and no disease. A lot of the camels that arrived in Australia came without any disease. As a result, there are many diseases that exist outside of Australia with camels that we just do not have, including a lot of parasites. On top of that, we have the right climate in WA. We've got access to cheap feed, cheap water, and of course our technology to be able to grow very quickly. What we've developed will be a niche dairy, each that will be capable of 3 million litres per annum to process the initial step for the powder facility. Now, you're only as good as your people. We've got capabilities, this is just around on the board level, but from execution to board, with capabilities down to the camel management, all the way down to having the ex-marketing director of Peters & Browns, which is the most successful dairy company out of Western Australia, who put connoisseur ice cream on the business class of Qantas as a positioning in the market, and has brought his capability into the project. Conscious of the time, just as a side note, the fresh produce is a huge opportunity as well as you're scaling up for your powder production. Even though cheese is more complex to produce, we have developed the technology to do that, to provide 6 months shelf life. Some gelato and kefirs as well, which if you consume them, you think you're having cow. This is an important factor, that it is aligned to the Western palate. You have our products, you think you're having cow milk products. However, they don't have the allergen, have a lot of that micronutrients, a lot of the peptides that help our immune system, and provide us a huge opportunity as well for the growth. Now, try and rush through the last slides. Our project is an $18 million project. It has backing by the West Australian government to the tune of just shy of $4 million, recognizing our credibility, our capability, and our integrity. This had a Deloitte's due diligence done on it to demonstrate the capacity of the business and the project. It'll be the first infant formula facility in Western Australia, and it will have a capability of $72 million in terms of a first step in our project and intention to grow. We don't only want to have our own infant formula tin and brand, but we also want to be the producer and supplier of powder for other infant formula companies. Now, I don't know how many people here in the room are familiar with the A2 company, but they've had tremendous success, and they're purely on the fact that there is a, not whey, but the casein protein, that there's one variable that's not there that's more inflammatory. However, the most inflammatory component in cow milk is the whey protein, the beta-lactoglobulin. It's still there, it still has it. It also still hard coagulates in the gut. But they've done incredibly well. Why? Great marketing, great market awareness. You know, you have to put the hat out to them. They've done a fantastic job. And as a result, they're already selling over $500 million worth of powder into China and are a leading brand in China already, purely on this micro point of difference. So camel milk chemistry gives you a macro point of difference in so many levels. And there is an unmet at the moment with half the children who consume hydrolyzed milk still struggle to consume it. We're seeking $50 million. We've raised over $10 million historically. And we're seeking $50 million to execute this project through institutional investors as a debt equity mix to build this initial first facility. We're targeting a return on investment of 29% as the first stepping point in this project, which can become a future Fonterra, which are a large cow milk powder producer for other companies. Thank you all for your attention, and hopefully I get to see some of you at the lunch break.
Now, maybe I'll just take this chance to ask a quick question that might be on our minds. If we visit the booth later, do we get a taster of camel's milk later? I'm sure that was on some of our minds, right, Masa? Okay, it's interesting as we're approaching to lunch. Thank you all so much for hanging in there. I'm sure we are all, in the midst of this. It's been actually about 2 hours into our sessions. I'm sure we've been very equipped thus far. And as we are approaching lunch, it's interesting that our next company pitch is also in the area of F&B, the food and beverage industry. We have Old Quarter Coffee Merchants. They operate within the specialty coffee industry, focusing on ethically sourcing and roasting 100% Southeast Asian green beans. Ladies and gentlemen, please welcome Amelia Hicks.
She gave so much away about my business. I was going to lead with something else. Okay, thank you all so much for having me. I know that many of you here are interested in investing in real estate, tech, crypto, but I'm hoping that this little passionate presentation might convince some of you to diversify that portfolio and invest in one of the best bets that you will ever make, coffee. So I want to introduce you to our company and the opportunity to invest. We have a first mover advantage and a completely niche product in an explosive market. Coffee really is the world's favorite beverage, and yet we do have serious issues in the supply chain. So in the global supply chain, consumers continue to increasingly demand traceability, and yet most coffee companies are unable to deliver that. And then on the other side of the global supply chain, the farmers, these amazing people who grow this incredible product, they also lack the stability, the pricing, and the long-term relationships that they need to build sustainable businesses. A few problems. So, oh gosh, the clicker people. All right, stay with me. But we actually go direct. So we cut out the middleman and we build these long-term trusted relationships with farmers. At Old Quarter, we source 100% of our beans, so directly from smallholder, mostly ethnic minority farmers in Southeast Asia, or Asia now, across 7 unique countries. So this amazing vertically integrated supply chain, it ensures that everybody wins. So the consumers that I was talking about, they get the traceability to the producer, and importantly, they get to feel as though there's kind of a part of a community, a part of something bigger. Most people are drinking 1, 2, 3 coffees every single day, and they get to, realize that this ritual that they're doing every day is actually making people's lives better. So consumers are stoked. Farmers, they get the better pricing, they get long-term buys and the stability that they need to thrive. But Old Quarter, we get an incredible competitive advantage. We get the better coffee at the better prices, but also an authentic brand story that truly is real to us, but it capitalizes on that consumer trend for social impact. So excitingly, it also, this beautiful supply chain that we've spent 8 years building, we get a world-first product. We have an exclusive product range that you cannot find across Asia or Australia. We have been pioneering Asian specialty coffee in the market, and we have an 8-year head start on our competitors. Cool, so before I go on, I'll introduce myself. I'm CEO and co-founder of Old Quarter Coffee Merchants. Oh, this side of the room gets neglected, don't you? So my co-founder and my partner, Yos, and I, we lived and worked in Asia for, upwards of a decade, and it changed us. It changed the trajectory of our lives and the people that we became, and we just fell in love with the region. And when we fell in love with coffee, we spent time at the farm level and we firsthand experienced the challenges that farmers face. And we were driven to start a business that would solve that problem and ultimately give back to the people and the places that had truly shaped us and given us so much. So in 2017, Old Quarter Coffee began. And we have a great track record of growth. So 10 times the industry average growth rate in the Australian market. We grew from 700 kilos, like one little pallet of coffee, to 45 tons in our 300 square meter warehouse. We also generated $1.23 million worth of additional revenue for smallholder ethnic minority farmers, something that we are so proud to have done. And our wholesale and online and cafe business is also thriving. So 46% average year-on-year growth rate, and our cafes are so successful, they're profitable very fast, within 5 months. So as I mentioned, I'm speeding a little bit, I know, but it's because I've got a lot to say and they only gave me 8 minutes, but bear with me. In Australia, so we operate, as I mentioned, from farm all the way to consumer. We import directly and then we roast that coffee ourselves. We sell that roasted coffee to 4 of our own cafes. We operate in the fastest growing part of Australia, the Gold Coast and Byron Bay, one of the most visited parts of Australia. We supply to 40 plus wholesale customers and a thriving online business. Some very, very healthy margins across every channel, so please take note of that. So what is the competitive advantage that really sets Old Quarter apart? it really is the trust in the supply chain. We've built it at every single step. So amazing social proof. We've got 5-star reviews across every single venue. We've also never lost a wholesale customer to a competitor. So complete loyalty there. But importantly, it's also the reason why we've had incredible price stability in our supply chain. So our competitors experienced up to 40% increase in their prices from 23 to 24, and we experienced just 1%. Actually, this year is worse for people, but I don't have the data. Again, old quarter, we have not had those increases. So that trust that we have built in the supply chain, it insulated us from the global chaos. And our competitors right now have quality issues, supply disruptions, but we don't have any. Okay, so I told you a little bit about us, and I will just quickly talk to you about this exciting investment opportunity. We are offering a very unique opportunity to join us before our valuation increases. We've been laying the groundwork and the foundations for scale in Australia, but now we are looking to go and expand into Asia, which I'll share a little bit more about. We're in a safe note round, so this is a very exciting time to join us before we get to our Series A, which is coming very soon. Okay, so what exactly is the investment opportunity at hand? We're raising $1.5 million in a safe note. We've already raised 425,000. This is AUD, guys. This is a bargain for anyone that operates in Singaporean dollars or US. We're offering a ceiling cap valuation of 7.5 million or a 20% discount on the next price round. Just briefly, we're going to use those funds. We're going to go from 4 to 6 profitable venues. We're going to invest in enough green bean for the rapid scale. We're going to 3 times our production capacity. That's lead to efficiencies and just keep dialing up the quality of the product. And we'll also invest in marketing and business development because we just want to rapidly increase the customer acquisition and we keep building that brand awareness. Yeah, we've been growing at a super tidy CAGR of 27%, but we're going to ratchet that up and just keep on the growth, the revenue, the profitability. So this is about taking the Australian business to the next level before we go to the Asian expansion. So this is like basically the last slide, and this I would have to say is the most exciting, so do stay with me. Our first step is going to be Laos. We have already got a joint venture partner that we've been working with and is trusted to us. We've already found a 200-hectare farm site that's capable of producing 1,200 tonne of coffee annually. And we will, as well as setting up our own specialty coffee farm, be setting up an export base. So that's going to allow us to distribute or export coffee back to ourselves in Australia, which is amazing, but also export to waiting customers that we have developed relationships with over the past 8 years in the Middle East, in China, in Europe, and America. So there is a lot of demand for Lao coffee at the moment. We will also have our first, but definitely not our last, old quarter venue in Asia. So we will start with Lao, but we do have partners that we're talking to at the moment who would like to take our venue model to Vietnam, one of the fastest growing economies and actually the place where Old Quarter is named after. So pretty full circle to get back there. This joint venture is the start of Old Quarter becoming the global brand that we have been dreaming it would be for the past 8 years. The joint venture alone has predicted revenues of 19 million, but that doesn't include what's happening in Vietnam and our plans for growth around the venues. The demand for coffee is not going away, and we are very uniquely poised to take advantage of that. We're just using the experience and the knowledge and the relationships that we have to do what we already know works. So, okay, why invest in Old Quarter Coffee? My co-founder's down the back there, the guy I run the business with. We're very committed and passionate and driven founders, as excited about this journey as we were the day that we started. We have a proven track record for growth, and we have an incredible product range. I know people don't believe it, but Google it. You won't find anyone that has that quality from these countries in the market. We also have those loyal business relationships at every single part of the supply chain, and global expansion plans like very much ready to execute. And I will say it again, discount on the Series A, so much, very much a good time to join us. I hope that I can meet more of you today. We've got a booth, and I'm available for interviews today and tomorrow before we fly to Vietnam. So thank you so much.
Thank you so much, Amelia, for that very passionate sharing. I think besides the passion in the sharing is also the passion for coffee. I believe all of us here share. Just to share a funny incident, and she's right, this side is a little neglected. So just a little incident before we started just now. One of the exhibitors was asking for coffee, and we said like, oh no, we haven't started the refreshments yet. You might want to check, you know, you might want to check your coffee merchant out because they're just right across the booths and they might have coffee. So we look forward to that and to having any talks with you as well. Yes, so we are actually down to our last company pitch, that's Bingo Tech. Bingo Tech is actually a Spotify-style marketplace for last-mile electric fleet needs. Right, ladies and gentlemen, we put our hands together to welcome our very last company pitch sharing by Daniel Huang.
All right, thank you for hosting our company. My name is Daniel Huang, and I'm the CEO and founder for Bingo Tech. Today, I'm very excited to introduce you to Bingo, a revolutionary solutions that is electrifying and reimagining the commercial fleet solutions for the entire global market. So I would like to get started by showing you a few highlights for the company. We are the world's first company that has a one battery swap fits all 2, 3, 4-wheel electric vehicle solutions company. Last year, we booked revenue of $1.8 million, and we expected to hit 3 times of growth this year and 15 times growth by 2026. We have been deploying our product and service in 7 countries in the world and expand to more. And it's approved by one of the largest platform company in the world. Our ERP software managing vehicles and batteries and drivers and charging stations, swapping stations, and all aspects of business of fleet operating partners. And we're excited to launch our first AI agent for fleet management later this year. And we have also been approved and committed by customers to launch a 4-wheel electric 350-kilometer super long-range lightweight electric vehicle systems later this year. So that's a little bit of the company. So the last mile delivery market is massive. It's a $160 billion a year business and expected to grow 10% per year in the next 10 years. But you know, many players are looking to actually electrify their fleet. However, they're struggling to a lot of challenge when it comes to converting and upgrading their ICE combustion engine motorcycles or electric cars to commercial fleets. It's unlike consumer electric vehicles that, you know, the revolution's everywhere. Commercial fleets are falling behind because there's so many challenges are facing this industry. Their last mile commercial fleets, they're very expensive to develop product and takes way too long for many of the operating partners. There's no complete systems. When they identify some products like motorcycles and EVs, and they still need to find batteries and, you know, charging stations and swapping stations, and they don't just work simply together. And of course, range anxiety. How do they manage, you know, when do they charge and how and where to charge the vehicle? And finally, there's no intelligent software that can manage not only the physical assets, but also the people, the business, the insurance, and everything together as a package. Bingo's solutions is as comprehensive as it is innovative. So we offer a hardware plus ERP software system all together. Our solution doesn't require any operating partners to have upfront development costs or time. And no existing charging infrastructures are required. And we offer a versatile range of 2, 3, 4-wheel electric vehicles options, plus all the batteries and charging stations and charging sized equipments together, and all paired by a turnkey AI-powered business software platform that help the fleet operating partners to manage their business. That's our solutions. So rather than just talk about the products, I would like to play a video and show you how everything comes together. So one swap fits all. That's what we do. So our business model is designed for a truly global, sustainable, and scalable growth. We handpick and tune a lot of hardwares together: batteries, vehicles, charging stations, swapping stations, and we offer our products to customers in many countries, and makes about 20% margin for the hardware sales. And all complemented by a monthly subscription service to our software, where we charge per vehicle per month base for them to use our software to manage all assets plus their business. And in addition, we also have add-on software services that we offer, like onboarding and future advertisement, transactional-based kind of e-commerce store fees and things like that. So we call it a Shopify-style solution for electric fleet operators. That's our business model. And I would like to show you the kind of growth trends on how many devices we've been managing on our platform in the past couple of years, and also what we're projecting for the next couple of years. So this is the world map, and these are the countries that we already deploy our products and service to. And these are the areas that we're planning to deploy the product and service in the next couple of years. And these are the typical customers that we're dealing with, and then with the typical hardware product that you can see. And in 2003, 2 years ago, our platform managed about 2,000 connected devices, battery stations and vehicles. And by the end of last year, our system was managing about 6,000 devices. And we're on track, this year, end of 2025, to manage over 57,000 devices. And by next year, we project going to manage 123,000 devices. And it's a huge market, for this entire electrification for the commercial fleets. We did about 1.8 million, and last year about 8 million this year, and projecting to grow to 28 and 60 in the next couple of years. And based on the many feedbacks from our customers, that we're just scratching the surface, and people are just loving our solutions. And so what's unique about Bingo is, first of all, we have the expertise that we have managed over 50 cities, millions of battery swaps in the past. And we have a software-defined vehicles and platforms that 3 years in the makings, that our customers just loving it. And we have many partners in electric vehicle OEMs that we already sign up and tune our system with. And of course, we have a very experienced team and managing, not only the products, but also the sales and marketings. And on top of that, of course, we have a solid customer order pipeline and new product pipelines including AI, new EVs, and blockchain-enabled fintech. Let's talk a little bit about the team. We have about 30, actually more than 30 people across the United States and China, and more than 60% of them are R&D. A little bit about myself. I in the early days of my career, I took a company public in Shenzhen, China. Today, the company is a $2 billion business. And after that, I founded a company in California called Mophie, one of the first portable power bank companies in the world, supplying to Apple and many telecom companies. I sold that company to NASDAQ, trading companies in 2014, and founded the current companies. And we have a team that just have a lot of experience in mobility space and then also the last mile delivery space that can really execute. And of course, we're raising capital. We already raised about $2 million last year, from institutional funds, and we're looking to raise another $2 to $3 million in the form of convertible note, and prepare and getting ready to raise our Series A round later this year. We already have a global kind of partnerships with one of the largest companies in the world, and we're expecting to really have a pretty great opportunity in front of us. So I hope that you like what we're doing, and I hope some of you will join me on this exciting journey. So thank you.
Thank you so much, Daniel. We certainly love what you're doing. The video was really good. I think it really encapsulated fully what the company could do. And also right here, just before we break for lunch, ladies and gentlemen, we have our final keynote address by Mr. Harley Dalton on the intersection of advice, capital flows, and asset management. Right before we flow into that, later on, before the break, I will actually be recapping through the companies that pitched just now, so that you will have an idea of where you could build your connections with and to. All right, ladies and gentlemen, without further ado, let's welcome Mr. Harley Dalton, the Managing Director and Chairman of Prime Financial Group.
I've got the best slot today because lunch is next. Everybody's hungry, so everyone's alert and listening. Everyone agree with that? First of all, thanks to Wholesale Investor today for putting it together. You've done a fantastic job. I think we can all acknowledge that, so much appreciated. I'm going to talk a little bit about Prime Financial, if I can get the work. And then I'm going to talk about alternate assets and Altor Capital. And then I'm going to talk about our current opportunities, which is in the business of sport. I'm trying to move quickly because I know everyone wants to get to lunch break. So Prime is a listed company on the ASX. The ticker code is PFG. It's founded on the principles of connected advice and experience, and I'm going to talk a little bit about what that actually means inside our business. But we live and breathe it. We are a team of nearly 200 people now, actually, with a global footprint, sister offices in London, New York, offices in New York, all down the east coast of Australia. We have 4 service lines and a 26-year history. I'm going to talk a little bit about that history as well, and look at a pivot that we made 5 years ago. The business is ambitious. It is trying to grow its revenue by doubling it every 2 to 3 years, and it is a founder-led business with 20 business leaders inside it at the moment. I'm one of those business leaders that merged my business into Prime. When I say it's founder-led, the CEO of the business is a fellow named Simon Matter, whose family owns over 22% of the business. Now, those of you who have been investing for a long time understand how powerful it is having a founder-led business, because you run that business like you own that company, and you worry about your costs and you look at the bottom line all the time consistently. So who are our clients? I'm not going to talk about where our money comes from. I'm going to talk about our clients. We work in the self-managed super fund space. We work in the wealth space. We look after over 5,000 clients around Australia and Southeast Asia. We've helped over 2,000 businesses. We have assisted 1,000 clients in funding or innovation. We have a very strong R&D division based in Australia. We pick up a lot of clients out of the US that are in that process of looking for research and development assistance from the Australian government. If that's of interest, please come and see us afterwards as well. And we've taken 500 clients where we've transitioned. When I talk about transitioned, Steve Torso talked this morning a little bit about the transition of wealth that's happening in Australia, and it is real, and I think it's probably real all around the world. There is a massive need of businesses that are trying to understand if they don't sell internally because the kids aren't interested or don't have the capability, how do they actually monetize that asset? And a lot of them will miss that opportunity. So we spend a lot of our time in those businesses. Typically sub 200 million is our sweet spot. I said it's a fast growing business. You can see from 5 years ago, that top numbers there are half. So in Australia, our financial year ends in June 30. I know you guys are December 30. So that's for a half. Looking at the top right there, 70% of our income is reoccurring. That's a really powerful asset from an AAR perspective inside for a listed company. Our goal is to double from 26 million to 50 million on FY25, so that's 3 months away. We are on track and we will beat that number. And then we're going to look to double from 50 million to 100 million in the next 3 years. Part of that growth is going to come out of the sector I work in, which is in the wealth department. The other important thing that I think is important when you look at this business or you look at PFG as a listed company is it has a strong dividend policy. So I look at it and think, here's a business growing at greater than 20% per annum, but it's also paying you about 7.5% to hold it. It's not a bad bet. The business is broken up into 2 lines. It's got business segment and a wealth segment. Inside that, the business segment is the accounting and business area. We call it PABA. Okay, effectively, that's a lot of accountants that are looking after clients, but their clients are the ones that have the problem of succession planning in Australia. Capital and corporate, I've got a capital team based in Sydney, 12 members. They are my deal hunters in Australia. Deal flow comes to them. When they find a deal that we might like, it might get introduced internally to me on an optionality process around it. I work in the wealth segment as a fund manager. We are in the space of private equity, private credit, anything in that alternate space. We do a lot of work in the property space and we do a lot of work in sport. I'm going to talk about sport in a moment because it's pretty exciting. And we have a self-managed super fund department, which I'm not sure if everybody knows, but basically your pension plan, self-funded pension plan in Australia. So this is for the half year, 25%, just at the top left there, 25% increase in revenue for the half. And the bottom left is the EBITDA margin, 18%. That margin should expand as we get scale. We're in the scale business and we need to grow this business fast to get that increase margin. So now I'm going to talk about Altor Capital. So that's the alternate asset management division of Prime. I set up Altor Capital. I merged it into Prime 14 months ago. And I now run the alts part of the business for Prime Financial. So who's Altor Capital? I set it up 9 years ago. I was very fortunate that I could come into this industry and start with a clean set of paper after being a fund manager for nearly 30 years in Australia, or 16 years prior to that in Australian equities. I ran a multi-billion-dollar Australian equities portfolio, sold that business, took a year off, set up Altor, started with a clean piece of paper. What do I believe in? That with active management, I can generate excess returns. And when I say active management, we actively get involved with our businesses. We are not a passive investor. I want to be in the boardroom, on the board, or have observer rights to that business so I can keep it, effectively I'll look at it, so I want to make sure I can keep a control of what's happening inside those businesses and protect my own capital. So we invest alongside our clients. I think you would expect that. I have a highly experienced team. I'll talk about those guys in a minute. And I've got a 9-year track record in alts. So Altor means protection in Latin. I set the business up. When I started it was all my own capital. And what's the most important thing when you're investing money is protect your downside. That should be your starting point. So how do I protect my downside? This is in structuring. I've looked at this business and I've said, okay, how do we actually generate excess return? Look after my capital. Second thing is stick to your knitting. So I know that myself and my team cannot be experts in everything, and everybody in this room would have to agree with that. So find what you're good at and do more of it, and then follow a process. So if I follow a process, I can avoid errors, and if I identify an error, I can get it out of the portfolio. Makes common sense from an investment perspective. And then be patient. There's no quick wins. So find good sectors that have got tailwinds. We talk about tailwinds in our business. I want to invest in businesses that I think have got some strong tailwinds so I can get through a cycle when things don't work out. And there's always a cycle and there's always a problem in every business. So I've got a credit fund in the top left there. It lends money to corporates only, so it's got no property exposure. A little bit different to probably what a lot of people would have heard of in Singapore, with a lot of Australian fund managers coming up talking about property credit. This is a corporate credit only. So I lend money to businesses, but I want a first ranking security. So I act as the bank to those businesses. Businesses come to me because, like every business in the world, they have one problem: how do I grow? So I need growth capital in the form of either equity or debt. So my equity fund provides the equity piece. Depending on where valuations are in the cycle, you will find that when equity prices are down, people don't want to go and raise equity and get diluted, so they want some other form of access to capital, and they go to the debt side. My colleague here today, Jason Shepherd, spoke earlier about the Social Infrastructure Fund. I love that sector. I think it's fantastic because there's a massive shortage of capital in Australia into social infrastructure. The government can't afford to do it all. They're looking for private capital. They need people like us to deploy capital into the market. And you look at where we're running into the 2032 Olympics, provides an immense opportunity. Then we'll talk about sport and the sports and entertainment opportunities. That's my investment team. I'll probably just take note that most people are old. I think you want experience because at the end of the day, you're backing people. So let's talk about sport because it's a bit more interesting than talking about boring credit and private equity. Can I just get everyone to put up their hand? Anyone watch sport consistently? Play sport? Keep your hand up, play sport. Have kids that play sport? I don't believe not more people have got their hand up. Have you ever sat there and thought about the business of sport? It is a massive opportunity. It is huge. Bottom right, I've got a chart there that looks at a tracking index of the US called the Ross Arctis Sports Franchise Index. So sports investing in the US has beaten the S&P 500 for 25 years. In the middle bit there, Boston Celtics sold recently for $6.1 billion US. It's a baseball team. So no stadium, just the baseball team. $6 billion, basketball team. We'll put that business in the top 20 on the Singapore Exchange. Just to give you context, that's for a team, right? It's incredible. So why do we love sport? First of all, you get recurring revenues, just like Prime Financial. I love recurring revenues because you can get a great multiple on those. They're typically monopolistic, which means that they own the market. You cannot get into some of these schemes. You can't go and set up another Boston Celtics. It's nearly impossible. And they're uncorrelated from a risk-return perspective. So we'll talk about that in a moment as well. There's a typical graph you'd expect me to show with the increase in the value of those assets. But just take your eyes, please, to the top left and look at the different leagues there. So that's NBA, the basketball, American football, baseball, hockey. Second column, down years. Pretty impressive, isn't it, from a non-correlation perspective? That's why we love sport. That's my business partner in the left there, Ben Harrison, who's the CIO into the sports space. What we've found in sport in Australia is now we can actually, it has typically been the domain of billionaires only. It's now gone beyond that. We just talked about $6 billion for a team. So how do you access that? Well, that's people like ourselves who've got funds that can actually take positions into these businesses. We love basketball. We're doing some interesting work in cricket, taking cricket into out of Southeast Asia onto the east coast of America. That's some interesting conversations there. We've done work in both rugby codes in Australia, rugby league and rugby union. We just took a stake in the head co for motorsports V8 racing in Australia. Again, monopoly asset, very popular with F1. You guys that know the circus that's F1. Drive to Survive, the eyeballs now that are on that sector are fantastic. We've taken a position in sport and entertainment tech and managing the assets of those people that are in the sports industry and how we monetize those. And then recently we just bought out a National Basketball League team called the Jack Jumpers, which are based in Tasmania. So why would you buy a basketball team? Let's have a look at that. So when I think of a basketball team, I'm a money guy. I don't really care about basketball, netball, whatever you want to call it. It's about the operating business. So I'm not a fanboy. I'm looking at it as a business investment, not the emotion that gets involved in some of these people who invest into the sports space. Australian basketball is recognised as the second best league in the world. So we know that America's the greatest. Everyone knows that in basketball, they love it. But a lot of players are used as a feeder fund from the Australian basketball space into the US industry over there. There's strong financial regulation in the league. What I mean by that is with the JJs or the Jack Jumpers in Tasmania, no other team can come into Tasmania, so it's monopolistic again. I'm not competing with anybody. I own the basketball in Tasmania. And then if you look on the right-hand side, some of the stats there as well. So now 1.2 million people in Australia participate in basketball. I think the second stat there is most impressive. When I look at AFL, we'd all know brands like Collingwood and Essendon, I hope, or the Bulldogs. They are very big brands in Australia. Basketball has now overtaken AFL as the second most popular sport in Australia. And why is that? The last dot point there on the bottom right, 77% increase between 15 and 17. That's because mothers do not want their kids playing high contact sport from the brain damage, head impact. So let's talk again about JJs or the Jack Jumpers. I spoke earlier about one of my investment theses is always have a tailwind behind you. So I know that I've got the right sector. I know I've got a team that's got tailwinds behind it. I've bought a business. I haven't bought a basketball team. And we talk a lot about layering up all platforms in this space. So this is a platform play, and by that I mean I get multiple revenue lines and profit lines inside this business. I bought a basketball team, which is EBITDA positive. With it comes a women's license in Australia. That goes straight to the bottom line. Women's sport is where you're actually going to get the multiplier effect in this industry. I've got access to profitability out of the actual stadium. This team has been sold out for 4 years in a row. They've increased their tickets 7.5% per annum for the last 4 years, and there's a waiting list to try and get into the games. It's incredible. So it's a property play, it's an operating business, and I've got access to further property development side on that, so I get a high performance centre that I can build in Tasmania as well that comes with it. And number 4, interestingly for me, and what particularly gets me excited here is the push in this space into Southeast Asia. So there's 30 million people in Australia. I think there's 600 million in Southeast Asia. They're looking at the next expansion step being a basketball team coming in from Southeast Asia. I can't say much more about it, but you can imagine the impact on that to the bottom line of that franchise as a business when you get those eyeballs on it. And 5, it's a scarce asset. No one else is coming in to compete with me in this space. So I'm just going to summarise there when we talked about Prime Financial. So it's a listed company, PFG is the code, high growth business. I look at it and say, this business is growing. I wouldn't have sold my business to it if I didn't believe in the founder mentality attached to it. Growing at over 20% per annum, and you're getting paid a nice handsome dividend for that right to sit there. We have an asset management division, that's Altor. I'll lead that asset management division. We are specialists in the property space, we're specialists in sport, and we're specialists in corporate credit and private equity. Thank you very much for taking the time to listen to me this afternoon, heading into lunch. Jason and myself will be outside of the booth if you'd like to follow up with any questions, and thanks for the opportunity. I really appreciate it. Thanks.
I'd just like to add on to that. I think I'm standing in between them and lunch now. Right. Okay, I promise I'll make it quick. And we just want to do a refresher because we're all here about the connections. So let me just give a quick summary on the pitches that we've done, and then we can actually head over to lunch. So we've had besides Prime Financial, we also had EBR Systems, the world's first wireless PACE system for heart failure patients. P2P Group, the innovative connectivity solutions. Equity, development projects focus on innovative and sustainable real estate projects. Good Earth Dairy, eco-conscious brand promoting sustainable lifestyle product. And Old Quarter Coffee Merchants, specialty coffee roaster focused on quality and origin. Last but not least, we also had Bingo Tech, developing advanced electronic systems and components for electric vehicles. Now, these are just but a few companies that are here. So in the meantime, while you enjoy your lunch, do look out for these companies. We will have a few more after lunch as well, and another panel discussion. Ladies and gentlemen, enjoy your lunch. It is being served right in the room opposite, where you can network and visit the booths as well. We will be starting the next session in about an hour, so we'll see you later. Thank you so much.
Okay, so whilst we're waiting everyone to come back in, one of the questions we consistently get asked is, how do we actually curate the opportunities that we work with? Now, for us, there's a specific way, that we actually have done this for a long time. And we're fortunate enough that we actually get a lot of referrals from investors that we're working with, from companies that we're involved in, etc. And so there's a couple key things from our perspective, and this is what makes what we do so unique, is that we think about things from an ecosystem perspective. So often we get referrals and introductions, as an example, from, some of the high net worth, the family offices that we deal with. So typically one of the curations for us, from a company standpoint, is that number one, who actually referred us a company? That's an important part for us. Number two, we want to understand who's actually already backed a company to date, who's already invested into that company. And then three, we're trying to understand, some of the traction metrics behind what they've already received, what they've been able to achieve with their business. And then number four, like typically if they've got, with those traction metrics, if they're B2B, some of their blue chip clients that they're actually working with, or, if they're doing trial partnerships with certain groups as well. Typically, if it's a life science or a technical business, then we're also really trying to understand who's involved, who's the team behind it, and trying to make sure that they basically have that sort of been there, done that sort of experience that we're looking for in a company. So they're for us some of the key things that we're looking for. And the final note is, I often get a lot of questions around from the AI aspect. And this is why, to me, obviously the last session we're going to have today is around the venture capital side. And I mentioned in my earlier talk, I think that is fundamentally one of the most exciting parts. And even when it comes to sort of alternative assets or to private equity, I think the potential of what we can do with AI across a business has rapidly changed what can be done from a productivity standpoint. And so therefore, and if you think about every company at some stage needs to grow capacity inside their own business. And there's typically layers in which you think about doing that. 3 to 4 years ago, we'd always just think about bringing on someone new, bringing on new team members. But now I find that when I'm speaking with CEOs, the first question they're asking themselves is there a software solution that can solve this role? And what's interesting is the software builder themselves are actually building software for specific functions and job roles. That is super interesting because it gives you a bit of an idea as far as what this innovation space looks like and for all the builders in the space as well. So that's the first part. So the first part they're asking is what software? And then the second part is really interesting is they're asking, can I outsource this role to another country? And that has also been interesting for me. And then lastly, they're thinking about, okay, well, if I need to get someone locally, that's the sort of third stage. So the shift in mindset from CEOs in how they actually utilize AI, starting with how can I utilize software in this, then moving to is there outsourced talent? Because effectively, I know in Australia, typically people only come to the office 2 to 3 days a week. So working with outsourced team members isn't that much of a stretch compared to what it used to be. So there's a great opportunity that sits inside of that for all of us that are business builders to have significantly, and this is, obviously, with Simon coming up with Alex Bank shortly, I think about that from a banking. Could you imagine what a bank could look like if they didn't have all the redundancies, of the past? There's sort of decades of different applications and software that they have to try and get to communicate to each other, what it actually looks like to scale a financial services business compared to beforehand. But to me, that is the exciting part about innovation. That's the exciting part about the potential of what people can actually build. So that's it from my note. Now, obviously, this next session I'm going to let Evangeline introduce. We've got it. So all these are sort of, I suppose people have built relationships over a period of time and some become friends with in that time as well. Wee Mang, I know, going back to 2017 now, and same with Jacqueline, I know from Australia actually, going back to, I think about 2014. That's 11 years. Do you know, it's like when age, you only notice it when it comes out of your mouth. 11 years of knowing each other. But you know, some of the people I trust and respect, and this alternatives area has become such a hot area. I know in Australia, and I know also in Singapore as well, as investors chase yield and return. So on that note, back to you, our famous host, Evangelina.
Thank you so much, our famous Steve, for that introduction. And welcome back, everyone, from your lunch. I trust that you had a good lunch. Judging from the energy in the room, I think it's slightly higher than when we first started. Yes, they had good desserts, good food, and now we have good content and insights coming right up. So let me just share a quick breakdown on the rest of today's session. Right all the way to the end of the session today, we have two panel discussions. The first one on alternative investment opportunities, and then we have company pitches coming right up, as well as closing on a note of venture capital and innovation at the very, very end. And of course, we will close off with a good networking session and drinks over at the exhibition hall later on, just to close the day off very well. Okay? So without further ado, we would love to actually warmly welcome our second panel discussion, focusing on alternative investment opportunities. Ladies and gentlemen, would you join me and put your hands together to welcome our panel of experts? The following experts, we have Ms. Jacqueline Rochelle Yee, CEO of ABEX Asset Management. All right, we also have Mr. Martin Tang, partner of Genesis Alternative, Mr. Tu Wee Ming, advisor of Golden Hill Asset Management. Oh, okay. I thought we were sitting down. We're so sorry about that. Of course, the handsome Mr. Harley Dalton from Prime Financial Group. Yes. Yes. No. Both are equally handsome. Ladies and gentlemen, one more warm round of applause to welcome our panel of experts, please, on the alternative investment opportunities. Over to you.
Good afternoon, ladies and gentlemen. Thank you very much for joining us after your lunch. I hope you have filled your tummies, and this is actually a very interesting panel. We have Martin. He has a VCFM entity, venture capital fund management entity. We have Wee Ming, who has who's been involved in the family office arena and has collaborations with an LFMC fund management company in Singapore. And we have Harley from Australia, fellow countryman, who has been in the ECM equity fund management space for decades and decades, and now he's also in the alternative space. So I'll let them introduce you a little bit more as we ask questions of our panelists. So I'd like to dive right in. One of the areas that has been very topical last year in 2024, and it flows on to this year, is private credit, and particularly private credit in the early stage part of the funding cycle, which is the VC cycle. So Martin, I'd like to sort of throw a question to you. With Genesis, you have introduced venture debt. Could I just get you to share with the audience the motivations for going to venture debt, and how much of that is the AUM part of your total AUM?
Sure. Hi, good afternoon, everyone. Very glad to be here again, together with Wholesale Investor and Steve as well. Good to see him again. I was just in Sydney a couple of months ago. It's great to see the energy flow down here as well, flow up here actually. I'm co-founder and partner of Genesis Alternative Ventures. We are a venture debt fund. So we started in 2019, and today we manage two funds with total AUM of 200 million US. We're backed by a couple of Japanese financial institutions, Koreans, family offices around Asia Pac, a couple of US-based investors, and a big pool of high net worth individuals in Southeast Asia. What was the motivation for us to start venture debt? I'm a career banker, but I'm largely focused on investment banking, M&A. So my first experience as a professional investor was in private equity, where we were doing a lot of structured equity, minority stake investing, and you come up with a lot of investors, entrepreneurs that are actually quite resistant to dilution. They say, I've got a great business, I'm very bullish about my business, I just want to borrow money. I keep hearing that a lot. And around that time as well, this was 2015, where the VC space really started to grow and grow by leaps and bounds. We saw an opportunity for venture debt. A lot of the founders as well as the VC investors realized also that you can't be diluting crazy amounts, 15, 20% of equity with each round. And a lot of startups in Southeast Asia, they actually have a lot of working capital needs, CAPEX, which are much, much better served with slightly cheaper debt. So that really is the genesis of Genesis. And we've gone through this, we've been doing this since 2015. I've been in venture debt since 2015. And I love doing this, and wow, I get to do this.
Thank you, Martin. Thank you for evolving from being a banker to a proper financier in the ecosystem and supporting venture and businesses. So I wanted to then move on to Wee Ming. So this talks about also the private markets capital or private markets availability of funds. We've been seeing a lot of flows of capital from the private market space, from different segments of the private market space, demographically and sectorally. Would you like to share with us a little bit about the recent trends you've seen in the flows demographically? And also, what are the key highlights that you'd like to share that you see where the new generational investors are looking to invest and how they are different from us OGs?
Right. Hi, good afternoon, everyone. It's great to be here, and thanks, Wholesale Investors, for inviting me back here again. I've been a long-time friend of Wholesale Investor. I've seen them grown, year by year, and lots of friends. The ecosystem is vibrant, and I'm glad that we are building one very good ecosystem here in Southeast Asia. So I've been trying to request Steve that he should do perhaps 1 or 2 more stops other than Singapore in Southeast Asia. But thank you for coming. Now, I run family office for many years. I very much love so because it's a very private business to be, where you are part of the family, you serve the principal in a very private way, but very professional way in terms of not just wealth management, but many things in the journey of an entrepreneur, right? So I would say that private market is a very big topic now because family offices are beginning to really look at reconstructing how we look at deploying capital. How do we protect and preserve the wealth? And more important is, what is the new strategy in this very polarized world in terms of wealth creation? So now, moving very close, I think the private market, I would probably let my colleague, which we are the twin face, I'll let Harley talk a bit more, but I want to touch on perhaps purpose and patient capital, because this is very close to my heart. And I think the whole family office, I think we in Singapore, we've been hearing family offices, right, flourishing. We have seen the good and the bad and the ugly stories of family office, right? So it's a very diverse sector. But again, I want to bring that back to our core purpose of our presence as family office, is to really build purpose and patient capital. Now, what does it mean to all of us here, especially if most of you are here in the venture sector? Now, we understood technology has been transforming, and now we've got AI that revolutionizes us, right? In terms of our work, in terms also on our society. So where we constantly look at AI is the buzzword now. No more fintech. Last time used to be the fintech. Now it's AI. I don't know what's next. But the AI space has been a very big topic to us because it impacts not just businesses. It actually fundamentally will impact how the society will be, right? So as a patient capital provider, we have been learning, outreaching to the world, right? Not just to look at investing, but how to look at this as an element that would be the call of our wealth preservation, making sure that our current business, our portfolio businesses will not be heavily displaced or disrupted, and for which that we are trying to play a defensive role, we need to create the new evolution of investment that can then help to protect our business, right? So talk about the protection first, right? Now, while we know that the traditional business is still very heavily funded in Southeast Asia, heavily funded, right? We still have all these businesses very traditionally funded. But now people are stepping up to look at how not just digitization, but adopting AI to look at some functional part of their business or in the industry. So, well, you know, we are in Southeast Asia, and it's so diverse. We've got Singapore here, and we've got Myanmar. Vietnam is so emerging. So depending what business and where you are. Now, I'll just take a step back because I'm recently been very busy with Indonesia, and we know that Indonesia is a huge, massive market. So while Indonesian business is still very traditional, right? The regulators are building up ways to create new capability, draw upon FDI to create new functions in schools to train those occupations to be more adaptable to digital and AI. So we are seeing this, and that's why we play as a patient capital. We are now suddenly being centered around investing in education. And I think this is a right thing because, you know, education is to create talent management. And developing the talent, we think that this is the right time, whether we are Indonesia or you're Singapore. Now, when this tsunami comes, which are already near at our footstep, right? Everybody has got the equal playing field to learn this technology and see how that can be applied into their own career and the business and the industry. So private market today plays a role of a very, in my opinion, a more purposeful role because we understood that, you know, in this transformation world, in the polarized world, things are becoming very disruptive. And therefore, we need to create a momentum to develop projects where we could deploy capital to see this through, not just for KPI purpose, but for the whole foundation of building blocks down the road. We are looking at about 10 to 20 years in our roadmap in investing into AI. So that just the AI topic, all right? Another, maybe I'll just, before I pass the mic to, another hot topic we talk about definitely is going to be climate change, right? So the whole impact investing around, why should we be investing so much into the green area? It's not because it's just a fashion. Now, we have seen so much of this disasters going on. And of course, we've done philanthropy work, a way of creating projects, but in the private capital where we invest to still generate returns, we want to build businesses, and we want to back entrepreneurs to develop a business model where they can utilize technologies to create, to challenge or to counter and combat the climate change. So one of the things that we've been doing in Indonesia, the water keep rising, right? So we are building a lot of very interesting, addictive material, where we want to create this addictive material into barriers at the sea level to help them create this, the rising of the water in many islands. It's not just in Jakarta, right? So we are investing into technology, right, where it will be able to combat this climate change. And this is just one of the projects we are in. All right.
Thank you, Wee Ming. So we've now heard how patient capital, early capital in both the debt stack and the equity stack helps early stage innovative companies survive through their growth before revenue, pre-money stages. We're very lucky actually to have Harley here, who's a very experienced fund manager with both equity and quasi-debt under his belt. So I like to move the questions along to, for the purposes of investors, how do you, what do you see in the private market space as we construct our portfolios with the huge amount of information asymmetry for the purposes of generating alpha returns for investors? At the end of the day, one of the value propositions of private markets, alternative investments, is the ability to convert information asymmetry into a form of alpha return for a portfolio. Would you like to share some of what you see are the current trends? And passive versus active investment, right? For us in the investment management space.
So I'll start with the second question first. I think passive, if you look at the Australian share market and the Singapore markets, similar. Passive investing is massive, driven by ETFs. And so what's occurring is that the largest businesses are getting access to that capital and at the expense of smaller businesses. So if you're an asset allocator out of a big shop somewhere around the world in New York, and you're risk on or risk off, you're giving a percentage position down into Southeast Asia, into say the ASX or the Singapore Exchange, and it tends to go to those top businesses. And what that means is that there's a valuation gap that you're seeing, particularly in that top 20 versus anything outside the top 20 from a liquidity perspective. When you drop that back down, then Jackie, to what's happening in the private space, there is that asymmetry, because passive is not going to go away, but there's an opportunity to actively manage businesses where you can generate alpha by being involved. And so I was speaking earlier around our involvement with businesses is getting actively involved by sitting on the boards, having observer rights. I want to have financial reports like it's a listed business and bring governance into those businesses. But I want to manage those businesses to protect my capital, because we all talk about protecting capital because it's your first principle. I don't think that's going away. And the reason it's not going away is that there's more opportunities in the private space than there is in the listed space. So in Australia, particularly, in that businesses worth sort of sub 200 million that are private companies, there's more access there from my perspective. So where do I want to go shopping? I want to go shopping where I can get the best access to the best deals, where I've got a better opportunity to filter it out. I've spent 16 years in the active space in Aussie equities. It's now driven by the biggest funds, all who are taking passive positions effectively. Very hard to find alpha in those spaces. Taken into the private space, it's a much more happy hunting ground for me.
Thank you, Harley. I might continue on that, and then we move backwards towards me. So, having said that, then what sectors? So, obviously, when one gets a seat on the board, one of the value propositions as a board director, board member, is to lend expertise in particular areas of the business so as to ensure the alpha is sustained. And in this case, provide also robust contingency options to the business to see around the corner. I would like to sort of speak more specifically about your current role at Prime Financial and Altor in terms of what sectors do you look at to generate this alpha, and what sectors are you focusing on for your alternatives, and what geographies and what stage?
So my happy hunting ground is in Australia because it is my backyard. I think we've had opportunities around Southeast Asia and Europe and the rest of the world. And I think we've all been involved in businesses in this room today, and things go wrong all the time. And I can't imagine something going wrong in a business that I can't actually go and see really easily, where I don't have tort law at my expense like I do in Australia. And that's why Australia is quite a attractive place from an investment perspective because of that tort law capability, besides the fact the Australian dollar's terribly, pathetically weak, the Aussie peso. We talk about areas that we like investing in. I want tailwinds in these businesses. And again, for that same reason as I spoke earlier about businesses all hit cycles. And so if I've got a tailwind behind me, it means I can get through that cycle a lot easier. Sectors we particularly like are defence area. Infrastructure spend in Australia is a massive opportunity, both with the Olympics coming up in 2032, but also just in that social infrastructure space that I spoke about earlier as well. I love financial services. I've been in the financial services industry for 30 years. I understand this sector well. I'm happy to get involved at an equity and a debt level in that space. And we like energy transition. So there's a massive opportunity in Australia with businesses that are positioned at both things like solar panels and batteries, and how you actually take an opportunity to grow those businesses. And the opportunity exists because it's really hard to get access to capital in Australia. The Australian banking system, post a Royal Commission, basically made it really hard for businesses to get access to this capital. And unless you're a small business where you're prepared to put your house on the line, from a collateral perspective, you cannot get access to capital. And that's where our business probably sits in that role of actually coming in. And now we sit there as basically replacing the banks as an access to a debt facility. Does that answer that question?
Yeah, it's very powerful to have balance sheet, especially if and when you're on the buy side as a substitute to the banks. Correct. Yeah, in the Aussie context especially. So, Wee Ming, I want to expand the question a little bit because of your expertise in technology and your focus on AI and climate. So, as we know, AI consumes a massive amount of energy. And so that kind of falls at tangent with the whole climate dialogue in terms of conserving use of energy. So what becomes then a value proposition is the opportunities in the transition energy space for sustainability, and then how you dovetail that with your AI interest and mandate.
Yeah, I think it's a very good question because I think the industry is all facing this similar challenge. Now, from my point of view, I've seen a lot of projects that we've been invited to invest. I think this energy transition is a very challenging one. As far as we in Asia is concerned, aside of China, China has been very advanced, but outside of that, that includes Japan. We see that this energy sector pretty much still centered around very non-innovative project. Funders, banks are coming in, and the private equity funds dashing in. I see, in my opinion, still a very early stage where now energy storage technology is becoming, in terms of price performance, is there. where scalability, still not sure, but again, the technology plays a vital role, right? And China has been very advanced in this space. But for the rest of us, we're trying to challenge all the technology. We don't see that this technology is still mature yet, all right? And therefore, this whole energy transition, in my opinion, is still at a very early stage. We have invested in very traditional energy, green energy kind of project. When I look at the performance, is quite good, consistent. But so far, these are heavy infrastructure project. And this project is not very technology, not innovation centric, but whereas very infrastructure. So I hope there will be more technology entrepreneurial that will be able to break cycles where at the skill level, today we see a lot of innovations at very small scale. But when you are looking to deploy the real world, it's still a big question, right? So that's something that we are still not very sure. And back to how this energy transition impact the AI space, right? So obviously, I was looking at last week, right? CoreWeave has got the IPO, right? I think that is a very smart software stacks because a part of the NVIDIA value chain, they are able to create software stacks that will be able to optimize performance. And I think these are the technology that we have been looking out to, because we cannot be just saying that how energy is going to be conserved or optimized, but we have to go to the core of how computers, the new technology will have to be redesigned and into the power crunch AI machines, right? So we still have to solve that very downstream issues. And we are seeing that all these innovations are taking place, especially in the Western world, US, Europe, at the chip level, at the software stack level. So hopefully those innovation will help us save more energy than what's current, the algorithm stated that is still very power intensive for a lot of the AI solutions. All right. That's my take. Thanks.
Thank you very, very much, Wee Ming. I think this is not working, so I'll just shout. Thanks, Martin. So Martin, this will be something that is of very valuable insight, information to startups out there and to investors also early in their journey on venture debt investing. As an experienced venture debt investor, could you share how you would like to see startups, what stage would you like to see them get to? How would you like to see them present themselves? At what point in their business would they be attractive to you as a venture debt provider? Are there more particular sectors that you are more ready to look at? Or do you also like to diversify your portfolio?
Mouthful of questions, mindful of time. So we are sector agnostic in general. So wherever our VC friends are invested in, that's where we come. In terms of companies that we look at, so the first principles are debt will always follow equity. So equity is high risk, high return. They are the ones that finance the moonshot projects, the R&D, and the debt guys like us will come in when there's proven market fit, there's traction, there's revenues, there's a list of customers that have signed up and are using it, the product, the software, and we will come in to fund the growth, we'll fund the working capital, the capex needs. So the types of companies that we fund tend to be a little bit more along the road. Companies, like I mentioned before. So very, very early stage companies are better off being funded by friends, family, private investors that understand the risk they are taking part in. That's where they get the 1,000x returns, 2,000x returns. Debt investors, they don't. Like if we get 2x returns on a debt transaction, if some warrants, it's a great outcome for us. But that's good enough. I mean, there's something for everyone.
Thank you, Martin, but a very, very important capital tranche indeed for the venture space. We've run out of time, and thank you for your patience, and I hope you found this session interesting and illuminating. Please share with me a round of applause for our panelists.
Thank you so much for our, once again, can we give a huge round of applause to thank our esteemed panel or our panelists today. I don't know about you, but I really wish that session could go on a lot longer. But not to worry, the connections don't end here because we have an extended networking session later on. So do feel free to reach out to them wherever you see them later on in the exhibition hall. All right, and moving on next, we actually have our company pitch presentations coming up, short, concise, and to the point. So we have just about 5 more of them. So we can look forward to companies from various industries. The very first one, we actually have TNB Aura. We have Mr. Joe Chang, who will be presenting on behalf of the company. Ladies and gentlemen, would you put your hands together to welcome Joe Chang, partner at TNB Aura.
Okay, great. Good afternoon, everyone. So my name is Joe, partner at TNB Aura. So this is, actually this is something special. We actually made this video out of mixing chemicals, real chemicals, and took videos and create content about it. And this was done in National University of Singapore. It's one of our, a lot of collaborations with the top universities around the world.
Do you believe in the right?
Sorry. I will just skip the video because I only have 8 minutes. So what is TNB Aura? So we are Singapore-based venture capital fund, sector agnostic, focusing on Series A and Series B investments across Southeast Asia. And we are actually at our 3rd fund. So total AUM across 3 funds is about 250 million US. And we are privileged to be backed by a lot of the top global investors around the world, which I will touch on a little bit later. And then we have made about 25 core investments across Southeast Asia, including Indonesia, Vietnam, Philippines, and of course Singapore, which is our headquarters. And then we also actually do a lot of collaborations with the institutions especially on our research side. And then, so our team, right? So in a nutshell, so our team comprises of a group of experienced professionals and also experts in their respective industry and fields who have built and exited business before. And also, just one thing to take away from the structure of our team. So in every country outside of Southeast Asia, we have a country partner who is responsible for getting access to the local partners, companies, and also do a lot of the value add and due diligence for us. But at the same time, each of the partner, aside from my founding partners, have specific roles on the group level. So for example, I'm taking care of our research and investments. David from Philippines is taking care of our value creation for our portfolio companies. And also Glenn is focusing on driving exits. So that reflects how we think about and approach the end-to-end investment process. So why Southeast Asia? I will make it quick on these few slides because I assume everyone here is more familiar about Southeast Asia landscape. But why we are so excited about venture capital investment is because Southeast Asia as a region has very large population. I still recall like almost 10 years ago when I started my career in venture capital, we were still talking about 600 million population here. But now we are at around 660 all the way to 690 according to different data points. And also we have very good economic growth and also very, I would say one of the top region that is connected to the internet, because the users here in Southeast Asia are super users, right, compared to other regions. That's why a lot of the global investors are having increasing allocations into this region across all different asset classes, especially in private equity and venture capital. And also over the past, I would say 15 years, the ecosystem has really grown and matured. That's why we have seen a lot of exits, IPOs happen in the past few years. And also we see trends on more and more M&A activities, and then potentially more IPOs to happen once the market recovers. And next is I'm going to talk about how do we capture the opportunity as a fund, right? So our fund, so over the past years, right, we have been innovating and refining our investment approach and thesis. So so now we have a very kind of a systematic way of looking at different opportunities in the region. So we actually started with doing a lot of research and also collaborations with the universities, starting with Singapore, and now we're actually collaborating with all the top universities across the region, right? So how do we do that is, first we have this, over the years we collected this proprietary database on most of the unicorns or soonicorns from China, India, and now we include the US and Europe as well, to basically figure out where are the biggest opportunities, and then also the industries and sectors with critical mass. After that, we basically do remarket sizing of those opportunities to Southeast Asia, country by country, because the market size landscape is very different. And after that, we will, so just to clarify, so it's not the copy and paste model, but we will rather study the success drivers of those unicorns or precedents in other countries, and then map it to the reality of Southeast Asia to find out what is the best business model to be adopted here. And then after that, we will go out to canvas the market, interview the founders from all these countries, and then at the same time, we will build conviction into certain industry, country, business model, and also identify the potential winning team, right? So this is probably is too small to see the detail, but this is just giving you guys an example of how we run our research to the investments. So this is almost a monthly process we do. So every month we will pick 2 to 3 industries to do research. So very important steps through our research is that first thing we want to understand the market size, the overall opportunities, and the global, and the macro tailwinds or headwinds. Second thing, we study the industry value chain from all the way upstream to all the way downstream to understand the key sectors or verticals within the industry. And then by using a lot of the data we collect, we try to identify what is the most interesting verticals within our industry. So in electric vehicle, right, after doing our research, of course, the top opportunities are in the EV four-wheelers by market size, number of unicorns, and then, but however, it's not the opportunity that a VC can participate in Southeast Asia, because it's mainly dominated by the large player from the US or China, and all the opportunities that are happening in Southeast Asia is the opening round will be $100 million via a JV of an international player with a local partner, right? And then the next step, however, other than the EV four-wheelers, the next most interesting opportunity to us was EV charging for four-wheelers. And then therefore, we do a deeper dive into this space, looking at all the companies in the US, China, and India. We actually identify specific business models that have worked out in other countries. So turn out to us is the most interesting business model is called end-to-end, according to us. So basically, it's a business model that a company owns their IP, they do installation, and then they operate. So once they start operate, it's like a real asset business. So each charging station is with very low maintenance, and then you generate consistent cash flow going forward. And then after that, we also study each country landscape in Southeast Asia. So quite surprisingly that the data shows that for EV charging, Singapore is definitely the biggest market here in Southeast Asia because of the government has been driving adoption of EV cars. And the second largest is Thailand. But why is it important to understand the country level metrics as well? Because Singapore alone may give us the opportunity to get a 5x return. But you know, venture capital always asks for unreasonable returns, right? Like 5 years in 10, for 10x. So it's very key that a EV charging company start in Singapore to make sure the business is sustainable, but also have an angle to expand regionally. And then the last step is we basically speak to all the players in Singapore, Malaysia, Thailand, Indonesia, and then to determine the potential winning team, right? So following this research, we actually made an investment that was just announced, I think, Q4 last year into a company called Charge Plus. So it's the largest EV charging players in Singapore and also in the region, right? Yeah, we have more data to do, like even more advanced research. I will skip this. So in terms of positioning, right? So for Team Biora, we want to be the best Series A or Series B investor across the region. We don't want to compete in the seed stage because I think we have a lot of very good peers focusing on that stage. Either they specialize in a certain industry or they specialize in certain country. But we are very close partners working with all these seed investors to make sure that when we come in to do a Series C deal, is one of the best deal, right, in the region. And our value proposition will be very different from the seed investors, right? Because when we come in, we basically want to make sure that the company adopts very good governance compliance process, and also setting them ready for the growth stage later on. Yeah, so a little bit about the track record, right? So if you go to our website, you can see all these companies. But I think two things to take note. One is when we evaluate our investment at the beginning, we actually are looking for some potential fund returners. So basically, one investment will return the whole fund. And we are targeting to generate a few of them, right, per fund, so we can have a good return to our investors on net basis. And also, one of the trends is that across our fund 1, 2, 3, there is actually I would say, an evolution of the quality of the company we invest in. And one example is like actually from our second fund, we invested into a lot of fast-growing companies, but they are not. They're still quite far away from the profitability stage. So they need to keep raising money to sustain the growth. But coming to our third fund, we actually invested into several companies that is already profitable or are very close to profitability when we invest, but at the same time, they still have very high growth potential. Also, so another two things to take note of. So by this pre-keen, so it's a benchmarking platform for private equity and venture capital globally. So we are basically we rank the top quartile in Asia. And also, we are one of the co-investment partner appointed by the Singapore government under Seas Capital. So Seas Capital is going to merge with EDBI. So this is a special scheme for Singapore government to encourage deep tech investments. And we are part of that. As I mentioned, right, so we are actually invested by some of the top global investors, like Norfund is the Norwegian DFI, Khazanah is the Malaysian DFI, FMO is the Dutch one, and then Development Bank of Japan, also, and at the same time, also some of the top fund of funds globally. And hopefully, I give everyone a sense of venture capital investment in Southeast Asia and the opportunities. And feel free to reach out to me or my colleague Sherry, who is here. After this, happy to chat and also show you guys more about how venture investment is done or can be done in the way that we are doing right now. Yeah, thank you, everyone.
Thank you, Joe, for that comprehensive sharing. And once again, he's sharing that himself and his colleague Sherry will be here later on to connect if you are interested. All right, up next, we have Alex Bank. The company is Australia's 100% digital, only 100% digital challenger bank. Ladies and gentlemen, let's introduce and welcome Simon Bates.
Good afternoon, everyone. My name is Simon Bates. I'm the CEO of Alex Bank and one of the co-founders. Today, we'll quickly run through what we're doing. We are here raising money, and we've got 10 million of that already committed out of the 40 million. Or actually a bit over that 10 million, with an IRR on this round of a bit over 42%. So strong return, as some of you have already talked to me about today. Alex Bank, why are we winning? We're Australia's only digital bank. And some of you have been surprised by that. It's a true story. And that's because Alex Bank, Australia is dominated by 4 large banks, which take 83% of the market share, and they've been focused on digitising their processes around mortgages and transactional banking. We see a real opportunity, and we are a live bank today in market, of focusing on highly profitable niches. These are things like consumer lending products for cars, renovation loans, insurance premium insurance premium funding, and also small business loans. On the other side of the balance sheet, we fund that today through deposits, predominantly term deposits. We're winning with the technology we've got in place. We're fully licensed, unlike in Asia where there's 2 different types of licenses. In Australia, there's only one banking license, and we have that. The market potential for those markets that we're spending is a bit over 338 billion. The market is huge in Australia, and we're just slicing off little tranches of that. And building out a multi-billion-dollar balance sheet. Customer dedication. The bank has been built with customers in mind, and we've used lots of customer insights to build out the bank today. We're 100% digital, as I said. We're born in the cloud, and everything that we do is digital with modern AI credit decisioning. Our customers typically apply for a loan in under 3 minutes, 2 minutes 40 seconds. AI makes credit decisions, and our credit decisions are instantaneous, whether it's an approved or a declined, or if the customer is required to send more information, then they're asked to do so. Scalable channels. In Australia, it's quite unique. We've got this unique opportunity for a B2B2C channel. So our brokers in Australia, finance brokers or mortgage brokers, do all lending except for credit cards, and we use the broker channel. There's 20,000 brokers around the country, and today we have over 1,500 already accredited. So we're highly scalable, and we only pay for the loans we write through the brokers. Interestingly, if a finance broker sends us a deal and it falls over within the first 12 months, we pull back our commission. We also use partners, and I'm pleased to say we announced just before Christmas that we've partnered with Qantas. Qantas is, of course, our national carrier. That gives us access to over 16 million frequent flyers, which is terrific, and then digital direct. On the deposit side, we also have wealth platforms. That look after our self-managed super fund and other depositors, and also give us deposits. So we have no problems in attracting deposits in Australia as well. We're highly efficient. And that's because we've built highly digital processes and we're running a bank on 40 people across the country. Risk maturity, we've got mature risk module and we've built from day one in responsible lending. And our people, founder-led organisation, we're bankers that know how to bank. I think just quickly on this slide, the big takeaways for this is we're building a big scalable bank in Australia, and we've got that now as far as the frameworks for that. We're looking for 5% market share through those niche channels. The significant domestic balance sheet across retail and small business is large, over 20 billion in assets there. We're targeting at a scalable bank a cost-to-income ratio of around 20%. The big four banks in Australia operate at around 48%, so significantly less than that. Our NIM today, or net interest margin, between our deposits and our lending, today is a bit over 5%. So again, highly profitable business with an ROE of greater than 20%. So it's a really quite a strong business case. To give you some insights into the Australian market, there's over $4 trillion in deposits in the Australian marketplace. And we're focused initially on the term deposit market, and about 20% of that comes through those channels I just talked about. The profit out of the Australian banks is huge, as you can see there, and the bank's trading multiple is incredible compared to some parts of the world, as you can see there as well. An average of 16 times for banks trading multiple. The Australian banks have thin net interest margins, and that's because they focus on mortgages and transactional banking. They have a higher cost-to-income ratio that I talked about in the mid-40s, where we're targeting a sub-20 or sub-30 to 25%. Our return on equity is around that 15 to 20%, and we know that through what we're factoring today that we can get there. And what's really interesting is our customers and what they're telling us, and our NPS or our Net Promoter Score is 74, and you can see the big four banks being Commonwealth Bank, Westpac, National Australia Bank and ANZ is sub 10%. In fact, they're just down at the baseline of 0. So our customers are loving us and continually to tell us they're loving us and asking us for more products. The market opportunity I've already talked about is significant. Our initial part that we're talking about is consumer finance market. It's 153 billion in size, of which 30 billion of that is in market every year. So again, it's about slicing off small parts of this and getting us there quickly. Our second phase is around small business. In small business, a lot of the banks have also retreated in that area there, given the cost to serve a small business customer is actually the same price as serving a $5 million property lend. So we see real opportunity using the technology we built at Alex Bank. And again, that addressable market's about 185 million. I'm not going to spend a lot of time on the product sets given the time I've got, but as I said, we have personal loans, small business loans, savings, deposits, and if you want to find out more, you can certainly talk to us afterwards about that. I've already talked about how we're addressing the market, and in Australia it's a unique opportunity around the B to B to C. So we only pay for business that we attract. We only pay for business that we attract through brokers, partners, or digital direct. Qantas is something that we were excited to announce late last year. We get access to their 15 million frequent flyers. We're the first bank in Australia that has been able to seal a partnership like this, where we're doing lending and deposits with them. All banks in Australia have a credit card relationship with them. We're the only one that's got this opportunity to target their customers. It also allows us to build our brand alongside an iconic brand like Qantas. Our digital tech stack, and I'm racing the clock here, our digital tech stack we've built on top of Terminos, which is a global banking system and well known in 104 countries, I think, these days. We've gone and built our Alex proprietary technology on top of that. Straight through processing, Alex Intelligence, which is our credit decision engine, and our partner portal. That allows us to deliver products to our customers in elapsed time, 2.5 hours, versus traditional banks in Australia taking 3 to 4 weeks. So we're really shifting the dial on the numbers. You'll see down the bottom there, those third parties mean that we can also move into different countries. We've got a really experienced team. And I won't spend time talking about any of them other than Alex Twigg there has built 5 digital banks around the world. Egg Bank, which was sold to Citibank, UBank, which was National Australia Bank's initial satellite bank, Judo Bank, he was a co-founder of, and Judo is the second of the 2 new banks in Australia, Judo Bank and Alex Bank, currently around. And then Alex Bank was the founding executive for Trust Bank right here in Singapore. So Alex has a lot of experience in building banks along with Alex Bank. Our cap stack, just quickly, we have about 28% of high net worth individuals in that cap stack. Family office groups, about 28% of our cap table. Institutional investors, well-known institutional investors like Regal Asset Management out of Australia, Manala, SG, Hiscock, Allium, all well-known, and then 20% still retained by management. What we're looking for, as I said at the start, is we're raising 40 million of Tier 1 capital. That means it's purely to help grow and scale the balance sheet of the bank. We're looking to list in the next 2 years. And as I said, we've already got about 10.2 or so million of that already allocated, and we've got a number of people that have shown interest on this recent roadshow. I think that's probably everything given the time there, and I've raced through that in record time. So thank you for your time. We're in the over where the food is. I'm there with the other co-founder, Craig Fenwick, and our CFO. We're the only ones with a purple tablecloth, so you can't miss us if you want to come and find out a little bit more. Thank you for your time.
Oh, that was a nice touch. Only one in the purple cloth. Okay, next we have from Chiron Global Technologies. In the area of defense technology improving survivability, let us welcome co-CEOs Samantha English and David Peiston.
Good afternoon, everyone. It's a pleasure to be here. Can I just kick off by asking who here has had any armed forces or police experience? Few. It's Singapore, I figured. Me too. So we've got an innovative high-tech defence offering to show you today, and it's all about saving lives, improving survivability of frontline personnel. But we're going to kick off with a quick video. Okay, so what you've just seen is an ex-Special Forces operator and leading combatives expert conducting highly realistic close-quarter combat training. He's shooting high-velocity, non-lethal rounds at point-blank range, and he's delivering high-impact, lethal strikes with blunt force weapons. Now, this type of training is not possible anywhere else apart from the Chiron X1 Elite suits. I'm going to talk a bit about those today. Okay, usual disclaimer. Okay, here's the problem that we're trying to solve. So these are the combatives training suits that have been in market for around 40 years without a lot of innovation or change. There are a ton of problems with these suits. The main issues with them are that people get injured all the time wearing this equipment. But worse, because they can't train realistically wearing these suits, when it comes to a frontline situation when their lives are at risk, they don't have the muscle memory and they end up getting either seriously injured on the front line or worse, killed. So we've seen examples, unfortunately, of videos from Ukraine where poor training has led to personnel being trained in that conflict that's happening. So really unfortunate. So here's the solution, quite a different approach to combatives training. What we're doing here is replacing 3 different pieces of combatives equipment that are currently used with one suit. So we're using advanced materials. This is the world's first hard armour training suit for combatives. It's made out of advanced composites, and this is all about improving survivability for frontline personnel. So it has high levels of protection, as you can see. It allows high levels of realism in training. What does that mean? It means that when those personnel are in a frontline situation where they're facing violent threats, they're prepared and it keeps them safe. It also reduces injuries in training. Okay, just a quick overview of Corin and where we're at. So we've brought to market a product that the market has asked for, and the timing is right for this product. It meets the current needs of frontline personnel. It's a dual-use product, so as well as the obvious defence, we're also selling this product into police, corrections and security vertical markets. We've patented the solution around this design, and we have patents either granted or pending in key markets. Before we brought this product to market in 2023, we spent years testing it with special forces units, naval boarding and clearance parties and police end users, and we took all of that feedback, and that's in the product that you saw in the video. We've established distribution channels with established defence and law enforcement distributors in key markets, and we have an agile revenue model. So the suits are available to either purchase or to lease, and obviously that accesses training budgets. So some units can access the capability via OPEX. Okay, just a quick overview of our product roadmap. So the Corin X1 Elite, that's the suit that you've seen in the video, the all-carbon fibre elite training suit that is currently in use with special forces operators around the world and with other customers, including a government customer here in Singapore. We are here today raising money to pay for tooling to bring these additional 2 products to market. So essentially, the same patented design forms the basis of 3 products. We're wanting to break into the additional vertical markets of police and corrections, high volume, high margin markets, but we know that we need to bring a lower price point product to market in order to do that. So we are raising money to pay for the tooling for an injection moulded version of the product, which will form the basis of the standard training suit for those markets and our first operational suit, the X1R, a riot and public order suit. Okay, I don't think I need to tell everyone here that the world order as we know it is changing, and not necessarily in a good way. So we're seeing increasing geopolitical instability. The group earlier touched on that, and that of course is leading to increased defence spending and spending into defence also. The timing has probably never been better to invest in defence, sadly. Civil unrest is on the rise. Stats have riots increasing to about 300% over the last 14 years. So that's a huge increase. We believe that we have a product that gives frontline personnel the protection and the training that they need to keep them safe in those violent situations. And we believe that we have a product that can significantly disrupt this market. I'm just going to hand over to my co-founder, David.
Thanks, Sam. So what does all that mean? We have a large serviceable addressable market. So it's about $3.1 billion. Our customers are NATO and their allies, so the countries that you see in blue on the map. And we believe we can capture a large proportion of the training suit market and the riot suit market with these low-cost injection moulded versions of the product that you've seen. And we're looking at generating about just under $34 million of revenue by 2027. We're in market with a current product, so the product that you've seen is generating sales. We have sales on 3 continents, in Europe, here in Southeast Asia and in Australia. So about $750,000 in sales to date and about a $2 million order pipeline for the current product. But the exciting opportunity is to bring these lower cost products to market where we can address these additional verticals of law enforcement and corrections that don't have the budgets of the special forces. And those products are being developed in response to customer demand. We have been told that our training product is better than current operational products, and could we please bring a version of our suit to market for those customers. So with the low-cost products, they're actually a higher margin product, and the company will be profitable by 2027. And as I mentioned, those products are coming based on strong customer demand. In terms of the team, we've got an experienced team with a broad range of experience in leadership and in commercializing businesses. So I myself am a serial entrepreneur. I've started and exited a number of technology-based companies. Samantha has defence background working for, serving for the New Zealand Defence Force, as well as extensive experience in branding and marketing, particularly across Southeast Asia. And our third co-founder, who's not with us, Justin, has extensive legal and executive experience, but importantly, 35 years of combat experience. It was actually his idea originally to come up with this product. We have an extremely talented design and engineering team that are based out of Wellington in New Zealand, and we brought in subject matter experts from defence globally to assist us with developing and growing the business and advising us. So the raise now is a pre-Series A raise of $3.6 million. And that is to fund the development of these two low-cost injection moulded products that will allow us to bring our world-leading technology to these additional vertical markets and provide better protection for frontline personnel in law enforcement and corrections. And we believe we'll capture a substantial share of the riot suit market and the training market with those products. So just to recap, we're an established business. We're generating revenue already. That's why we're post-seed but pre-Series A. We're generating sales in a number of continents with a strong pipeline building. But the really exciting opportunity is with these two new products that we want to bring to market. The solution that we've developed is patented. We have patents granted and pending in all key markets. And as Sam mentioned before, we have distribution channels in place. So experienced partners that are already working with defence and law enforcement customers in all our key markets. The company will be profitable by 2027, and we see a return on investment in the form of either a trade sale or a sale to private equity or public equity. So I'd love to thank you for your attention. We're over at table 7 in the room next door if anyone would love to come and have a chat with us, and we'll also be at the networking event later. But thanks very much.
Thank you so much, Samantha and David. They're, right as they said and shared, they are at table 7. If you don't see them, just see two tall, built, very defensible individuals there. It was really very unique sharing right there. Thank you so much. All right, up next we do have Fruity Sugar. Here to introduce healthier sugar to the world, we have Mr. Andrew Ong, founder and CEO of Fruity Sugar. Ladies and gentlemen, Andrew, please.
Good afternoon, everybody. I'm Andrew Ong from Fruity Sugar. So like what you have heard, we're talking about healthier sugar. Basically, the problem starts from the issue of diabetes and then a better understanding of how the problem is trying to be solved by using artificial sweetener. Of course, when we delve into the use of sweeteners and sugars, you realize that there's a lot of limitation given by these sweeteners. One, either is too sweet or the taste is a bit weird to some people. And then in case of the sugar alcohol, some people can't even take them. So in fact, whether you're type 1, type 2 diabetes or pre-diabetes, there are people who find this actually a very limited option. For us, well, what we feel is that there is actually a better option that is hidden somewhere, but work has to be put in to put them out into the market. And that is allulose. Now, 30 years ago, the Japanese has found this sugar. It is natural. It works like sugar. It tastes like sugar, but it doesn't have calories in it, as in almost like 10% of what we are seeing in cane sugar. But it's also important that it works like sugar, as in like you can put it in ice cream and you can use it in beverages. And this actually is the kind of solution that is useful if you're talking about replacing white sugar. So the problem, of course, is that hardly anybody heard about it, and that is only because it is very expensive. So click too much. Okay, so such good thing is quite unbelievable, and very often when I mention about allulose, a lot of people tell me, "Oh, it's too good to be true." But it has been in market manufacturing, especially in Korea. For the last 10 years, it has been manufactured there. And the last plant that they built actually is 4 times larger than the first plant they built. So there is actually a demand for this sugar even though it is fairly expensive. And to show you that actually there is attraction for this sugar in Australia and in New Zealand, recently they actually approved the use of this sugar. Of course, in America, there has long been approved, and also in Singapore. So that this interesting sugar do exist and do move in the market. But we have to keep remembering that why it is not everywhere, and simply because it is just too expensive to make them the way they are presently been made. So what can fruity sugar do? What we do is that we come and solve this problem about cost and scale. So if you have something that's very good and is very hard to make and very few people can get access to it, then again it has no meaning. So our solution is, instead of using very complicated machines to try to filter out the allulose from the fructose after the enzymatic conversion, we use fermentation method to eat up the unwanted fructose, or in our case, we can even have glucose inside there, leaving behind the allulose. Now, the interesting thing about our technology, and it's patent granted in America, is that after getting the allulose, we actually are also growing probiotics. And we also have the sugar converted to lactic acid. And if you all know, lactic acid is actually very useful, even for making bioplastics or even the body parts. So there's a lot of value in the byproducts that we are creating, that comes off from our system. So all in all, the key thing I want to stay on this particular picture is that the input cost is actually very low. We are talking about tapioca starch or cornstarch. But the output you're getting, it can be very, very valuable. So it simply said, the return on investment on the system can be very, very high, depending on how much work we have money to put into. So market size, of course, is talking about sweetener, is into hundreds of billions of dollars, not counting the lactic acid market size and the probiotic market size. Here is just talking about the sugar issue. And of course, the trend, as you can see, to be expected, white sugar in the red line is supposed to be coming down, and then the other sweetener is supposed to be coming up. Now imagine when the allulose can be made the way we are proposing here, the cost of allulose will be about 3 times and most 5 times higher than sugar. So that means that it actually will be very affordable and accessible to a very big mass of people. So definitely we will be able to take up most of the market from there. Application-wise, almost limitless, because we know sugar is everywhere. So if you have something that is healthier and almost the price of white sugar, virtually you can put into anything that now you are making. So we say that we are meeting people where they are, because very often in a situation with diabetes, you tell them to exercise, you tell them to not eat that, and you know. So there's a lot of telling them what to do. But if you are indeed able to use allulose very cheaply and produce a lot of things which then they can then choose suitable to their style and suitable to the way they live their life, then they naturally will have a chance to have a reduction in the use of sugar. So that is why we feel that the market potential for this is fantastic. The business model that we are proposing is, first, we import the allulose and we distribute them in a way of giving education as well as creating demand. As we are building up the plant, we will be then, next phase, be able to provide allulose syrup to, on the B2B basis, to maybe beverage manufacturers or to food manufacturers. And then the third phase we can do will be then to engage with overseas customers, because we all know diabetes is everywhere. So you can virtually go to almost any country and they should be interested to be able to provide low-cost, safe sugar to their population. And that is how the business model will work out. And then we will, in that case, be able to be fairly lean in how we go about doing the business, yet we are able to reach out globally. the team here, of course, myself, I'm just the salesman. We have the inventor, Dr. Zhou, who is there to make sure that everything continues well, Dr. Chia. But more importantly, I want you to look at the other side where we actually are also getting grant from Ministry of Education because indeed, we are having this joint project with Singapore Polytechnic, and they are actually working and looking at how to use allulose in pharmaceutical application and even in functional food. So there is a lot of help. I mean, in Singapore, the ecosystem is fairly good. So we get a lot of help in terms of the application of the allulose and let it seep into the market and into the industry. There will be a patent we'll be filing later on with the money that we can secure and further improve on the protection of the business. One thing to note also that one of the enzyme that we are using is co-developed with A-Star, which again, they have patents exclusive to us. So the ask is very simple, just 2 million. 2 million to be able to work on building a pilot plant. By having this pilot plant, we will definitely be able to demonstrate how profitable the business is. Imagine the input material is nothing but just starch, and then output material, you are talking about probiotic, we are talking about lactic acids, and of course, very in demand allulose. So I think it is very interesting, and I think it's very important opportunity. It's very interesting and very valuable opportunity. I wouldn't say lucrative until the whole system is up, but this is what we are working on. So thank you again for your time, and please reach me at table 9 for further discussion.
Thank you so much. That is indeed a very valuable opportunity given the growing healthcare concerns on the rise. All right, last but not least, before our much anticipated panel session later on, very soon, Venture Capital and Innovation, we have one last company presentation, and that is by Refilled, providing a world without single-use plastic. Ladies and gentlemen, can you join me to welcome Ryan Nelson? Ryan Nelson, Ryan is founder and CEO of Refilled.
Is this the clicker? Hello everyone, my name is Ryan Nelson and I'm the founder and CEO of Refilled. We are an Australian climate tech startup and I only found out about Emergence on Sunday, so I booked a flight and arrived last night. So if I seem a little bit tired, please forgive me, it's the end of the day and the time zone's a little bit different. I'm sure you're probably all aware of the climate catastrophe we're facing around single-use plastics. But what you may not know is that we are now producing over 481 billion single-use plastic bottles every year. It's 1.3 billion bottles since we've been here today. What's even worse is that less than 20% of these are ever recycled, with the other 80% ending up in our oceans, landfills, and environment, taking over 400 years to break down into harmful microplastics, and they're ending up in our food chain. I recently met a professor from the Edith Cowan University in Perth, and they are conducting autopsies on deceased adults, and they are finding up to a credit card's worth of microplastic inside the human body. And it's been linked to brain, heart, and lung disease from all the chemicals that they're leaching, and the body cannot pass them. So we're only just starting to see the radical health implications of plastic. So once I started researching the plastic problem, I quickly realized that it's actually beverage brands that are leading this climate catastrophe, with the top 3 plastic polluters worldwide being the brands that you guys probably all know and love. They're found across the world on beaches, rivers, parks, everywhere. And so if we've got an established market or a growing market with beverage consumption going up and plastic consumption going up, flavored drinks aren't going anywhere. People are going to keep drinking every single day. What are we going to do about it? How are we going to disrupt this very wasteful industry and change? Well, we have created a smart drink dispenser that solves that problem, and it's a full circular economy. I've got a quick little video that explains it, so you can actually see the product in action.
Hey, did you know that we produce over 1.3 billion single-use plastic bottles every day? And what's even worse is that less than 20% of these are ever recycled. And the rest? they end up polluting our oceans, landfills, and environment, taking over 400 years to break down into harmful microplastics. I'm Ryan, the founder of Refilled, and I've created a machine that can pour hundreds of flavoured still and sparkling drinks without producing any single-use waste. Just bring any reusable bottle or glass, press a few buttons, and customise your perfect drink. Choose still or sparkling water, mix and match flavours, and if you want a boost, add caffeine, vitamins, or electrolytes. It's delicious, healthy, and sugar-free. There's something for everyone. So it must be more expensive, right? Wrong. Refill's up to 50% cheaper than traditional bottled and canned drinks. And what about convenience? Even better. Your office manager will save a ton of time, so you'll never have to worry about stacking the fridge ever again. So if you're ready to ditch single-use plastic and enjoy our delicious Australian-made drinks, get in touch with the Refilled team. Because together, we can save the planet from plastic, one refill at a time.
So as you can see, we are a hardware startup and we have invented this technology, the smart drink dispensers that are capable of pouring hundreds of different flavoured still and sparkling drink combinations with zero waste to landfill. There's internal bladders that can be fully recycled and each machine can hold up to nearly 9,000 serves of drinks. And so it's your classic coffee machine and bean business or razor and razor blades. We make the equipment, but that's our Trojan horse. And then where we really make all of our money is on the drinks themselves. But from a consumer point of view, you get the drinks you know and love. You can get energy drinks, vitamin waters, teas, all sorts of drinks available from the one appliance. Our vision is to become the most sustainable beverage company in the world with a mission to eliminate 1 billion single-use plastic bottles by 2030. And the market, I'm sure you know, it's absolutely enormous. I don't need to tell you about that. There's nearly $1 trillion worth of soft drinks consumed worldwide every year. And in APAC, 124 billion, hence why I'm here today. And so our business model is to manufacture these machines. We're looking now into Thailand and China and how to bring them to the region. They're currently made in Australia, but we just lease the equipment to the client and then they buy the drinks from us as they consume them. So an example here, we've got clients in Sydney. They pay $595 a month for the equipment. We've got a debt facility where that washes its face and is actually profitable for every machine we put in market. But where it really gets interesting is in the variable cost of the consumables. And we have currently where our unit economics and our economies of scale are the worst they've ever been because we have no purchasing power as a startup. We still make 90% profit margins on these drinks. So we can sell a drink for $1.50 and make it for 20 or 30 cents. The business is 2.5 years old. The first year and a half, we were focused on R&D and prototyping. And we launched the product in July. So in July 24, the first machines went into client offices. We're now at Uber, Google, Atlassian, Metcash, Databricks, Meta, JP Morgan, WPP, DocuSign, Asana, Woolworths, and DLA Piper. And the reason that this is important is that these clients have asked us for this product in their Singaporean offices, and we can't fulfill the demand. We currently operate Australia-wide, but we're looking to raise capital so we can establish a presence here and become the market leader. This is a customer case study of one machine that's been at Google 12 months. As you can see, 1/3 of our revenue comes from the lease itself on the equipment, and the other 2/3 is from the high margin consumables. So if the machine sold no drinks and it was just the equipment lease alone, it would be paid off in 36 months. We build the machines for about $12,500 Australian. But when you factor in the margins from the syrups, those units are paid off in less than 12 months, and they have a 10-year effective life. Everything's powered by IoT technology. I've got a demo over there at booth. I think I'm in booth 10 in the left-hand side corner. You can come see the technology and everything we've built to run it, but we are not a boring vending machine company. My background is in SaaS. My co-founder's in SaaS. He's been through Y Combinator. We're trying to build a really smart, intelligent system that enables the scale out, the rollout of this solution at scale and providing analytics to the clients that can actually measure this in their scope 3 emissions and how much plastic they're reducing through our initiative. Now the important stuff that you all probably care about, the milestones, where are we at as a business? So you'll see the first year from July 23 to July 24, we were pre-production prototyping phase. And in July, we rolled out our first production units. So we now have 30 of these systems in market, with the majority of them in Sydney. And we've just installed in Brisbane and Melbourne. But we have grown 20% month on month. Our roadmap is to roll out 500 machines over the next 2 years. That'll get us to 9.6 mil ARR, and we want to do that through scaling Australia, but also establishing our office and presence here in Singapore. We're also working on some product iterations to open up the addressable market with a mini version of our dispenser. And beyond that, if we get to 5,000 machines in the market, we'll be at 96 mil ARR. So how are we going to achieve this? We're currently raising $4 million US, and we have 830K committed. That was opened 2 weeks ago. So we are looking for a lead investor for 2 or 3 million. Ideally, someone that's to do with sustainability or has a presence in hotels, real estate, development and construction. And the good news is that I have a debt facility in Australia. That means that there's non-dilutive funding to build the 500 machines. So the debt's already in place to build all those 500 machines. We just need the equity capital to be able to grow out the sales and marketing team. You can see some use of funds here. And I have a very robust 5-year financial model that I can share as well, along with my pitch deck if you're interested. As I said, myself and Stefan, and then we've got a core team of 7. So we're 7 people approaching $1 million ARR, and will be profitable inside of 6 months by the time we roll out the next machines. So we really want to accelerate things and, you know, capitalize on this opportunity for the demand for our product. You can see some of them here live at client sites. But yeah, look, if you're a potential customer here in Singapore or anywhere else in Asia, we've had inquiries from the Philippines, Japan, Korea, the UK. We are the only player with this sort of technology in the Southern Hemisphere. There is a company in the US that have raised over $130 million, and they have a 5-year head start on us. So there's validation there in having a large competitor, but the market is big enough for multiple players. So thank you for listening. If you want to book an investment call with me, you can scan the QR code. And thank you very much. Cheers to saving the planet from plastic, one refill at a time.
Thank you so much, Ryan. Oh, truly one plastic at a time. He left his bottle here. Okay, ladies and gentlemen, we have come to the final panel discussion. Thank you so much for staying. And this is our much anticipated session on the crucial role of venture capital during innovation. Ladies and gentlemen, would you put your hands together and join me to welcome our esteemed panel of 6 experts. We have first up, Mr. Shiva Vanaraman. A huge hand for Mr. Shiva Vanaraman. He is founder and CEO of Veritas Asia Pacific Ventures. We also have Mr. Joseph Mukanu, managing partner at Verge Health Tech Fund. A huge hand for him, please. Next, we also have Mr. Hershen Elton Powers, director at 1982 Ventures. Also with us, Mr. Joe Chang, partner at TNB Aura. Okay, last but not least, we also have Mr. Tong Xian Hui, executive director at SG Innovate. Mr. Xian Hui, please. Thank you so much for joining us. You must have heard us from across the hall. We also actually would like to convey also our sincere apologies for Ms. Shi Yan Ko. She had to leave due to the delay in the start of the session. She had to take her leave early, but sends her apologies and also we hope to have been here. Without further ado, we will pass the time to the panel. Thank you so much.
Yeah, so first of all, a warm welcome to all my panelists. Shian, unfortunately, Shian had to leave. She had a meeting. And also, I wanted to thank our very patient audience for staying with us till the end of the day. And I have about 40 minutes, and we're going to cover a variety of sectors. So the first thing I wanted to ask each of my panelists to do is to briefly introduce themselves, share their firm's investment focus, and in a few words, describe your current priorities.
Hi there, so I'm Dr. Joseph McAnuff, co-founder and managing partner of Verge Health Tech Fund. We invest globally and very early in impactful healthcare technologies. And that can mean, you know, different things to different people. And to us, it means anything that can really bring healthcare more preventative, more distributed, and expand access, quality, and efficiency to care around the world. So an example of what that might look like is, you know, a digital stethoscope that costs $15 to manufacture that can prevent, you know, a concerned parent taking a 6-hour trip to a hospital in a remote Indonesian island versus, you know, being able to triage it at home, or, you know, a platform that can structure and organize health data so that it's actually useful longitudinally to a variety of different stakeholders. I guess the question is, what am I excited about, or what am I looking for these days? Basically, anything that can do that. I'm most excited about getting clinically relevant telemetry with increasingly cheap and innovative detection technologies at the moment. Cheers.
Hi, Herson Powers, founding managing partner of 1982 Ventures. Based here in Singapore, we're the leading seed fund focused on software infrastructure, fintech, enterprise AI. We are a top 5% fund globally. Right now, I'm mainly focused on finding the best founders to invest in. We're a first check investor. All we need is the founding team, some tech built, then we can write our check. We generally do about 500,000 to $1 million for that first check. Additionally, we're raising our second fund to basically double down on the thesis that's working. And we're also looking for more partners across the region. So a lot of our backers are corporates. So that could be Genting from Malaysia, Carta from the US, a lot of other large strategic conglomerates around the region. And we'd like to help them access this innovation faster. Thanks.
Hi, my name is Xian Hui. I'm Executive Director of Investments for SG Innovate. We are one of the Singapore government's investment arms, focused primarily on early-stage emerging tech startups. Mandate global. The kind of technologies and startups we invest in tend to be companies that are solving the world's biggest problems. Probably sounds a little bit ambitious, but we certainly are looking at areas like nuclear fusion, quantum technology, cell and gene therapy, just to name a few of the kind of areas that we focus on. And what's really exciting these few days or these few weeks is that there's been lots of inflection points in a lot of these cutting-edge technologies, like in quantum, in artificial intelligence, and even in nuclear fusion, and that's taking up a lot of my time. Thanks.
Thank you.
Hi, my name is Joe. For those of you who have listened to my presentation just now, you already know a little bit about myself. But just a little bit extension from that. So I was actually born in China. I came to Singapore over 20 years ago, and then I have been in the VC space for about 10 years. So again, TNB Aura is a Singapore-based venture capital fund focusing at Series A stage across Southeast Asia. Our typical check size is about $3 to $5 million, and then we can go up to 10. So our investment process is very top-down driven and research-led, right? So we do a lot of different kind of research from micro and also looking into specific industries, verticals, and business models. And we also do a lot of outbound reach to the founders instead of waiting for our network to introduce founders to us or waiting for the founders to approach us, right? So because of that, we actually have done some of the investments into companies that didn't even go out to raise money, right? So and what we are looking for right now, I think, is I would say the next generation of tech-enabled startups with very strong team experience, and also who are very rational and focused on the business fundamentals. Yep.
Okay, thank you. Thank you for all for your introduction. So let's start with maybe the first question that probably is on everybody's mind, AI. So what I would like each of the panelists to talk about is, how does AI intersect various sectors? For example, AI in life sciences, or AI in robotics or advanced manufacturing. I know, Hurston, you have invested a lot in fintech. So AI in fintech, or energy, or battery, or carbon credit, or any other deep tech technology that AI can be combined with, like quantum, right? So maybe if you can just talk about, hey, where do you see AI having the most impact, especially in your fund, in the areas that you focus on?
Okay, are we just going? Okay, I'll start. So the short answer is everywhere. Like, why are we even talking about this? It's almost like air or investing in the internet 20 years ago. So there's nowhere that our life is not going to be impacted by this. It's transformational. This is really just day one. We've seen it within our portfolio companies, the banks and financial institutions that are working with our fintech companies. So there's not just one place that I think you can look for. It's about where are you positioned to ride this wave. So I'll take it a different way in the sense that even my industry, venture capital, being a fund manager, we need to utilize AI as much. We're probably one of the only funds in Singapore that has AI agents doing everything that an analyst would do. So we haven't hired any analysts. I never want to have to hire an intern again. All my CRM, my pipeline, my research, it's all done by AI agents. So anywhere where a traditional industry can take advantage of these agentic forces or Gen AI, it will be transformational. For me, financial services is one of the easiest places to work with. Banks, insurance companies are some of the last, I'd say, to adopt technology. Maybe that's because of regulation, maybe it's because of their legacy, management, whatever the reason is. But today they are forced to do it because fintechs are coming after them to eat their lunch. And we're still at day one. I think less than 1% of all financial services revenue is actually taken up by fintechs or digital financial services, but it's growing exponentially. So what I'm looking for are founders that are utilizing AI from day one when they're doing the startup, beyond just kind of thinking about, you know, if it's going to be shipping or manufacturing and the like. So short answer, everywhere.
It's really hard to follow up after that one. So the question, so maybe we'll fast forward to the singularity, and maybe I'll ask the audience, show of hands, when super AI takes over, are we pets or vermin? So pets, show of hands, are we going to be pets? No? Vermin? Everyone thinks we're going to be vermin and exterminated. Lovely. So, you know, this is the first time in human history where what made us special? Well, there's two things that make us special: intelligence and opposable thumbs, right? The software revolution has threatened our intelligence, and that's step one. That's all this agentic work, the large language models, all this fun stuff. The next thing that's going to happen is our opposable thumbs are going to be threatened, because you're starting to have robots that are, you know, multi-purpose, actually understand the world around us, because the large language models have been understanding the universe of text. Like you ask, you know, you pose a question like a baseball is thrown 30 feet above a human, you know, what's the next thing a human does? Catches it. Obviously, a human can't jump 30 feet, at least not normal humans. Let's wait until we have the, you know, robotic enhanced humans that could. So it's going to be a really interesting question as to where this world ends up. Now, this big X question, we don't know if or when that's going to happen. Maybe there'll be some global calamity before that takes us. But the next 10 years or so are going to be really exciting. And maybe this is where I'll actually answer your question. And, you know, where are we excited about AI in our sector? Right now, the really boring plumbing of healthcare is awful. You have rooms full of people doing medical coding. You have, you know, you have highly trained doctors who make more money adjudicating claims in emerging markets than actually treating patients. That's all going to go by the wayside. So you're going to have this low risk, you know, high mundaneness, very formulaic type of work that's going to be replaced, automated, wonderful efficiencies. It's going to be great. And, you know, the goal of a healthcare professional is to be a healthcare professional. You're going to interact with the patient, and technology should be invisible and seamless to them, because all the decision support and everything should be happening in the background. Today, it'll be on your phone. Tomorrow, it'll be projected onto your retina while you're having a conversation. That's exciting. On the life sciences side, we now have the ability today to predict the structure of a protein based on its sequence, and not only that, predict what small molecule you'd need to synthesize to fit that protein to activate or inhibit it. That is immense. That is something that we thought we'd need quantum computers to do, but now we're able to do with generative models, AlphaFold 3 being a particularly strong example of that. What that means is anything that nature has ever designed or evolved and expressed across the millions of organism types that are out there can now be predicted and solved. You want a cure for cancer? It's coming around the corner. We want to figure out how we're going to grow old and die? That's going to come around the corner as well. You want to make a poison that will kill you and only you? That's also coming around the corner. So that is pretty crazy what's going to happen here. So if we can avoid this kind of apocalyptic scenario that may or may not happen, it's going to be a wonderful age of abundance for AI, and we're going to figure out how to basically, you know, be functionally immortal if we want to. That's the end game, the end of all disease, the end of all sickness. And it's within the horizon of the feasible, which is crazy, and not a lot of people think about that.
Yeah, maybe I'll go first before everyone sort of takes up all the all the answers. But I think as investors, we looked at it and we said, hey, AI is prevalent. AI is here to stay. It's going to continue to grow. Adoption is going to be more prevalent in every single industry. So the question is, if that is the thesis, then what happens after that? From an energy perspective, this AI, all the processing that's needed, how much energy is going to be needed? How do you communicate? How are you going to move data more quickly across the various data points? How are you going to make data or AI more readily available to the common man? I think when we looked at that, then we started to say, hey, we need to put in a little bit more money into things like energy. We looked at cybersecurity because that's ultimately going to be something which AI, you're going to have to protect your AI models. You're going to have to protect the data that's coming in and out of it. We looked at processors. We looked at photonics because that's about transmission of data. So I mean, there are a lot of ancillary technologies that as investors we can look at because they will inevitably be valuable just based on the fact that AI is going to become more prevalent. And maybe just to add to something which is probably more Joe's area of specialization than mine, which is that AI can only do something up to a certain stage. I mean, we do investments in a lot of cell and gene therapy companies. The AI can definitely give you the structure of the molecule, so on and so forth, but the clinical trials still require, the real world trials are still needed because we don't have a complete understanding of biological pathways and the way the body works. So I think there's still going to be several decades, if not a generation or two, before human beings are left irrelevant. That's okay. I'm old enough to not need to see that.
Yeah, but you might live forever. So.
I'm hoping so. So that's all right.
Joe, you want to weigh in?
Yeah.
Maybe talk a little bit about your deep research that you're doing across all the sectors.
Yeah. So we actually done AI research. I think for Southeast Asia specifically, right? I think the opportunities lies with specific applications in certain industries or use case, right? So because all the infrastructure, the large language models, all this stuff is actually taken by the US and China, right? So it's very hard for Southeast Asia to compete in that sense due to capital, talent, availability to data, right? But there are opportunities, right, lies in specific industry applications. I think that's the overall kind of insights from our research, but we are still monitoring what opportunity will emerge the next stage. Because if you think about it, 20 to 30 years ago, that generation grew up with internet native. And Southeast Asia, starting from 2009 or 2010, we are actually the perfect example of starting with mobile internet native because we didn't have the internet era, right? And then now the generation now is basically AI native, right? Because my kids are started to interact with AI straight away, and then we are also using AI agents to handle some of the process, not like completely replacing our analysts, but I think there is a trend, right? So I think the importance is the people who can adopt the AI technology better and faster than other people will benefit and make a real difference, right, in the next coming years. And also, I can't really predict anything after the singularity. I think that's the meaning of a singularity point. But I think but there's one space I really personally concerned with or are interested in is that authentication of AI-generated content, because
especially copyright.
Yeah, it's like not only copyright. It's basically AI can generate text, videos, image, music. Like just if let's say there's a supercomputer, right? Like it can easily wipe out all human history. Like there must be a way to protect the rights of human to really understand the truth in the future, right? But this is something I'm personally very interested in.
Yeah, even I think Sam Altman is monitoring that one case that is going on in the United States. If you want, I can send you the link. So let's move. I think I don't know if I'm pronouncing your name right. Sinhui, he made an interesting segue into energy, right? So maybe I'll jump to my next question, which is energy transition, right? I read somewhere that Microsoft took over 3 Mile Island. I don't know if you all saw that, right? 3 Mile Island nuclear power plant. So I want you to, all the panelists, to talk a little bit about, of course, AI and energy, but also about things like EVs, the emerging opportunity for not only energy production, clean energy, like nuclear fusion, solar, but also how do you store this energy, right? How do you utilize this energy? Especially now looking at the geopolitics that is going on, right? Like, with now we have President Trump in the White House, and it's no longer clean energy anymore. So I know there's a lot that I've asked to you to comment on, but how do you all look at the energy space? Maybe Joe, you want to start there because you did something in mobility, right? EVs and mobility. I saw your research, I was paying attention.
Oh, thank you. I think energy is a very wide industry, right? Because you can look at renewable energy, or the green tech related to carbons management or credits or projects, right? So I think at least based on our research in Southeast Asia, we are very much focusing into energy access. So basically using renewable energy, for example, like solar panels, right? And then provide and also use. I wouldn't say it's new technology; it's already out there for years. But the access, right, is very important because a lot of the rural area in Southeast Asia do not have stable access to electricity, and then and also like for some certain country, like for example Philippines, right, the electricity price is super high, and then there is a good opportunities to help the people, but also make real monies there, right? And then we also study the carbon credit space. I think two business model are quite interesting. One is doing the credit rating or standardization across the globe, right? I think, but the difficulties is why Southeast Asia will have the best platform, right? And then I think Singapore might be a good space, but it takes years to build out the reputation, come out with standardization, work with all the different governments, corporates, right? So it's not that easy. The other space we were looking at is basically carbon audit, right? It's like in the financial services, in all the companies about certain size need to do audits every year. I think going forward with the push of sustainability across the world, this will become a standard, and then this is gonna be a service to be needed by most of the larger corporates, right? So I think this is another space we are looking into.
Anybody else want to comment?
Yeah, because I talked a little bit about energy, perhaps I should say something. So I think, obviously solar, wind are the renewables, and even thermal energy are the renewables that most people talk about. Challenge with these technologies is that it is intermittent. So in other words, no sun, no energy. I mean, obviously there's storage, but you need the storage is in itself lossy and inefficient. The only real replacement for fossil fuels is really nuclear energy at this point in time, outside of any other technologies. And you've probably read a lot about small modular reactors that the UK now is committed to build, and the US as well. But at the end of the day, these are still using the traditional fission technology. So the waste that comes of it is still very radioactive and can be harmful for people. And when they say small modular reactors, you're right. The reactor itself is probably smaller than what, a tenth the size of this room. But the cladding that needs to go around it probably takes about 1 square kilometer. So I think it's not that small. Which is why we actually looked at fusion. Now, fusion technology is probably 15, 20 years But a lot of these big MNCs are putting their bets behind this because they feel that that's really the only way in which they can get clean energy to power all these data centers that are ultimately going to be driving all the AI applications that we have all been talking about. So I think lots of different, there's some crazy solutions out there. I mean, we are fortunate we get to see the craziest solutions. There's a company in the US that wants to beam energy from the sun, from space. They want to create big reflectors and they want to beam it down to Earth. I don't think they're getting much in terms of traction, and certainly I don't think President Trump's administration is going to be behind this particular solution. So yeah, these are some of the things that are going on now, but energy is a big issue, and not just energy generation, but also how do you store it. I mean, you mentioned batteries and all that. You know, at the moment now, it is dominated by the Chinese. CATL is probably the biggest battery manufacturer. BYD just announced that they have a battery that can power their vehicle for what, 300-400 kilometers without having to recharge or to charge the battery within a couple of minutes. That's amazing. I bet you the battery is going to burst into flames after a few charges, but that's me. I don't know the technology behind it. But anyway, we'll see. But lots of exciting things happening in this space, and watch it, and perhaps there are investment opportunities there.
I'm not sure I can speak exactly to the energy, but all the points kind of point to something that I keep hearing is that we're going to see more investment into the core infrastructure, the data centers, and all the hyperscalers, AWS, Google, Azure. They're investing in Southeast Asia, and I think that's what's really missing. People are missing this point, is that they're focused on the US, they're focused on the turmoil in Europe, and China, maybe it's time to get back in. We're not sure. We're seeing rapid developments there. And India, we haven't really seen too much movement in this space. But Southeast Asia, whether it's in Thailand, Malaysia, Singapore, increasingly Vietnam, we're seeing the government, we're seeing the big tech like ByteDance, Google, and the rest invest in this market. What I'm really excited about are the externalities that are going to come from this investment, not only in just the compute, but in what we see for our startup ecosystems and what we see corporates starting to do with more access to innovation. So there are going to be a lot of energy challenges around that for this region, but I think we should look at the positives too, is that actually we're in one of the most undercovered markets, Southeast Asia, with probably the best chance for growth, especially in the early stage VC today.
At the risk of swimming outside of my lane here, my only claim to energy knowledge is my father being a nuclear engineer and having a chance to visit a few reactors when I was young. We haven't talked about transmission and infrastructure. We've talked about generation and storage. We have not talked about the very costly and ancient infrastructure that's transmitting our power today that is in need of great upgrading, which unfortunately we haven't seen a very clever way to mitigate that. I think China's done a great job. They're very good because they still make stuff. They know how to make stuff. The rest of the world, unfortunately, not so much. So then there's two solutions to this. One is you figure out a way to radically transform your grid, or you decentralize your grid. And depending on where you are and what you do and how you get your power, decentralization may make more sense than rebuilding infrastructure, similar to how we see cell phones replacing landlines, right? There's an opportunity to kind of leapfrog Southeast Asia, given how disconnected it is. Maybe decentralization in smaller, more modular power generation solutions, be it nuclear or not, could be the solution to challenge some of these logistic issues. But there are going to be some applications that you're going to need large centralized power for, and namely the ones that are consuming, or rather keeping NVIDIA stock price as high as it is, right? So that's probably what you need to think about, and also you need to think about the appropriate power mix based on what your resources, capabilities, and infrastructure. And what's the term? Geologic stability or seismic stability may be, because no one wants to build a nuclear reactor on a fault line. So.
Yeah, thank you. Very interesting comment. Actually, the Adanis or the Ambanis, one of them is building a huge power plant in Western India that caught the attention. So I'll find that link and send it to you if any of you are interested. So let's transition to maybe what could be the last panel question, and I'll try to throw it open to the audience. Transition to life sciences and health, right? I know some of you are not in that space, but I heard from Xian Hui that he's doing that. So what do you see as opportunities or challenges? Would it be gene editing, synthetic biology, gene therapy, or more innovations in digital health?
No, maybe I should let Joe speak first.
So I think the problems in life sciences are all human in nature. So I don't know if you noticed, but the FDA is being completely gutted, kind of selectively gutted based on the agendas and biases of someone trying to get certain things through the FDA and not able to. And that's been interesting to see because that has affected our portfolio companies tremendously, especially in neurology, which had, for a time, the entire FDA staff cut. So regulations, they're there for a reason. They prevent snake oil from becoming mainstream. They make sure that things are safe and effective. Maybe there needs to be a little bit of innovation to just stop at the safe side and let the market kind of look at efficaciousness, because the problem is the more targeted and the more specific we get, the more personalized these therapies or regimens are going to get as well, which means that to do a large, randomized control study is going to be very, very difficult when the applicable population is like 6, right? Or 1 when you get ultra personalized. So how do you do that? Combinatorial therapies are really difficult. It's hard enough to look at a cancer drug like a biologic plus a small molecule versus gold standard, let alone taking 6 different things at the same time, because that's tailored to your genome, microbiome, and transcriptome and the particular kind of cancer that you have. So it's very difficult to have a regulatory framework that works here, especially when your regulatory framework has been gutted. The other challenge is that it's so damn expensive to run a clinical trial because of all the things I've just mentioned, plus the fact you have to get for-profit hospitals or academic medical centers to be convinced to do this thing. And there are arbitrage opportunities. Southeast Asia is a great arbitrage opportunity to run clinical trials here more cheaply and quickly, but then the problem is you have this data quality issue, which the more developed countries might take issue to, and then the local populations don't want to see themselves as being used as inexpensive guinea pigs for the benefit of large, rich Western pharmaceutical companies. So that's another challenge. I think that's fundamentally it, because that is kind of the rate limiting step. To the extent that you can develop approaches or technologies to try to improve the statistical power of your trials, or to increase the the discovery to first in human efficiency play, that could be really, really important and effective. I think for the other things, like the actual designing of molecules and therapeutics and cells, I think that's just a matter of time, and AI is getting smarter and smarter at assisting there. So it's more the regulatory where I see the greatest barriers. Oh, and one more is the, sorry, I'm going on forever. The reimbursement, who's gonna pay for it? When your average cancer drug costs $1.8 billion to take from lab to bedside, and it and the average cost of a new cancer drug for a year is like $180,000 US, and if your country spends $26 per capita on healthcare, how's that going to work? It's not. And is the US sustainable at spending $4 trillion a year, which is 55% of global healthcare spend for just 4% of the population? Basically, the US is subsidizing the entire planet for innovation, and that's not sustainable either. So some structural things.
Yeah, I'll sort of just share a little bit about the areas that we are looking at. Perhaps a little anecdote, about 10 years ago, a French startup founder came to me with a solution adopting a brand new approach called mRNA. The company was called Moderna, and I, of course, told him, your product or your solution is going to be 20 to 30 years out. And by that time, I would either have been fired or I would not be doing what I'm doing now. So I told him, no, that was 10 years ago. I was obviously wrong because things change. And that is the nature of the biotech space. Sometimes needs, force people to innovate into areas or force regulators to adapt to the current situation. But these are extremely rare. But once the genie is out of the bottle, so to speak, mRNA has the ability to actually pioneer new approaches to diseases, certain types of cancers. We have had a very interesting company that we invested in not using mRNA, but stem cells to tackle something called glioblastoma, which is cancer of the brain. No particular drug is effective because of the blood-brain barrier, so on and so forth. They're using stem cells to bring it across. But what was interesting about this company is not so much the fact that it still hasn't gone into clinical trials per se, is that in the animal model studies or in the animal trials, they did it with dogs, and it was extremely effective with dogs. So therefore, the thinking now from the founder is that even if it doesn't work out in humans, there's a huge market in the veterinary space. So I mean, sometimes these kinds of things you have got to sort of manage and structure them. You're going to make an investment in this particular sector.
Yeah, or pivot, right? Okay, so looks like we have about 7 minutes and few seconds. So I want to open it up to anybody in the audience who want to ask our esteemed panelists any question. Any question? We have somebody to pass the mic.
Well, sad to say, every time I attended Steve event, we don't see real innovation coming by. Very much adoption and blindfold adoption. No real initiative for 21C kind of capability. Just as Steve mentioned, for example, Catherine Wood, for example, which is a decoy by Elon Musk. And the question that, for example, there are many things that Michael yeah. So the question, these are not real innovation. These are some you can say purely gimmicks. So the AI you're talking about, the kind of generative AI, which Elon Musk can't even solve his own problem. And most of them can't do it because it's gobble and things like that. Why can't you come up something to say, we're looking for a really good one, original, and this and that? We're talking about hours and hours of talking which have no meanings. What's the question? Yeah, my question is that you guys don't think original out of the box. Why don't you test us with your best of ability so that we can complement with your kind of initiative expectation so that we know how to manage your expectation. Otherwise, where are we? Thank you.
I'll follow that one up. We talk a lot about AI and a lot of this emerging technology. As VCs, venture capitalists, how do you guys see the future of the next founder or the next generation of people coming through? Like, what are the important skill sets that you guys see, look for? Is it someone that's new, embracing the technology? Is it industry experience? What are you looking for that sets them apart?
I think the core is the same. You need somebody that knows exactly what they're going for, that has the grit and the conviction to push forward, and hopefully as open-minded as possible to start deploying these technologies faster than others. So when we invest, we're only investing in a founder, generally. There might be a client or two, there might be some tech, so we spend a lot of time doing forensic background checks, getting to know the founders through their customer network, their investors. This is how we get comfortable. Is that going to change because of AI? No, we just want to make sure that they're thinking about it and utilizing it in the right way. And I don't want to ignore the gentleman's question here. I think the question that you're asking for is a lot bigger than anyone in this room, right? Are the things that we're investing in actually helping people? Are they helping people access financial services, access healthcare? I think undeniably, everyone on this stage can say that the companies that we're investing in are getting to the people or helping businesses all over the world. So I'm not sure if that's good enough for you, sir, but for us, this is where our LP dollars are going to, and hopefully impacting millions of people, not just in Singapore, but across Southeast Asia and around the world.
It's actually a talking event.
Yeah. So
They, just so you know, I work with a lot of VCs. They actually spend most of their days listening. They listen to opportunities, they listen to LPs, they listen for these events. We invite them to hear their feedback and their perspective on what they're seeing.
I love this. This is fun. So I'll give you some statistics. In the past 2 years, we have seen 2,246 startups from 91 countries. We have discussed in meetings about 457 of them. We have met 330 of them, and we have invested in 14 of them. That's kind of the sense of the funnel. We spend probably more time than we should meeting new people. There's only a certain number of people you can meet as a human and still stay sane. For us, it's helping us understand what are the problems, because every founder has taken, you know, a very big decision to do something new that may or may not work. And the problem is you're not going to figure that answer out typically for 14 to 15 years. And that is an immense sacrifice that we have to be respectful and grateful for, because, you know, if we had great ideas, we wouldn't be investors. We'd be doing the startup, right? But we don't. So, you know, our job right now is to invest in other startups that have dreams that, you know, it's our job to back. And when I was an entrepreneur 23 years ago doing my first medical device startup, and I met my first VCs, I thought, holy shit, sorry, I swore again, this second time, Steve, at your conference.
You're most welcome to at my events.
Yeah, so you know, I met VCs and I'm like, holy crap, these folks pick the future in which we live, right? By backing or not backing founders with their dreams. You know, it is great responsibility, and unfortunately, it's a bastion of negativity because we have to reject 99% of startups we meet. LPs reject us all the time. Like we feed it as well. Imagine trying to go to an investor and say, we're going to hold your money for 10 years minimum. We're going to invest in things that you have no say in, and we might be able to make your money back 3x hopefully net after you know 10-ish years. And that's a very difficult conversation to have, because most people who have money like to figure out what they do with it themselves until they realize, oh, whoops, I invested in a whole bunch of crappy things. Maybe we should let people do this for a full-time job, maybe decide how we allocate the funds. So, you know, it is a difficult profession. We do have to talk a lot because we have to, you know, make founders want to meet us as well and say, why should, you know, they take a check from Hurston instead of Joe, or instead of Xianhui, maybe take checks from all of them. So it is a bit of a challenging profession. I think a lot of us could be making a lot more money if we stayed in our consulting or banking careers, you know, feeding the machine and, you know, making 7 figures and then having soulless vices to contemplate our, yeah. So anyways, hopefully that addressed some of your concerns. And if not, then I think it involves, you know, a lot of more self-reflection. It's good that we're kept honest from time to time. And in terms of the second question, creativity, adaptability, and grit.
So I got a question for, I suppose, Hurston, both for the two of you actually. So you both deal with early stage companies. The question I can't stop thinking about is, I know what a role that AI and software has played across my business, as far as, you know, we went, you know, basically reduced the amount of team by almost 2/3, but actually matched what we've been able to do from a productivity, revenue perspective, and everything. In fact, still got capacity in the team to do more. So I sit there and think, if I've been able to do that, you know, with a sort of a general sort of use of AI across our business and just a willingness to try different tools, I keep on asking myself the question, what does the actual future business model look like? And I imagine you guys get a great sort of bird's eye view as to what those companies look like, and especially when they start to scale and when they start to gain traction, you know, you get some early insight. So I'd love, you know, there was, you know, a few years ago they had the sort of the VC operating model, as far as this is what a company should do with their capital, this is how they should invest it, this is how they should grow out the teams, here's all the operational roles. I'd love to understand from you guys, what does that look like now from some of the companies that you're dealing with? And then from you, HH, I'd love to understand how much faster can you get data, you know, and insights into whether your companies are likely to, I suppose, sail or, you know, or fail, you know, just because you can get a feedback a lot earlier. But I'll start with the first question, the first guy.
Yeah, for Southeast Asia, it's not happening fast enough. I mean, we'd already talked about how some of the funds here are already utilizing AI agents for our own work and fund management. So we want to see our companies adopting automation, AI, as quickly as possible. But the sad fact is, and this is not just for startups, I would say it's for enterprises in Southeast Asia, they still feel that humans are cheaper, that I can just get, 20 people in India or 20 people in Vietnam to do the work instead of having to go there. And this is the flexibility of that founder that we need to see that says, you know what, I'm not going to just hire another back office or the conglomerate saying the same thing, that I can just hire a lot of cheap individuals to do this. We're not there yet in Southeast Asia. We want to see them go for that 10x engineer, the 10x product person, and then utilize AI through the portfolio. We haven't seen that in Southeast Asia yet, unfortunately, but that's where I hope we're going. And I think it's going to take a few more case studies. I think, again, and apologies for being a broken record here, fintech, just like yourself, is leading the way. You see Klarna, one of the reasons why it's one of the most anticipated IPOs, not CoreWeave, but a fintech, is because they've been utilizing AI to dramatically drop their cost, to become profitable, and now it's one of the most anticipated IPOs in the world. So are we there yet for Southeast Asia? Probably not. We're going to need a few more case studies and some bold founders to say, you know what, I know it's cheap to get, a BPO or outsourced tech outside of in Vietnam or India, but you know what, we're going to drive through with the innovation through more AI adoption.
This might sound really terrible, but most of the problems with our companies, and we invest globally, we've now, again, invested across all 6 continents. A lot of the startup pain is in waiting for things and waiting for humans, waiting for regulators, waiting for B2B contracts, those really long sales cycles, waiting for clinical trials to finish. So the actual product design and product development is relatively quickly done and doesn't actually take a lot of people. For the things that look more like conventional VC investments, the B2B SaaS plays with, say, digitizing primary care clinics. There are, for example, 100,000 GPs in Bangladesh. Those GPs are not really digital, and you can AI yourself to the moon and nothing will move the needle because those doctors like to be visited in person one by one. And until we figure out ways to automate that, I'm hoping that Figure will make those androids cheap enough that they can. I'm kidding. They'll probably end up being target practice for something until they take us over and get resentful. So that's unfortunately the challenge that a lot of our startups in health tech face. It's just waiting. It's a parallel, not serial game.
Yeah. So I mean, to answer Steve's question, and I suppose, before that, when we look at AI, I don't know, I just came back from the US a few weeks ago, and the badge of honor of a lot of startups there now, which I met, is that I was able to do all this with 3 people. In years past, I needed a team of 30 people to do exactly the same thing. Now it's like, hey, with 3 people, I can do this. So if you give me money, I can do a lot more with 10 or something like that. So it seems like, there's a mental shift in terms of how they view manpower and how they view the new tools that are coming out. At the same time, I've also met a lot of companies in the US that said, hey, OpenAI just basically wiped out my entire business model because I was doing this particular application and OpenAI just 2 weeks later came up with the same thing and they're offering it for free, so therefore there was no business to be had. Yeah, and DeepSeek, and there's a lot of other stuff. I mean, there's a new Manners.ai and all that. There's a lot of interesting things coming out of different parts of the world. But Steve, to your question as to how do we start to detect when something is going to be successful or not, in general, when we make investments, and I think we are not, at the end of the day, I think to Joe's point that was made quite clearly is that as VCs, we are here to make money. We are not here for altruistic reasons, and that applies even to me. We are from the Singapore government, it's a government fund, there's a strategic angle to it, but we have to make money. So, we cannot just say, hey, we love lunar travel, or we love mining minerals on the moon. Let's just invest in a startup that's doing that. That would be completely irresponsible because the technology that's needed to do that still has not been developed yet, or is in the process of being developed. So what we look at are potential inflection points, commercial inflection points. And when we think that certain technologies have reached that inflection point, we make certain investments. And we know very quickly whether we have made the right or wrong investment, because if it hits the period when it's supposed to hit the inflection point and it doesn't, then we either scale down our involvement with the company or we take a back seat or write it down. So a good example, actually, you might have read about this last week. In Luxembourg, one of our startup companies called Spectral, quantum key distribution, cyber communications using quantum entanglement to ensure secure communications, spatial using satellites. They signed a joint venture, they signed an agreement with SES in Europe. That was a company we invested in 6 years ago. And we thought that the space is going to be an inflection point after 2 years. Obviously, it didn't happen, but we kept on at it. We sort of took a step back. We didn't put so much money into it. We told them, keep the lights on. It's going to happen sooner or later. And it took 6 years. So, that's really how we sort of manage our portfolio. You win some, you lose some.
Good afternoon. This is Ahmed and Sosan Berak. We are the 2040 Master Planning of Dubai, part of the 2040 Master Planning of Dubai and the vision of Dubai. We did so many concepts, so many proposals for the Dubai government, and we are a strategic partner of Road and Transportation Authority of Dubai, of the government. I have one question regarding the energy, and it is apart from the vision of Dubai and the government of Dubai. And before asking the question, just to make it more funnier, thank you, Steve, for the invitation, and we will see you. Hope to see all of you in Dubai in May, 6th of May. So the question is, there is a program with the DIWA, which is Dubai for Water and Energy Authority. It's called NH3, nitrogen, green nitrogen. So to save the energy after getting it from the solar sun, you can save it as a NH3, then you can use it later on. For example, now you just mentioned that if there is no sun, so we can't store the energy. We fix it by using the technology of NH3. It's still not that much usable in the world, but it is doable. And we encourage you to, like, maybe once you come to Dubai, we will have a presentation and we will show you how we use it. And Sosan want to say hi.
Hi everybody, I'm Sosan Berak and I'm very happy to participate to this event.
Yes, thank you so much. This is a question and a comment and invitation. Thank you so much.
Yeah. I will try to answer the question. I think when it comes to ammonia and ammonia storage, that's certainly something that we have looked at quite carefully. It comes with its own set of problems. There's an entire economy of its own. From the using the Haber-Bosch method to produce ammonia, to its liquefaction, to its storage, to its transportation, and then after that, converting it into hydrogen, which can be used. So we have looked at that, and I think Singapore does have an initiative in that space, quite an aggressive one, in fact. Our Prime Minister, before he talked about nuclear, was actually talking about hydrogen, and ammonia actually was a big cornerstone of that particular strategy. So, we certainly are looking at companies that are in that space. It's just that with the limitations of time, I didn't go into that. Thanks.
Yeah. Okay.
No problem.
Can we have a big round of applause for our panelists? Yeah. So thank you so much, gentlemen, for a fantastic round of insights. With that, I'll hand it over to Steve, and maybe we'll segue to alcohol after this.
Joseph, you had a name for alcohol beforehand as far as what we do.
I have no recollection of what I said.
Well, ladies and gentlemen, thank you.
He's taking the fifth. He's taking the fifth.
Thank you so much to the panelists. Obviously, I highly respect all of these. As I said, I've been following TMB Aura for such a long time. Hurston, I've known for at least, I think, 4 to 5 years. Same on your side, I think 4 to 5 years as well. And HH was, when I first came to Singapore, he was the man that showed me around Singapore and introduced me to so many parts of this ecosystem. So, and obviously, Shio, thank you so much to you for hosting as a panelist. Also, incredible guy. Ladies and gentlemen, that concludes Emergence 2025. I am getting in between you and networking and drinks at this point. I hope you had a great day. I hope you've had a lot of networks and great conversations. Enjoy the networking. I believe it's in the next room, and we have to be out of here at 5 o'clock. Thank you.